Afternoon and good evening, real estate investors. I want to say thank you for joining me here at Note Investing 101. It's our what we call our Note Weekend training class. It's a 2 hour class. I promise to probably get you out of here just under that on how to get started and how to learn the basics of investing in banknotes. Now, note investing is a broad niche. Some people consider note investing when they hear about, hey, you're going to sell a house on owner financing, you're going to sell or buy on terms. And that's one facet of creating paper. We've done a lot. We do a lot of that. But my favorite niche is actually buying mortgage notes, bank notes directly from lenders, hedge funds, and buying it at a huge discount. And I usually primarily buy non-performing notes, and that's why we get a bigger discount, bigger yield, and a lot less headaches than traditional real estate investing. So I encourage you to check back as this is the 2026 edition of this class. It's hard to believe we've been teaching this class now for over 6 years on teaching the basics of note investing and what we focus on and what we focused on for almost the last 20 years. But anyway, we are here to help you learn the basics, dip your toes in the water, see if buying banknotes is something that you might enjoy doing, whether you're a seasoned real estate investor or brand new to real estate. Guess what? Everybody can buy notes these days. All right. But first and foremost, I'll tell you a little bit about me. I'm Scott Carson. I'll tell you why you should be listening to me for the next hour and a half and then following up with more stuff. Is that I've been an active real estate investor since 2001, bought, flipped, foreclosed, been a landlord, raised capital. But since really for the last 20 years, I've been focused solely on buying mortgage notes from the banks. Okay. And I'll show you how to do that. I'm an award-winning educator and podcaster. I've spoken all across the country, spoken internationally on buying and investing in distressed debt. I'm also my podcaster. It's amazing to see how far we've come for over the last almost 9 years now as a podcaster with the Note Closure Show, Note Night in America, and a few other things that we do. I'm most proud of the fact that I've helped thousands of investors like you get started buying their first note, their first 30 notes, their first 20 notes, their first 100 notes, and taking it to a whole new level where they enjoy being the Lien Lord versus the landlord. And I can also help you invest in Main Street like Wall Street does. Wall Street does not buy properties to fix and flip. All right. They don't do that. Wall Street buys the debt. They want to own the debt, the cash flow, and learn how to leverage that without having to do all the work, all the maintenance. Yes. Will some banks take stuff back and fix it up and sell it? Yeah. But they don't like that. And you should learn something from the banks because over the last 20 years, since 2007, 2008, we've had this huge opportunity of buying non-performing notes from banks and hedges. Yes, you could buy them beforehand, but they become much more accessible to you guys now on a one-off basis. You don't need millions and millions of dollars to buy notes. We've got students that are buying their first note with 10 grand, 20 grand, 50 grand, and making an above average return in their IRA or raising millions of dollars in private capital from other investors out there to go fund deals and making it a win-win solution for you. So let's dive into a little bit of that. But once again, guys, WeCloseNotes.com is my main website. Our website with our Note Buying for Dummies workshop is the #1 investor recommended training for note investing. So highly encourage you to check it out at notebuyingfordummies.com. But we'll get that later on. Let's dive into the content today so you can get rock and roll. I always encourage you, if you're going to have questions after this class, I know it's going to happen. You can always book a phone call with me directly at talkwithscottcarson.com. That's talkwithscottcarson.com. It's a 30-minute call, or we can do it via Zoom if you got a deal you're working on or you've got a question. You're going to have questions. I get it. That's why I make myself available to talk with you. And I guarantee rarely will you get anybody else to talk with you to give you the true insights and not blow smoke up your tail and tell you exactly how this business is, like I will at talkwithscottcarson.com. So there's no cost to that. Book a phone call and let's dive into it and get rocking and rolling for you. But anyway, all right. So let's dive into this first session. There are a variety of other resources you need to know about that you can tap into. These are free resources, okay? Obviously, we have a Facebook group. It's a kind of a semi-private group called Note Nation Facebook group. It's got about 1,000 plus members on it. We have the Note Closure Show podcast. You can listen to that in anywhere you listen to podcasts or at WeCloseNotes.com. We have our weekly webinar we do on Monday nights called Note Night in America. We've been doing some sort of webinar on Monday nights for over 14 years now. And you can go there. It's free to register. Really what our focus here is, it being 2026, is diving into assets and breaking down assets that you can purchase, you can cherry pick from, you can buy for your own portfolio, or deals that you could potentially fund on deals that we're working on. So NoteNightInAmerica.com. We also have the Note Night in America podcast for you. Of course, the #1 YouTube channel, WeCloseNotes.tv. And of course, the link I just told you guys to book a phone call with. But there's also my AI clone. If you want to ask my clone some questions after hours or the middle of the night when I'm not available, you can do so there. And then, of course, our next steps, usually following this, is people will sign up for our 2-day workshop at notebuyingfordummies.com, or they'll sign up for a monthly membership at $97 a month at noteumbrella.com. And then, of course, for those that really want to take it to the next level, we probably should talk about our one-on-one coaching and mentoring program that's so successful out there. It's the best out there when it comes to helping note investors buy deals. But anyway, like I said, there's the logo for our main podcast. And like I said, if you go to YouTube, look for WeCloseNotes.tv, and you'll be tapped into thousands of videos, thousands of case studies, so much great information there for you. That's why we have the #1 YouTube and the #1 podcast when it comes to note investing. But the big question I want to ask you guys and gals that are here is, what do you want to accomplish with this? What are you looking to accomplish overall as a real estate investor? Are you going to do this just for 6 months? Or are you going to do this looking to add this to your portfolio for life? Well, the answer to that is always B. I don't think true real estate investors never retire. We just kind of slow down a little bit, right? We never quit what we're doing. We're always going to be investors. So many people come to real estate investing for a variety of reasons. Why are you here? What is your why? Are you looking for cash flow because you're not making enough at your job, or maybe you want to stop dealing with toilet sinks and trash outs? You want to find an alternative way to make cash flow? Are you looking for deals? You can't find assets in your backyard anymore or in your local community. You're looking for an alternative source to find deal flow for you. Notes are a great way for that. Are you looking to boost your income in retirement? Maybe you're not making enough. Maybe you got some IRA money you've had from a previous job or a previous role where you're wanting to put it to work to make an above average return. We can do that on a passive or part-time basis. Are you just tired of being tired? All right. I know a lot of folks are just tired of being tired, especially in this economy and with what's going on with real estate being so expensive and cost of goods being higher, gas tweaking up a little bit. It's still very affordable here in Texas where I'm at. And here's the thing, I don't care who you vote for, whether you're a Republican or a Democrat or independent, you just have to deal with things. All right. Life is what it is. If you're worried about what's going on in Washington more than what you're worried about your own budget, your own pocket, guess what? You're wasting time. You are part of that problem. But if you want a solution, then it's better to start focusing on your own problems and how we can solve that in today's world than focus on what's going on in the media. And guess what? With notes, you can solve a lot of these issues, ladies and gentlemen. All right. And if you've got money sitting on the sideline, you want to make an above average return, let's talk about how to put your money to work to make it, an above average return, 8, 10, 12%, depending on the deal for you. Whatever your why is, we can help. So whether you're wanting to be active or passive, let's talk. Let's show you the way to do it and why notes, I think, is the best way, the #1 investment vehicle for your hard-earned money. Okay, so let's talk first about the second. Sorry, not the second, but the types of notes that are available out there for you. And it always kind of breaks down into two sides of the note business. You have institutional and non-institutional debt. Now, many people, like I mentioned before, are more familiar with the non-institutional side of debt. Oh, we're going to talk about owner financing a property and carrying paper, or I'm going to buy on terms. And that's a great way. But what we focus primarily is on the institutional side for a couple of reasons. And we'll get to those reasons a little bit later on. But first and foremost, there's a variety of different product niches that come across our desk on a regular basis. And it breaks down first and foremost the institutional, which means it's originated by a bank or a lender, or non-institutional. It's originated by a private investor or an LLC of some sort, okay? You have residential first liens that are performing. Yes, you can buy performing paper. All right. There's also residential first liens that are non-performing. This is one of our favorite aspects of the business, is buying non-performing notes at big discounts. You have residential second liens or junior liens that are both performing or non-performing. We don't see a lot of these like we used to. All right. I've had people reject, I want to buy a portfolio of second liens at like 50 grand. Not going to happen. All right. There's not been as many second liens originated as there are first. Plus, the price point of them is so much higher. It just doesn't make any sense to buy in a second lien position for me. I'm sorry. Yes, if you're using your own funds and you want to put a little bit to work because you only have a little bit of money, that's fine. It might work out to buy one or two, but I would rather make a bigger check, all right, in the first lien space. Plus, it's also easier to raise capital in the first lien versus second lien position, okay? You also have commercial first liens that are performing and commercial first liens that are non-performing. And commercial runs a broad gamut of like mixed use, industrial, warehouse, um, apartments, office, medical, self-storage, RV parks, all that good stuff. We are not going to get into the different types of commercial notes and how to break that down. When I talk about note investing, if you want to learn the commercial side about commercials, you really need to be an expert in that specific niche because underwriting and evaluating a note is so different when looking at commercial assets versus it is at residential assets. Don't get me wrong, we've bought both. But when you're starting off, let's focus on the residential side. Of course, you can buy owner finance notes that are performing and non-performing in today's market. You'll see stuff. I don't go out and buy leads of owner finance notes. I've seen way too many people buy those leads. I mean, I've bought those in the past and then spent thousands of dollars on marketing to get nothing. I don't like targeting owner finance notes. Now, I'll talk a little about it. I'll advertise that we buy them. But I want people coming to me versus going out and chasing one borrower or one lender who's got one note and is kicking the tires. I would much rather deal with banks who have a variety of product on a regular basis that they will send to you on a scheduled time, once a week, once a month, once a quarter, that I don't have to do any marketing for to find deals. Besides jumping on LinkedIn or an email blast, it's much easier and evergreen when it comes to finding notes. So yes, you'll see some owner finance notes that you can buy and sell on performing and non-performing. Contract for deeds are another product. This is a non-institutional product because it's basically owner finance from a lender or a property owner selling a property on a contract for deed or land contract. It's not the same. It's not treated the same as a mortgage in a lot of states. Sometimes it's treated as a tenant relationship versus a borrower. So it can lead to faster foreclosures or evictions, depending on the state. All right, so keep that in mind when you're looking at stuff. And then, of course, we do see some lease options from time to time for people trying to sell those as a note product. It's not necessarily a true note product unless it's converted to an actual contract, but you'll still see those from time to time. Now, where should you focus? Now, that's all about what you want to. A lot of people come to us and they look at either cash flow or property. Well, I'm a big believer that you need to focus on the cash flow side of the business because that's what note business is all about. Repeat cash flow. If you're using notes to find property, don't get me wrong, you can still do that. But if you're looking in, like, I live in Austin, Texas. If I was just looking for stuff in Austin, Texas, I would have gone broke a long time ago. You have to have a broader view. So cash flow is king. You can't fund your deals or buy stuff, pay for groceries on appreciation or equity. You buy it on the cash flow side of money coming in. Return on investment is important. What's going to be the biggest return on your investment? And then there's also return on time. What's going to take the most amount of time or least amount of time, depending on what type of time you have in your schedule. Do you want another 30 hours a week? Yeah, we can do a lot. Most investors get started about 5 to 10 hours a week. Of course, inventory is important, or what you want to focus on. Some states have more notes available than others. And there's also asset classes, like I talked about. Oh, I want to focus on condos, or I want to focus on multifamily. Well, you got to understand what's available in today's market. Of course, pricing stuff in Miami of Ohio is much more cheaper and more affordable than Miami, Florida. Austin, Minnesota might be cheaper than Austin, Texas. So understanding the pricing point, of course, you're going to pay more for performing note. If it's in a fast foreclosure state like Texas or Georgia, you can pay a little bit more than you say would in something that's in Florida, South Carolina, New York, New Jersey, which takes longer to foreclose. And like I said, time. How many hours per week are you wanting to put into it? 5, 10 hours per week? Many people get started. We don't want to create another job for you. That's not fun. We want to help you work smarter, not harder. Okay. And like I say, when it comes to goals, one of the greatest things that we have put together is really a game plan for you to help you work to getting to 6 figures in the next 12 or 24 months. All right, our 2-day workshop, our Note Buying for Dummies workshop, that's one of the big presentations we go through there, showing you how to build a plan to make 6 figures in 12 to 24 months on 20 to 40 deals. And yes, everybody could do that. And that's the biggest thing I want you to think about. But also, if you don't have capital, that's okay. If you don't have your own money or you only have a limited amount of money in your IRA or 401k or savings, that's okay. But we will show you the way and how to raise $1 million in capital in the next 3 to 6 months. And we'll talk a little bit about how we target that later on here in this training. Okay. First thing you got to know, every state's a little bit different, especially when you're buying non-performing. You're going to deal with foreclosure timeframes. It's going to be different. Judicial foreclosures, some states are judicial, which means it has to go through the judge. All right. It's a longer time frames and there's a longer process, usually 6 months or longer. All right. Like New York is going to be take like 3 years. All right. The costs we usually are going to start at $3,500 or $5,000 to foreclose and above that. Most of your judicial states are east of the Mississippi. I'm going to put an asterisk because like California does have a judicial foreclosures for an owner occupied thing. Usually, you're going to pay a little bit of a cheaper price than buying something in a non-judicial state just because you've got to hold on to it for longer. And that's your foreclosure costs are going to increase. And that means your holding costs are going to increase. Okay. Non-judicial foreclosures, where most people they want to dive into that. I'm just going to buy non-judicial foreclosures because it's a fast foreclosure state. Okay, that's fine, but you're going to actually pay more because they do have a faster foreclosure time. Like here in Texas, it's 21 days. Once you're 90 days late and you file something, the notice of default 21 days prior to the first Tuesday of the next month, you can foreclose. Other states can take up to 120 days. It's less expensive. Usually foreclosure is about 1,000 is the cheapest we found it in here in Texas. Most of it's going to be west of the Mississippi. And though and you're going to pay a little bit of higher price point because it is such a fast foreclosure process. Something in Texas is going to cost more than say in Florida because of that fast time frame. Okay. I like to tell folks start off with 3 to 5 states and pick a couple states with bigger cities in both kind of pockets. Okay. I like Ohio as a judicial foreclosure state, but I also like it because I buy stuff that's occupied that I know I get worked back out for cash flow faster than the 9 month to foreclose. Okay. So keep that in mind. You probably want to start off 1 or 2 states in each kind of foreclosure process, judicial and non-judicial, just because you're going to need to know that for more deal flow for you. Okay. Now, the question people always ask me, do I need a license to do that? What kind of requirements do I have? And the answer to that is yes and no. Okay. Depends on what state you're going to buy in. Well, the great thing that I love about the note investing business is the fact is that you have servicing companies that do a huge amount of the heavy lifting for you. Think of them as your third party, you know, oh, manager, property manager. Instead of them going out and collecting rent, they're collecting the monthly payment. They're reaching out to borrowers if they stop paying. They're going to handle the paperwork. They're going to hand out the statements. They're going to collect it and adjust the balances. They're going to check your taxes. They're going to check your insurance on that stuff. Okay. So in most states, if your servicer is licensed as a debt collector in that state, it's going to solve things. But some states do require a separate debt collector's license and other fees, like Illinois wants you to be a licensed debt collector separately from your servicing company. All right. Some states like Ohio, they want you to get a separate debt collection license for second liens. Oregon, Washington, Maryland, Massachusetts all require you to have a separate mortgage banker's license or mortgage broker's license to do that stuff. And then Georgia has a required license to get you become a mortgage broker's license in that state of Georgia. Now, the exclusion of that is if you're buying in your own name or you're using your self-directed IRA. That's the exception, but I would not recommend buying in your own name, buying a note. But there are some third parties out there that allow you to partner with them, and we've got some friends that will do that if you're going to be buying in Georgia. Okay. Now, some states do require you to be a licensed mortgage broker, like I talked about California. If you're buying notes in California, they want you to be a licensed mortgage broker there in California. Okay. Like I say, talk to your servicing company. And if you don't know who a servicing company is, we highly encourage you to talk with like Covey Financial out of San Antonio. They're a company that we recommend. But if you're already using a different company for your performing notes or owner finance notes, talk with the servicing company and find out which states they are licensed in and what requirements to make sure that you're not violating anything. Last thing you want to do is buy a note that you can't end up collecting on because the attorney general shuts you down. All right. Now, what is available in today's market? It's 2026. It's not 2008 anymore. The market has changed, right? So, like I said, you can buy reperforming notes. This is what a note that was once non-performing. Somebody like me bought it non-performing, got it back to work, and I'm looking to sell it off and still give somebody a 8 to 12% return on a reperforming note because I bought it at 50, I'll sell it at 80. Non-performing notes are still available. We see, people talk about, oh, there's a low default rate. Yeah, there's a low default rate on new stuff, but there's still plenty of stuff out there from previously that's still non-performing that you can buy. And with defaults increasing and inching their way up back beyond what they were over COVID, we're seeing increased default rates means more opportunity. Contract for deeds you can buy. These are smaller valued assets in a variety of different states. Non-performing commercial notes, we talked about that. You've all seen the news with commercial defaults, foreclosure, stuff like that increasing. You can buy commercial notes that are in default. Um, don't expect to go buy a 200, 300 apartment complex when the borrower's not paying, it's going to foreclosure. Most of the banks are foreclosing on those and taking those back if they can. Okay, they're not looking to sell those at a huge discount. We talk about old notes on platforms like PaperStack and a few others. Yeah, you'll see some stuff that's been floating around for a while. You can buy that. It's a great way to get started, but I don't encourage it as a long-term viable option to be a note investor beyond one or two notes at a time. Okay. And you can also buy newly originated owner finance notes. If you want to chase that, go right ahead. I'm not going to waste my time doing that. We get people that call me all the time. Oh, hey, would you buy this note? It's got 1 month of payment. I'm like, no, I want 12 months of seasoning. I'll buy it, but I'm going to ask for a big discount. I'm not going to pay par or full value for a newly originated note. It just does not happen. Okay. And one thing, as a note investor, this is one of the hardest things that a lot of people struggle with is the banker's mindset versus a fix and flip mindset. I struggled with this my first 2 years coming in the note business. When I would buy, everything I bought was non-performing and I was foreclosed on everything because that's where I came from, right? Oh, deadbeat borrower, just needed to foreclose on. Well, I should have had more of a banker's mindset because I realized looking back in hindsight's always 2020, as they say. If I look back and was willing to work it out with the homeowners on those notes, a lot of them I would have made more cash flow. And that's the thing you got to realize. When you're buying a note, you're not buying the property. You are buying the note. You're the lender. Okay. A lot of people get into this. Oh, look at all this equity. Well, you're not. Equity doesn't exist to you as a note holder. You're only entitled to the legal balance, the payoff amount of the loan. Now, of course, if he takes the foreclosure and nobody bids at the auction, guess what? Then you own the whole property. You can offer cash for keys to borrowers to avoid it going to foreclosure. We've done that before in some cases, but you have to understand if you're evaluating a property, it's all about as is. There is no after repair value in the note business, okay? And that's why we always say you want to streamline your products is what you focus on. I like to buy non-performing notes where they owe more on the property than what it's worth, because then I kind of control my equity by buying it at a discount, right? Or I'm going to target owner occupied assets where there's less than 20% equity, the borrowers won't fight you for that. Okay. You want to avoid the shiny objects and, as I say, the squirrel syndrome by chasing all these different things. The more narrowed your buy box can be, the happier you'll be, the more awesome that your profit margins will be. Okay. Cash flow should be your number one priority. If I'm buying this note and it's occupied, what kind of yield can I get keeping the borrower back in that property? Now, of course, is every borrower going to reperform? No. We still foreclose about 20, 30% of the time on stuff. Of course, if the borrower's already left the house and moved on or passed away, you know you're going to foreclose. But when it comes to cash flow, you're all about building notes, and that should be your number one priority. Taking back real estate and doing fix and flips are going to be your secondary market. And then, of course, if you take a property back, if you want to owner finance it or keep it as rental, that's your choice. I'm a big believer in selling that asset off, bringing my money back in, and then go out and rinse and repeat and doing other things. Okay. So let's dive into session 3 here on the different types of note sellers available in today's market. Well, there's a ton of places to find note sellers. Most people won't do this, but if you learn how to market like we teach, you will find plenty of deal flow. Plenty of deal flow in today's market. All right, you can go to banks, which is one of our favorites. You can go to lending institutions, mortgage bankers, servicing companies, note conferences and conventions. LinkedIn is where we spend a lot of our time. All right, private sellers, county clerks to track assignment claims of when a note is sold. You can track to who's bought it and who sold it. You can also go to foreclosure lists and target either the bank, which is the lender, or the attorney and try to buy the note through them. And we do a very big deep dive. It's our whole first part of our class on Note Buying for Dummies is how to find deals. And to give you a bit of an idea, there are 5,000 federally chartered banks out there, and there's just under 20,000 lending institutions originating loans, mortgage bankers, mortgage companies, a whole bunch, okay? There's also hundreds and hundreds of servicing companies servicing loans for investors like you and me. Those 4 places right there is plenty of inventory if you will learn how to market. Unfortunately, most people are going into these Facebook groups, which are just private sellers and one-off sellers. Just does not make sense. You have to understand marketing is important. Going to note conferences and conventions is great, but there's often not a lot of sellers there. There's a lot of note investors there talking about it, And that's why I don't really go to any note conferences anymore because there's no reason to go. I know most people there. Everybody's looking for deals. Well, instead of you going there and looking from people who are looking for deals, why don't you actually go to the source directly? And that's what we've really hung our hat on and shown you how to really get deals direct from banks and hedge funds. Okay. Um, if you're going to target banks, there are a few different department names you want to focus on. One is a special assets department. That's going to be your largest institutions. No, you're not going to buy from Chase, Citi, Wells Fargo, Bank of America, but there's other larger banks out there that they call their department the special assets manager, the special assets department who handles note sales. There's also secondary marketing departments. You'll see this for banks, REITs, real estate investment trusts, stuff like that, lending institutions who have bought portfolios. That's a great job title to look at on LinkedIn. Whole loan sales departments. You'll see this REITs and larger insurance companies or funds will have whole loan sales department where they're moving whole portfolios off or letting you cherry pick. Smaller banks, smaller region banks will call their department the chief credit risk officer. It may even be the loan officer that originated the note if it's a small one-off bank in rural America. Not saying you can buy anything at a big discount there because they're too conservative. They can't take a big 20, 30% loss on the loan, but there's still opportunities. From time to time, we'll get stuff from D, but we really primarily focus on A, B, C, or D. All right, for you. There are some websites that help you find notes. You can go to landguide.com, which has been for over 50 years in targeting what banks are sold to what banks. They often publicize different internal numbers and emails of asset managers. It's like $165 a year. We've used that for years. Bauer Financial tracks FDIC banks and then also credit unions who submit their quarterly reports to get their FDIC insurance. We will often once a quarter buy a list of them of banks that have more than 5 branches, and it gives us their whole financial breakdown, how far upside down they are, what percentage of the portfolios in default, what's coming down the pipeline the next quarter is 30 to 89 days late, residential, commercial stats, multifamily stats. It's really a great resource. That's about $300 to $400 a quarter, right? FDIC.gov is free. You can go there to see which banks are in trouble, what banks have gone out of business. The Texas Savings and Mortgage Lending here in Texas. We leverage the licensing department in Texas and a few other states to download the list of licensed mortgage bankers, licensed servicing companies doing business here in the state of Texas. And it gives us a contact list to reach out to those companies individually. And then, of course, like I said, loan servicing companies, you can go to the National Mortgage Loan Originator, NMLS.gov, and do a search on there by just typing in servicing. It'll pull up hundreds of servicing companies. Some of these servicing companies have a trade desk or have somebody that's handling the trading of notes on behalf of their clients. Okay. And then, of course, other state license websites. Some will vary. Some are easy to get a hold of. Some are. Don't ask me specific questions about your individual state. Just go check it out yourself. Go look for the Florida mortgage lending or mortgage lending licensing department, something like that. Now, what do you say? What don't you say when you're contacting these banks or lenders online? Well, the biggest thing is it's important knowing what not to say more so than what to say. Okay. The idea is if you're going to reach out to your bank asset managers, you're going to have a basic elevator script. And we've actually provided this pitch in our workshops. And it comes down to asking the major question. Hey, are you the right person? And what do you have on your books that you're looking to move? Okay. I'm looking to buy for my own portfolio. I'm looking for something with some hair on it, especially if you like the non-performing side. We're looking to work it out with the homeowners if they ask what you're going to do with it. Always say that, even if you're planning on foreclosing. They like to hear that. Indeed, we're looking for non-performing notes in these markets or states. Now, I don't get specific to one city or one market. Okay. I say we're buying in most of the major markets across the country. We buy in about 20 to 30 states. My whole goal is to get the lender or the special asset manager of the bank to send me the list of what they have all across the country or across the state. So the more specific, like I only buy in Austin, Texas, that's a big okay. You don't want to do that. All right. You want to say we're buying in multiple markets. I'd love to see what you have. Now you're also not going to go say, oh, we buy anything. No, you don't buy anything. Okay. That tells me you don't buy. I mean, when you say you buy everything, it tells me you don't buy anything. Okay. We buy, assets that are 100 to a million in value that are non-performing in most of the major markets across the country. That's kind of a normal common thing. Okay. Let's see what we got. Now, do not say these items. Don't come and say, hey, I have 20 million a month to buy. They're not going to believe you. That screams out joker broker. I'm looking for notes and REOs. Nope. If you're contacting a bank and that's what you say, I'm looking for notes and REOs, they're just going to forward you to the REO department, which is just a voicemail box that tells you to call the listing agent on the website. Okay. I'm looking to broker or wholesale. I don't care if you are looking to broker or wholesale. Don't tell the bank that. Okay, they don't need brokers. They don't need wholesalers. All right. Don't say that. They don't waste your time. Okay. Don't say I represent a buyer or I'm a buyer's rep or a buyer's mandate or a seller's rep. That just sounds like a big joker broker, and I want to vomit in my mouth anytime I hear that from somebody. Okay. And like I said, I'm looking for anything. No, just be specific. Hey, I'm looking for first liens that are non-performing, with values 100 grand plus, and go from there. That's a really great thing to say. But the rest of the stuff, I'm looking for this one zip code in Austin, Texas. No, don't do that. Don't waste your time. Go do something else. Okay. You want to make it easy for them to hit the download button to send you the spreadsheet or the tape, as we call it. Okay. Now, if you're gonna build a list of emails and you find contact information off licensing websites or off of their LinkedIn profile, emailing is the easiest thing for you guys to do, and you can create a list and upload it to a CRM and drip mark it out to them once a month, which is one of the great things you do. You want to make sure that your email goes out on a Tuesday, Wednesday, or Thursday. All right, not Monday or Friday, between 10 a.m. and 3 p.m. their time zone. Okay. Well, Scott, I worked, Tuesday, Wednesday, Thursday between 9 a.m. and 5 p.m. How am I going to email it? You're going to use a CRM tool like REI Blackbook or, God forbid, MailChimp or something like that. Easy, okay? The first email you send out, you're going to see a 10 to 20% open rate. After that, the second time, yes, send the same email a second time to those that didn't open the first time around. That's a 5 to 8% open rate. And you want to even send it a third time later, about 24 hours later, at 1 to 4% open rate on that third email. So I send it on a Tuesday, second one goes out on a Thursday. Third email goes out on a Tuesday. Okay. Um, you want to give it yourself at least 48 hours or 2 business days apart at the opposite times of the day. So if you send it at 11 a.m. in the morning, on the first one, send the second one in the afternoon. All right. And that's the whole goal, is rinse and repeating. I've been doing this rinse and repeat thing for a decade, ladies and gentlemen. I have asset managers that send me stuff on a regular basis that get my emails and call them the green email, right? They reach out to me, hey, I don't have anything this month. But when they do have something, guess what? They think about me. And you guys can replicate this. It's not hard to do. All right. Very simple, no longer than an email. It's 20 lines of text and directly to the point of what you're looking for. Okay. Now, if you want to take that next step and really do reach out to asset managers, it's easier to do these days than it used to be 10, 15 years ago. All right. The best time to call asset managers are Tuesday, Wednesday, Thursday, same time, 10 and noon, and 2 and 5 their own time. Understanding what time zone they're in is important. Who you calling, when you're calling. You're not going to call the customer service number. You're not going to call loss mitigation, because they're just not going to know. You're going to have to call the main corporate office. We use Lane Guide to find the main corporate office numbers on most of these institutions. Okay. And expect to leave a lot of messages in voicemail boxes. Always, always leave a message. Hey, this is Scott Carson. I'm calling. I think you're the right person, James Smith, who handles your note sales. I'd love to talk to you about it. Expect to leave a lot of messages. If it's, a lot of these bankers will have their phones forward to their cell phone if they're out. If you get a cell phone number or something like that, hey, shoot a text message. It's not going to hurt anything. Pay attention. Speak clearly, slowly. Have your elevator speech and repeat. And like I said, leave your phone number twice. Okay. You're going to leave a lot of message. If you make 50 phone calls, very important, smile while you dial. If you're in a bad mood, don't make phone calls. But if you make 50 phone calls, you'll probably talk to about 14 to 16 people. You'll probably sign 4 NDAs off of that, and you'll probably get a deal or a tape with either one deal or 1,000 notes. Who knows what's on that list? But one source who sends you stuff on one day is very valuable. When I first started this, I wanted to challenge myself years ago to having signed 100 NDAs. Well, at the end of the first month, I was like, I need to expand that to having 1,000 NDAs at the end of the first year. And we achieved that. Okay. Now, like I said, you have to learn to follow up. This is where most people drop the ball. Follow up and follow up and follow up. Asset managers are not going to get mad that you follow up. If they tell you, hey, I'll have a list next month, and you call them next month and you leave a message and they didn't send you anything, guess what? Follow up. Make a phone call again. Drop them another email. Send an email. Make a phone call. Jump on LinkedIn and track them down on LinkedIn. Hey, just wanted to reach out to you. You can use things like Rocket Reach or Sales Navigator or even AI to find the right email and phone number for a lot of these asset managers. And the whole idea is just to repeat, repeat, repeat. The thing you have to realize is most of you out there come from the real estate space where you're sending out letters and postcards as stressed assets and foreclosure list each month. What if you never had to do that again? What if you just dropped an email blast out to people and they sent you their list on a regular basis? This is what we do, ladies and gentlemen. We don't rely on people to send us just one thing or one source. We deal with multiple sources. A lot of note investors back in 2008, 9, and 10, they got used to buying from two or three sources, and that was it. But when those sources went out of business or pivoted to something else, they didn't have any note deals. And this is one of the things that we always talk about. It's the follow-up. It's so important. You always got to be creating new lead generation because people will come in this business. Funds will create and come into this business. We also follow up on deals that we make offers on 30 days out because we close on a lot of deals where our initial bid was not accepted. Okay. You have to realize that 80% of sales are made after the fifth contact. So keep that in mind. Five contacts. I've got to send at least five contacts to get the ball rocking and rolling to be in the game. That's what it comes down to. All right. If you don't understand that with email marketing or social media marketing as well, go do something else. Save you a lot of grief because you're just going to get upset. I sent one email, I made 12 phone calls, and nobody said anything. Well, guess what? You barely touched the tip. Okay. Make separate lists of who you actually talk to when you're making these follow-up phone calls or the original phone calls, and that becomes your hot list. I start off with 50 banks a day. If I got through 35 of them and left messages, then the first part of the second day was making the 15 phone calls to those I didn't get to. And then 2 days later, I would hit those 35. Hey, just wanted to follow back up, or the week later. Okay. Now, we spend a huge amount of time in our virtual note investing workshop. We call it No Buying for Dummies. It's a 2-day course that we teach about once a quarter, live with me via Zoom. It's an all-day thing on Saturday and Sunday for you to dive into. It's really the number one class that our students have taken to learn, where we show you how to find, fund, flip, and flow. All right, very affordable for you, and definitely should be something you get signed up for. Now, of course, if hey, the 297 is a little steep for you, or you want to try something a little cheaper, you can always go to our monthly membership. It's at $97 a month. Includes access to our virtual workshop and some other trainings for you. It's designed to help you spread your training costs out over the year and stay up to date with things. So it's just $97 a month, and you can get signed up for that at noteumbrella.com. All right. Now, let's dive into the different markets and pricing points of notes. Okay. Now, let's talk about market expectations because markets are always constantly changing. Some states are getting easier to buy in, others are getting more difficult. Okay. They completely vary based on a variety of things. Either the popularity of a market, like I said before, Miami, Florida is a lot more excitable than buying something in Miami, Ohio. Market values, obviously. Things in Los Angeles will be a little bit more valuable than, say, something out in Dayton, Ohio. The foreclosure timeframes will vary. Texas, everybody loves Texas because it's the fastest state to foreclose in versus like New York, which can take 3 years. And then, of course, you want to look at where the population is. You know, a lot of people will look at small balance notes. They go, oh, I'll buy something in a small market. Well, I always recommend staying in cities that have at least 50,000 people or greater. The reason when you start getting into the small markets like 3,000, 5,000, you have less realtors, less buyers, less vendors to help you out with that stuff. Now, I'll buy in a small market if I have carnal knowledge. Like I'll buy in South Texas, down in Ingleside or Aransas Pass or Port Aransas, which is by Corpus Christi. It's only about 30 minutes outside of Corpus, but I grew up in that neck of the woods. I have resources and I know the market like the back of my hand. Okay. And like I said, more about the location. Avoid rural assets. When you start looking at assets and it's out in the middle of nowhere, avoid it. Unless you know that market or you're targeting like raw land or stuff in an area like that, just avoid it till you get your feet rocking and rolling. All right. Till you get your business rocking and rolling because you don't want to buy a note and it drag out. We had some students who thought they were smart. They were going to buy this portfolio of these low balance, low valued REOs that were all rural with the idea they're going to owner finance them. Well, guess what happened? Even though they were offering great terms in the owner finance note, nobody wanted it. Okay. You got stick to the pool. I'm not here to try to lead you astray, but when I've done this for 20 years, I don't want you to make mistakes that are going to cost you. All right. And that's the biggest thing. Let's avoid making mistakes and making profits. Okay. Been there, done that, got the scars and the t-shirt. You don't have to go through the same thing that I have. All right. And of course, inventory. You may want one specific market, but there's not any inventory. You got to change your market up. Like I said beforehand, I live in Austin, Texas. And yes, we are seeing more increased stuff here in Central Texas, but when I first started, there wasn't hardly anything here. So I had to look outside of my market, outside of Austin, outside of Texas, and that's why we've bought thousands of deals outside of the Lone Star State. No, I didn't have to jump on a plane to go look at it. We use vendors, and we'll get that later on to help you that. But that's the great thing about market expect. Now, what's hot in today's market? Today's being 2026. The most expensive note markets haven't really changed much. That's California, way overpriced. Well, although we are seeing a few more notes in California than beforehand. Arizona, a lot of distress there because a lot of investors bought in Arizona, and Phoenix and that woods it's taking a big hit. Texas is always hot here. We are seeing more distress in Texas, Dallas, San Antonio, the Valley, and Waco and stuff like that. So it's more opportunities. But people love buying in the Lone Star State. It's the friendliest state to lend and foreclose in. Nevada, Sin City, Reno, we are seeing more distress there. People like those areas. Sin City, who doesn't like Sin City? And then, of course, you have like Georgia. People love Georgia because it's a fast foreclosure state, second to Texas. But you got to be careful about buying in Georgia. If you're going to buy outside of your own name, use an SDRA. If you're not going to use that and you want to use an LC, you really need to partner up with somebody so you don't get tagged by the Attorney General. You don't want cease and desist and fines, right? And of course, people want to buy on the West Coast. I would say the populated for Oregon, Washington State has dropped off because of the licensing requirements and how unfriendly they are to landlords. The communist side of those two states just doesn't make it friendly for real estate investors. By West Coast, you could also throw in like Colorado, Utah, Idaho. Those are very popular states as well too. Some of the bigger markets there with the growth going on, but they're going to be the most expensive as well. All right. Now, what's not so hot? The least favorite markets really hasn't changed this month. New York, don't buy in New York unless you live in New York. And a lot of people call, I want to buy in New York. No, you really don't. Okay. Same thing for New Jersey. New Jersey can take you 2 years to foreclose. The one exception in New Jersey is that it's got a vacant property, which is 6-month expedited foreclosure. So if the property's vacant, you can get away with it faster, but you got to really want to buy there in New Jersey. Kentucky, don't see a lot in Kentucky. They do require a separate bond for a business and personal, depending on how you're buying it. I don't buy in Chicago. Cook County, if you live in Chicago, that's an exception, but if you're an out-of-state investor, don't buy in Cook County. It's just not a very pleasant way to do things. And then also too, what's not is you're trying to buy assets under 30,000. That's hard. I mean, I've bought plenty of those deals over the years, and you can make some good money, but also understand where it's at. All right, a roof, an AC can kill your deal if you've got to replace that or do something that's not friendly. Stick to the 50,000 and above assets, and you'll be a lot happier. Okay. Also, what's not high equity note deals? As I said before, you have some people that chase high equity. Oh, that the house is way worth a whole lot more. You're not going to end up with that asset most of the times. Either sell at the auction or the borrower is going to file bankruptcy and drag it out. Okay, so don't get sucked into that. Now, where is the most inventory we're seeing these days? Of course, we still see a lot in Ohio, Michigan, Indiana. All three of those states are three of my favorite states. Illinois, you see some stuff. I will buy outside of Cook County. Missouri, I've seen more distressed stuff in the bigger markets, St. Louis, Kansas City. Florida, oh my God, Florida is back on the market with a lot of distressed inventory. You just got to be careful what you buy down there. Insurance costs, condo associations, it does not come without its hurdles a little bit. And then we're also seeing a lot more in reverse mortgages where the borrower has passed away. More people are getting older. Obviously, people are getting older, they passed away, but we've seen an increase in reverse mortgages over the year. And we've been buying more vacant reverse mortgages where the only goal with that is to basically you buy it at a discount and foreclose and either A, make money at the foreclosure auction by selling it there, or you take the asset back and then sell it off. Okay. And then we do see a lot of opportunity in small balance commercial real estate. Small balance, sub 5 million, under 2 million. A lot of your banks finance the commercial boom these days in this round versus back, it was all Wall Street back in 2008, 9, and 10. So if you're in an area and you're knowledgeable of that area and you can buy a small balance commercial real estate, small strip mall or something like that, there's opportunity. Small apartment complexes under 100 units, there's that opportunity to buy some of that stuff at a discount. Okay. The pricing models, people always ask me, what are things going for these days? And it varies across the board. Okay. Everything always asks me, what's non-performing notes going for these days, especially when you have negative equity. By negative equity, that's where the borrower's upside down. We'll talk about the stair-step model on the next slide. So just keep that in mind. Negative equity, that means they owe more than the property's worth. Okay, so as an investor, your valuation is not on what's owed, but it's actually on the property value. Now, we'll get that in a second. Now, with performing notes or non-performing notes with equity, Yes, with equity, you're going to have to probably pay 80 to 95% of the unpaid balance or the payoff amount. All right. Sometimes it makes sense, sometimes it doesn't make sense. But if there is equity, you really need to be looking at 80 cents on the dollar. Okay. And by equity, we mean a sizable chunk, usually 20% or more. Okay. Contract for deeds, you know, non-performing contract for deeds, we would used to buy stuff at 30 cents on the dollar of the unpaid balance or the fair market value, whichever is less. Performing, you will still see stuff at 60 to 80% of the fair market value when they owe more. Okay. Now, if they owe less and there's equity, you may have to go up to 80 cents on the dollar, just like anything else, depending on the underlying asset value. Okay. Just keep that in mind. Junior liens, we just don't see great discounts on those. They're overpriced and there's just a current due to lack of inventory. Okay. Like I said, commercial is all going to vary by the cap rates, the asset class, and what's going on with it. So I'm not going to dive into that. But you're going to submit your bids usually as a percentage of the unpaid balance or a percentage of the legal balance. Okay, minus your taxes owed. If there's more than 1 year or more than the current year of taxes owed, deduct that from your bid and say, hey, I would have bid 65,000 on this, but there's 5 grand in back taxes owed for the last 2 years, so my bid's going to be 60 with the back taxes. And double check your taxes before submitting bids. Okay, you can go to the county records and check those all day long at Netra Online and other websites, so you know what's owed before you submit. Okay. Now, when it comes for the negative equity, the stair step model, here's what we talk about. If you're down here at the bottom where it says below 30,000 fair market value, you shouldn't be bidding more than 25%. Okay. So they owe more than the property is worth. So it's the house is only worth 30, they owe 50. Well, I'm only going to offer 25% of the fair market value. And as you climb up that, so this same thing, you're 30 to 40, it's 35%. 40 to 50, it's 45. 50% plus, you probably have to be 55% of the fair market value. You start getting above $60,000 in assets, 65% for a one-off is pretty common. It's not pennies on the dollar. It's not 5 cents on the dollar. You're going to be bidding, under what you would probably pay for an REO most cases. But understand, pricing has gotten a little bit more expensive than over this. And this is just a guide. It's not a hard, fast rule. It's a guide if the seller does not give you type of pricing. Okay. Keep that in mind. And of course, you'll adjust your bids based on what type of yield you're looking for. All right. If it's an occupied asset and the borrower's made a few payments last year, you may only want to bid at 62 cents on the dollar or 60 cents on the dollar to get your yield if they reinstate. It all varies. Okay. Now, people always ask me, well, Scott, why do you like occupied assets versus taking their property back via foreclosure? The reason you want occupied assets is A, it's usually in better shape. Somebody's living in the property and taking care of it. That's the first and foremost. Somebody's kept the power on. The HVAC hasn't turned on and walked off. It's in better condition. More exit strategies. You've got a whole slew of exit strategies that are available for you when it's an occupied asset versus a vacant asset. So more different ways to make money. It's easier to reinstate or work to modify, do a trial payment plan for the borrower. It's easier to do a deed in lieu or cash for keys if it's occupied. And the emotional equity a lot of times can help you keep borrowers in the property versus them moving out and not taking care of the property, moving somewhere else. I like to keep people in their houses, and we're able to do about 65, 70% of the time. Okay. And the number one thing, it's less capital expenditures like the HVAC, the roof, the wire, and the plumbing. Somebody's living inside the property most of the time. It's to be taken care of. We have seen some assets where, they're not taking care of the property, and I wouldn't buy that. Never buy a note you don't want to end up owning. I didn't say live in, but owning. Okay, I've bought plenty of smaller assets that I wouldn't live in myself, but are good little quality assets for somebody else to live in. All right, smaller assets or in areas that I wouldn't live myself, but other people are living there, and that's okay. Right? Now let's dive into the different funding options for you as we get rocking and rolling here. Okay. First part's all been about the finding side. This next session is all about the funding options to you. How do you fund a note deal, right? Well, how do I pay for a note? Well, you're going to use a variety of usually cash wires. When you pay for a note, it's not going to a title company and closing on a loan. You're going to wire cash from your IRA or your checking account into the lender, okay? Sometimes you'll wire into an attorney's account, and that's fine. You can use personal and business lines of credit if you want to use that to pull money off of. That's fine if you've got those. We've also got a good friend, Merrill Chandler, with getfundable.com who helps people do that. All right. We just did an episode with Merrill recently, and I'll show you what the link to that is in just a second. But he helps all of our students out getting lines. If you have a new LLC that's less than 2 years old, you're not going to get a line of credit. Okay. You need a business that's been in for at least 2 years to get a business line of credit, and he'll show you how to do that. He's helped our students get six figures and stuff. So he's also got a boot camp, usually like a 2-day course he hosts from time to time, getfundablebootcamp.com. All right. But a lot of you, if you don't have your own money, you don't have lines of credit, you don't have retirement accounts, you're going to use OPM, other people's money, to fund your deal. Okay. You're not going to go and get a hard money loan to buy a note. They're just not going to do. Now, sometimes hard money lenders will sell notes, but they're not going to give you a line of credit to finance your non-performing note deal. They want to own the property, not the note. So if you have a self-directed IRA, great. That's a great point. Yes, you can use it to buy, whether it's a Roth or traditional IRA, a solo 401k, a SEP IRA, a self-directed HSA, an educational IRA. You can also get a self-directed IRA LLC, which gives you fast access to it. Some of the IRA companies out there, like Inspira, have made it so damn difficult to fund on a note deal because they make it impossible because they just don't seem to understand it. Equity Trust is the biggest company out there, but they all have such high rollover as far as employees. So it can take what should take 7 days to fund, takes 2 weeks, 3 weeks sometimes. So getting a checkbook IRA LLC I think is really one of the smart things. If this is going to be something you're going to do on a regular basis, just because the speed of the transaction can be so much faster in days instead of taking weeks. Okay. And we have a preferred vendor, Safeguard Advisors. They actually create all these self-directed IRA checkbooks. They're with Solero Bank. All right. So it makes it very easy for you to have a debit card or checking account to fund your own transactions with your IRA, completely legal. You can book a phone call with our buddy Nick over there by going to our website, weclosenotes.com, and scrolling down and to see where you open your self-directed IRA LLC. And we did a podcast episode with Nick Sahagan, episode 1041. Golly. It's hard to believe it was 50 plus episodes ago. But anyway, reach out to him or shoot me a message or an email. I'm glad to make an introduction to Nick for you to help you get your IRA LLC together. Okay. Now, there are other ways to fund. You can do collateral assignments. If you've got existing performing notes, you could pledge the collateral, cross-collateralize your collateral for a new note funding. You can pledge the collateral of the performing note. We've done that before. We were buying a note, and we had a funding company come in would fund 85% of the note, but they wanted to hold the collateral file. So once we closed, the collateral file and all the assignment stuff was shipped to them. We couldn't foreclose without them, right? But it gave them collateral to hold that note in case we didn't follow through. Okay. All right. They'll file a UCC1 at the county against the LLC, which is fine. You can also do a co-assignment of interest on the assignment of mortgage, where your investor is also codenamed. So with every type of note, when you buy a note, there's an assignment of mortgage is what's filed at the county. That's what transfers ownership. Okay. And it'll show from ABC Bank to Inverse Asset Fund LLC. Well, if you're going to bring on an investor and they want their name to be somewhere, then you could say, okay, we're going to buy this note from ABC Bank. And it's going to be assigned to 50% interest to Scott Carson LLC and the other 50% interest to, John Holmes Invest LLC, whatever it might be. Okay. If you've got property, you could also have them take a loan out in a junior position against that property to protect their investment. Some people got talking about partials. Oh, I want to do partials. Well, partials are the most overblown strategy out there. Yes, can you do it with small amounts? Yes, you can do it. You can do it from performing notes, but you're not going to buy a partial from a bank. All right. And a lot of the owner finance people don't understand it partial either. They want to sell the whole thing, not the partial thing. So yes, you can do it with a small balance. You can only going to do it from an owner finance note position. You're somebody who's a private seller willing to do that. And one of the great, probably the best strategy for that would be Tom Henderson's strategy, a friend up at Dallas who does the whole thing. I'll give you 10 months for 12 months. If you're going to give 10 months for 12 months of payments, you're going to make a 20% cash and cash return. Pretty simple, pretty easy to do. We're not going to go into that facet. Like I said, partials are the biggest overblown aspect of the note world. Or you can, if somebody's going to bring a chunk to the table, $250,000 or greater, $500,000 or greater, start a new LLC with that investor and go from that route. Right? And or your investor will fund an LLC that you own. Could be something that you're selling off shares of your LLC. Of course, you can go create a fund. You can do a 506B or 506C, all that stuff you want to. Look, the easiest way is just to keep one investor funding one deal. All right. Don't bring in two or three investors to fund one deal. That's pooling money, that's illegal unless those three investors fund an LLC together and you borrow from the LLC. Don't go pooling money. Don't go talking about, I'm going to go put a fund together if you've never raised 50 grand. Okay. 50 grand is really like the starting point. And like like I said earlier, will a bank give me a note loan? No, banks will not lend on notes. Okay. Now, smaller banks may do collateral assignments. I've got a couple friends that are hard money lenders in Houston who have a bank that will give them a collateral assignment of 50% of the balance on their notes. Okay. So if they do a loan for 100 grand, they'll do a collateral assignment to the bank, and the bank will give them another $50,000 to go out and lend on. Okay. Some banks, some of your commercial banks, will do joint ventures or reassign the note where they will finance the purchase of that non-performing note, usually on $1 million portfolio or $1 million asset or greater. They'll give you up to 80% and carry the financing, and you just got to bring 10, 20% down. Okay. Um, so Novice Bank will do this on their loan sale agreement if you're looking to partner. Like I said, it's usually got to be a million plus loans. We've had people do it on a portfolio of residential loans before they bought from a bank. But usually they're going to want to see team and experience of that, or having, and your team can be your attorneys. It can be your servicing company. It can be your experience. Okay. Just understand it. You're usually going to have to raise capital to go do that. And like I say, it may require a percentage of the down payment, 5, 10, 20%. 20% is about normal we see when a bank is going to carry financing in some sort of fashion. Okay. What about hard money lenders? Hard money lenders will not lend on notes, as I mentioned before. They want to own on the deed. They like short-term loan deals, 6 to 12 months. Remember, they're making points and spread between what they're borrowing their own money at 8% and lending at 12 to 14. They don't want to be into a 20-year note for 5 years. Okay. Like I said, they like to control the asset and can foreclose with deed of trust state. They want to make their money on the points and the churn if they can flip that money every 6 months and make another 2 to 3 points, that's what they're making. Now they may have notes for sale, but most hard money lenders I find will not sell at a discount. They want to sell it at par. All right. And I'm not going to waste my time at par. Now, some of these notes will be at 12%. If great, if par, if you want to make 12% on 6 to 12 months, by all means, go buy those. All right. Go buy them. I don't have a problem with that at all, but they're just going to be shorter term loans and rinse and churn and burn. You're not going to make the points, but you can make the 12% in a lot of cases. They may still want to retain servicing on that as they're doing the workouts or managing a project. And I would highly encourage that, but make sure you get to know the hard money lender, make sure they're not in trouble. Okay. Now, when you're funding on a note, do we just fund the purchase, or do we add other things to the funding amount? And yes, you want to add other things to the things. If it's got a couple of years of property taxes, yes, put at least the last couple of years of property taxes on there as well. You're going to review your values and from a BPO, broker price opinion, or a qualified realtor's comparative market analysis. And so you may want to throw on there as well. Always, 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 always put eyes on an asset before closing on the deal. It doesn't have to be you flying out to take a look at it, but make sure you send a realtor or somebody you trust to drive by the asset and confirm what condition the asset is in. Now, you're not going to get interior access unless it's listed for sale or short sale, stuff like that. But most of the time, especially if it's occupied, you're not getting interior access. You can tell a lot about exterior condition. Does it have toys in the front yard? Is there some pride of ownership? All that stuff. Okay. You want to budget in your foreclosure, taxes, work out servicing costs. So one of the things that we do is we'll say, okay, if it's a non-judicial state, we'll add 2,500 to 4,000 in that extra funding amount, so we don't have to go back to the investor. If we don't use it, great. We end up paying it back anyway, and it's tax-free money for us. If it is going to need some work out, some repair costs, clean out, paint and carpet, understand what that is. Talk to a crew. Talk to CertaPro painters is who we use. Hey, what do you charge roughly for an 1,800 square foot house? Give me a ballpark. Okay. What's a roof going to cost me in there things? Okay. You're going to add forced place insurance in case the insurance is not being paid. And that can cost you quite a bit in Florida or other Gulf states. So make sure you understand what insurance costs are. There may often be utility, HOA, code enforcement liens that don't go away. So that's going to be something that comes out of after the deal. Some of those liens get wiped out in some states, others don't. Some others follow. So keep that in mind. Okay. And you may want to add $500 to $1,000 in marketing costs or an asset management fee, because it does cost to be a note investor with due diligence paid on properties that you don't end up closing on, or your CRM or other website stuff. So add a little bit extra over time. That extra comes in handy when you're buying multiple assets where maybe you under figured out, you got a foreclosure dragging on longer than expected in some states. Okay. Um, but the cardinal rule we like to put is staying below 65% of as is fair market value when funding. We don't want to go above 70% usually. We want to say the 60, especially non-performing. Performing, okay, we'll go a little bit higher because it's performing. But when it comes to the non-performing side, which is what we focus on most of the time, that's where we want to stay at below that 70%, especially 65%. Okay. There are 5 things that are going to be protecting your investment or your investor's investment. That's things to keep in mind. First and foremost, that we're buying only first liens. We're in the most secure position besides taxes. Taxes can wipe it out, but we're going to pay the taxes. All right. We're going to be buying below 70% of as is value. We're going to be using servicing companies and attorneys to collect and foreclose. They're going to do all the heavy lifting. It's not me having to go knock on door and collect. 4, we're going to put property insurance. Forced place insurance is what FPI stands for, either through a servicer or our own. In case of an act of God or something happens, disgruntled borrower, that's fine. Go pour concrete down the drain. It doesn't happen very often, but guess what? If you do, I'm going to get paid an insurance claim. And 5, we're going to check title and collateral files to make sure we have all the T's crossed and the I's dotted so we have the right to foreclose and all the clean paperwork available needed to it. Okay. Now, we did a podcast episode with our buddy Merrill Chandler. It was episode 1088 on the different lines of credit that he creates and stuff like that. Or not he creates, but he's able to get for clients. So check it out, episode 1088 on the Note Closure Show podcast. Okay. And he's as we say, our credit Neo, our credit Morpheus. He's a big fan of the Matrix movies. So he'll help you take the red pill to see the true world of financing and bank financing, all that stuff's going on with FICO and your credit scores. And it's just not all about your credit scores, everybody. Okay. But he will show you how to secure 6 figures in lines of credit for your business. Okay. Session 7. Let's talk about how you find investors as we kind of hit the halfway point here, just beyond it. One of my favorite parts of this is when I talk about this, people's eyes just light up. That light bulb goes off in their brain on how to find investors, because this is always one of the biggest questions. How do you find notes? And then how do you find investors? Okay. Now, finding investors to fund your deals. How do you do that? Well, first thing that most places people go to is like real estate investment clubs, meetup groups. That's a great spot to go, but it's full of sharks. It's full of real estate investors who may have money, but they want to make 12, 13, 15% of those. They may not actually want to make a 6 to 8% return, but you know what? It's still good to go join. One of the most important things to do is go network with other investors. Hey, LinkedIn. Yes, you can find investors on LinkedIn. Type in private investors or SDIRA investors on there. Different keywords. There's different LinkedIn groups, profiles if you search on there. I found private capital on LinkedIn quite a bit. You can go to Connected Investor, that website, privateinvestor.com. You can go to Bigger Pockets and look for investors on there. Keywords, do a keyword search on there and then send them a short 10-minute pitch deck video to help them find an opportunity with you. And so many people will go on these different websites, say, hey, I got 50K to invest or I got 100K to invest. Use those as your keywords and you'll be surprised. Okay. You can also go to self-directed trustee events. Like there's a lot of these companies that have educational, their own meetup groups. A lot of it's online, but some of it's in person. That's a good thing to go to. I prefer to find investors who have pulled the trigger before via the public records. And this has been the gold mine of us creating a river of private capital, not only for ourselves, but our students out there who are doing the same thing. Okay. Now, we use a website called netraonline.com. This is a free website that kind of brings all the states, all the county records, all the recorders, the GSI mapping, all those websites together in one spot. If you go to Netra Online, you'll see a map. You click on the state, you pick the county, and you'll see a listing of every county in the country of how to tack into the county clerk or the county appraisal websites. Okay. And we love it. It's free. We jump on the appraisal districts. Okay. And we do a search also at the county clerk or recorders. But if you do the county appraisal districts, you'll see everybody with a quick search of who has used their self-directed IRA to buy a piece of property by just searching for like equity trust, as the owner's name. Now, some states don't allow you to search by owner's name, so it's a little difficult. You got to go to the county clerk or recorders. Same thing. If you go to the county clerk or recorders and search for the last 2 years, say equity trust. as a deed search. You'll see everybody who's lent money out of their IRA to potential investors. Okay. This is worth its weight in gold. And some of these counties will literally allow you to do a download dump where it's in a literally a spreadsheet you can do a mail merge from, and then you send a letter postcard out to these investors. That's what we've been done for years. Okay. So, one of the great things that we do with our class is show you exactly step by step how to do this. Okay. Appraisal list is very easy. Just search the different names of the IRA companies, property owner. We used to search Equity Trust, Quest Trust. It's now Inspira. Those are the two biggest ones here in Texas. And so we search this and we'll find hundreds of IRA investors. We'll also find their mailing address. And we can send, if they've got their name on there, the account holder's name, great. If it does have that, we can search to see if they own other real estate in the area. If they don't own other real estate, we'll just mail a postcard, a letter campaign. But if we do get their names, we'll skip trace them. We contact them on social media. We'll find any other properties they have and reach out to them directly, and be able to save money instead of mailing out postcard and stamps and letters. We can do it digitally through our CRM. Okay. We can also, like I said, we got a skip tracing company that we leverage when we download a list of the stuff that we'll skip trace through them to find all sorts of stuff, and then search on Google white pages for more information. Okay. If can't find a name, can't find an email or another address, we'll mail the postcard to the mail address based on the county records. And it's usually a multiple touch approach. It's a letter one time, it's a postcard second time, another letter. And the whole idea is just to get them to reach out to us. And we'll send them to our pitch deck video of 10 minutes. We'll send a couple case studies. It's all about that 80% of sales comes after the fifth contact. Now, the county clerk is important. If you're in a state like Minnesota, California, Maryland, Virginia, that don't allow you to search at the appraisal districts by name, you'll do a deed search at the county recorder's office or the county clerk. Same thing. You're going to type in the name of the IRA company. It's going to give you a list of people on the deed search or release of lien. That's awesome. Hopefully it gives you the mailing address on there for the release stuff. That's valuable. And then you go skip trace that. The great thing about this, the clerk, though, is it's going to show you how much money the borrower actually lent on it. And so that gives you, say, hey, somebody just got 50 grand back or 100 grand back. And it's the same thing. Mail a letter, postcard, and contact on social media, and rinse and repeat it. Okay. And we did episode 1030 of our podcast recently. How do you find private investors in your county? So I encourage you to go check that out on the Note Closer Show podcast, wherever you listen to podcasts. It's also on our YouTube channel where we break it down and kind of go through it as well, too, on weclosenotes.tv. Right. Now, you can also, if you don't want to do the whole I'm going to pull list or hire a VA, you can purchase custom lists of IRA owners, not specific to a true self-directed IRA custodian like Equity Trust or anything. It's going to be any type of IRA company or bank. You can actually buy a list where they've got the list provider can guarantee that they've got 150K or more, and you can narrow it down by cities or counties and stuff like that, states. You can also purchase a list of employees with a company. There's some employees with companies that are making good money. Halliburton, Boeing, some of those things. Okay. This list will include names, addresses, emails, phone numbers. It's a really kind of cool thing to do. Melissa data, exact data, especially if you're buying in a state or investing in a state that doesn't give you that free search. You're going to have to pay about $1,000 for a list. It's going to be 6 to 14 cents a lead. If it's a business list, it's going to be 25 cents per lead. But that's a lot of people on the residential side, 16,000 names and emails. So it's going to be difficult for you to implement that if you don't have marketing in place. So yes, a letter campaign, an email campaign is great. Even uploading that list to social media, see who has a social media profile, and then market that list. Or some things you can do out there. Now, where can you post? You should be also, this is an important thing, besides just targeting people on social media and stuff like that, you should also be posting about your deals. Okay? Don't post, we'll buy your note. No, that's a big joke. Okay? Post deals from past experience. If you've bought a note, talk about what you paid for the note. Post deals from others, case studies. It's one of the things that we share in our 2-day workshop, is different case studies. We give our coaching students different case studies to post. Post deals that you're working on. Post past deals, all right? But you never want to mention safe or guaranteed in your postings about the deals. Talk about, hey, we made this type of percentage, or our private investors making 10% on this deal. Those are great words to say. We talk a lot about posting and creating a short pitch deck video. That's very important to do in today's world. because it's your advertising. It's a commercial about what you're doing and what people can learn more about you. Okay, and your pitch decks can include about you, your focus, your company, your vendors, and the types of deals that you're looking to do or past deals. Okay, qualifying investors. Not everybody's going to be a good investor. The thing I always like to ask: are they currently investing in real estate, or have they invested in real estate in the bags? Are they accredited or sophisticated? Okay, how much are they looking to put to work? Okay, how much are they looking to invest? That's important. That's the number one question you got to have answered at your first phone call. Not the first question you ask. But you got to know moving forward, is somebody going to have 50 grand to put to work or just 5 grand? Okay. How long are they comfortable tying their deal up for 2 to 3 years? Not 30 years, but 2 to 3 years. That's still short term. And are they looking for an active return or a passive return? If they want 15%, that's active. Let them go do it themselves. 8 to 12, we can usually give that on a passive, depending on a case by case study. Okay. And I think, what kind of returns are they looking for? Same thing. Like I said, sometimes it wants 20%. That's too expensive. I can't do that. I'm not going to give you deals on that are like 30%. I'm going to do those deals myself. All right. But if you want to make money on passive basis, I can give you 8 to 12%, especially if you're not making anything in your money the last 12 months. Okay. And we use an investor questionnaire. It's required for our investors to fill it out. We go through that in our workshop and provide a sample copy of that for you. Okay. Now, there are investors that you want to avoid. People with unfamiliar real estate that don't have a clue about what investing in real estate is. People that want short-term or higher ROIs, all tied up for 3 months. Well, I'm sorry, that's just too short a deal. I want 25% of my money. Well, okay, go do that yourself. I usually like to have folks invest at least 50 grand or more when you're starting off. You're going to have friends and families. Okay, 25 grand, but understand, don't take their last 5, 10, 15 grand because they're going to be a big pain in the ass. And look, you're interviewing these folks just as much as they're talking with you. If you see them talking bad about politics or bad about other investors or other deals, avoid them. Okay. One of the questions always asked: are you involved in any type of suit? If somebody's sue happy, avoid them. You want to try to. There's things that's going to happen along the way. You want to try to be as cordial and work things out, especially like through arbitration or stuff like that in your agreements. But always ask for references: past partner, CPA, attorney, banker. You ask for references just as much as they ask for references as well. Okay. Always require your investors to fill out your investment profile or questionnaire. Don't post it online. Oh, hey, go to my website and fill that. No. They're not going to fill that out. Okay. Send your pledge letter or an email saying, hey, here's my proof of funds with 100 grand put towards note deals with you. If they won't return these 3 items, they're not going to fund. And you need these in case they do flake, that you can show your seller, hey, I did have money raised and this investor flaked on me, because it will happen. Okay. Now, if they're going to be pulling their money from Chase or equity, from a non-equity trust client or something like that, you need to have them open an account with somebody so they can transfer that 401k or that IRA over into a true self-directed custodian so that they can invest it in notes in real estate. Okay. And it's going to take at least 3 business days for them to sell out of it. If it's in a fund or if it's in a stock, it's going to take at least 3 days to sell out of that into cash before they can wire it to the new account. So keep that in mind. You're going to need that week to get it set up and the transfer to take place at a minimum. Okay. Now, this is important. Always have your paperwork and agreements created by an attorney. All right. Always allow the CPA or attorney's review. I don't have a problem them reviewing it. I just want to make one thing. Have they bought debts before? Have they invested in real estate? If they haven't done those things and they get all, oh, it sounds so risky, I'm going to kibosh it right off the bat. Like, well, would you go to your brain surgeon for dental advice? No, you wouldn't. Okay. Always use agreements that outlines when things go wrong, especially with family and friends. Most investors aren't going out and making above 6%. Okay. That's why you ask them what they have invested in. If they're in like CDs, stocks, bonds, making 5, 6%, okay, good for you. I can give you double that. Would that be interesting? Okay. If their money is making 0, sitting in an account, not doing anything, 6% is an above average return for them. And that's what we offer, above average returns. I don't go and say, we'll offer you 12% right off the bat. Why? When they couldn't make that themselves. Okay. Now, somebody's an active investor, 12% pretty desirable. But I always like to see where's the money coming from and where it's been sitting at. If it's been sitting vacant for 2 years, 3 years, I'll give you 8%, okay, or less. You're going to want to make sure that there's people are paid on a regular basis and communication. How do you make payments on a non-performing note? Well, I don't make payments to my investors on non-performing notes unless the borrower starts paying. Okay, when they start paying, then it's not a monthly payment. It's a quarterly payment or annual payment. I don't do monthly. Okay. Most people using self-directed IRA money, unless they're retirement age, they don't need that money. They're not living off it. So, and all that money's going to go back direct in the IRA account. So quarterly is great, or once we foreclose. Okay. You can set up an online portal for tracking help. You can use Podio, Pipedrive. I'm very simple using Basecamp. Some people use Dropbox, whatever, Slack. There's a whole variety of different things you can use. Google Sheets for tracking, but never, ever, ever pool money together. One investor per asset. One of the most important things you can do. Okay. And trust your instincts. If you've got a bad feeling about somebody, don't do the deal. Move on. Your gut will protect you in cases like that. All right. Let's dive into some of the different marketing tactics when it comes to marketing for notes. Okay. This is one of my favorite places to be because there's so many things you can do with the marketing side that we teach that others don't. And that's the one thing about taking our 3-day or 2-day class, our 3-day in person or 2-day online class, is you walk out a better marketer. Not many people are teaching the marketing strategies in 2026. Their ways of marketing are from like 1996, which is 30 years old. Okay. So once again, you have to realize 80% of sales are made after the 5th contact. And part of what we teach is the whole multi-touch, multi-post approach to things. You have to expect to post regularly and often, automate it with like buffer.com. It's a great resource for automating posts, news articles, case studies, images. You can automate it and reschedule this stuff or pre-schedule stuff out so you don't have to do it all at the same time. The 3 most important things to use in today's market when it comes to marketing is email CRM, and we use Black Book REI. Damon Ramey's company is our preferred vendor for that. LinkedIn, you can use Octopus CRM to help with the outreach for that, or Buffer to post there regularly. And video marketing, YouTube and short video across not only just YouTube, but also across all your social medias. Okay. Email marketing, like I say, it's the number one ROI still to this day. You're going to make a $44 for every dollar you spend. Okay. And with email, when you send an email blast out, you're going to see a 17 to 20% open rate. Understand that. That's the first time out. That's a pretty good open rate. You're going to have to follow up, but that's the whole point of using a CRM like REI Black Book, is that you can do it and pre-schedule it. Okay. And schedule, like I said, if it's going out to your warm market list, send it out on a Tuesday, Wednesday, Thursday. If it's going out to your asset manager list, you can pre-schedule things out. You should send an email out to your warm contact list, people you've met at conferences, your networking events, your meetup groups, your friends, family, once a week. I like Sunday night. All right. Sunday night at 7 p.m. is when we usually like to send an email out, at least to our warm database about what's going on that week. All right. Who do I talk about? This is the thing that people always ask. Well, Scott, I can't come up with an email once a week. Oh, yes, you can. You can talk about every month has a holiday. Happy Easter. All right. Happy April Fools. Happy St. Patrick's Day. Happy Valentine's Day. Happy New Year's, right? Happy Merry Christmas, Happy Thanksgiving. Happy Halloween. I mean, you go back and forth on every month has a holiday. So that's one email. So, hey, happy Easter, happy Christmas, whatever it might be. Okay. If you have a local group or you're more local, talk about going to your BNI networking thing or your local RIA club meeting, what they're going to talk about tonight. Talk about a personal event. Talk about how you got back from vacation or you came back from a conference. Okay. Don't tell them, hey, we're going to a conference next week. We're going to be out of the house for the next 2 weeks. So rob our house. No, talk about it afterwards. Or share a family event, like your kid graduating from college or high school, or, celebrating your 30 years as a performing note. I mean, 30 years as a married couple, whatever it might be. Okay. But then also talk about past and present deals. The reason most investors fail to raise capital for deals is they're not marketing the deal. And part of sending this email out once a week is to get your audience to start paying attention to what you're doing. And Gary Vaynerchuk, who's probably the best social media mind out there, wrote a book a few years back called Jab, 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 Right Hook. The whole idea is the jab is you're adding value, content to your network, and then that right hook at the end is when you need somebody to fund. Unfortunately, most investors, when they don't do this ahead of time, so when they get around to needing funding, they're like behind the 8 ball. And they send out a panic email like, oh, email marketing doesn't work. Yeah, it doesn't work because you didn't put it to work. Okay. And like I said, your email asset managers is all about drip marketing once to twice a month to that list to get people sent up to you. Okay. And Oh, I think I already posted. Maybe I did already post this one, but we talked about how do you find private investors or anything like this in our county in episode 1030 for you to take a look at. Pretty cool thing about the marketing process that we do in the follow-up side of things. Okay. Now, LinkedIn, very, very easy to use, but you need to have a complete profile. And yes, maybe having a paid version of LinkedIn is going to be worth it for you if you're going to use it. But the things you all should do is get you a free version of LinkedIn. If you don't have a profile on there, guess what? You really don't exist in the note business. Okay. Bankers are going to go to LinkedIn to see you. They're going to track you. They're going to look at your profile. Do you match up? Does your profile make sense? I call it the social media business resume. If you don't have a website, you better have a LinkedIn. All right, yeah, you need to have a website these days, but LinkedIn is the first starting port. And making sure you have a good smiling photo, an image of your of your image of your logo or your company name, and then have your profile filled out all the way. Your about you, your featured stuff. It's easy to find investors and bankers on LinkedIn. Check out Octopus CRM to help maximize connections. We grew our LinkedIn from 6,000 to 30,000 connections over years of using Octopus 5 days a week. Very, very affordable. One of the most powerful tools you can use to grow. Only 3% of LinkedIn users post daily. So think about that. If you can post something, an article, a newsletter, you create your own newsletter or case studies, people will pay attention to you and they'll start to follow you. And you can join and post to the different groups out there as well. It's a great way to connect with other people that are more than like a third-degree connection away by finding groups that they're in and connecting with them. And yes, you can import a list of up to 1,000 emails into LinkedIn, and LinkedIn will go out and find if there's a profile that matches up with that email, and it helps you can kind of prime the proverbial LinkedIn pump to help you start connecting with people. Video marketing is just so important these days, ladies and gentlemen. So much more valuable these days than whatever it was. And you have a phone. If you have a smartphone, guess what? You can use video pretty easily. YouTube, it's the second number 2 search engine owned by the number 1 search engine. Okay. TubeBuddy is something that we use to help us grow with keywords. When you post a video, it's besides more than just a video. It's the title, it's the description. We use TubeBuddy to help us come up with that stuff. You can also use different AI tools for that. But you gotta, if you're not gonna take the time to put a good title or description with it, don't publish it. Keep it private on YouTube until you're ready to publish it. But then make sure you have a description, your keywords and thumbnails. Those are the roadmaps for YouTube to send views to your video. Description, keywords, and thumbnail. Okay. Now you can use like Facebook Live, Facebook Post, TikTok. Most of those have a 24 to 48 hour lifespan, not 28 hours. But it's still good to post on those, especially case studies. LinkedIn Live, or uploading video, long form content, and short content on LinkedIn now works really well to share what's going on with short deals. Short case study videos of 5 minutes or less and have it rinse and repeat. But most of you guys are going to use your smartphone. Very easy to use with selfies to upload to TikTok or upload to Instagram or upload to Threads or Twitter or Facebook using your phone. There's so many great tools, especially TikTok. Record something, it downloads it to your photos, and you can upload that video to everywhere else. And we've used short videos to really expand our business a lot over the last few years. We use a thing called the marketing octagon or content octagon. If you take an image of a property you're walking or a property you're evaluating or a note you're evaluating, sharing that content and that short little video across multiple channels. Like I said, photos and stories do best. We'll use buffer.com from time to time to share across multiple platforms simultaneously, especially if I'm going to be out of town or my VA can log in a buffer and upload things, upload short videos and stuff like that gets reposted again and again. Not everyone is on every platform. I get it. But you got to be on every platform these days, ladies and gentlemen. If you're going to be in this for long term, leverage the free activity, the free audience that you're going to get by being on those things. You never know, because you never know who's going to see your stuff. We've raised capital and closed deals on every platform: LinkedIn, Twitter, Facebook, TikTok, Threads. And for something that's free, use it. Okay. And the more you cross promote, the more hits you're going to see. And somebody sees your thing twice, guess what? Okay, they follow you twice. Whoopee freaking doodah. Now you've hit that 80% of sales made after the 5th contact now faster. Okay. Best time to post is at lunch, 3 p.m., 7 p.m., and 9 p.m. when people are death scrolling in bed at night. Okay. Start with one new platform if you're starting off with, and one new thing each week, and rinse and repeat. Get better at it. Get better at it. It's the only way you're going to do it. We use Restream to repost our longer form videos on a regular basis across all the platforms at once. And we also use Opus Clip to take our longer videos, chop it up into short videos, and post those short videos across every major platform. And it helps us a ton and very, very affordable. Okay. Let's talk about business structures because people are like, oh, well, can I use this? Can I use that? You've talked about funding. You've talked about marketing, raising capital. Let's talk a little about the nitty gritty, the black and white side of note investing. Yes, you've got to have a business entity. And let's talk about how do you structure your dope business. You need to use entities, LLCs. You can use trusts. You can use S corps. Easiest thing for you to do is just an LLC. Okay. Now, people talk about, well, I want to use an LLC in Wyoming or Delaware Statutory Trust or a Nevada LLC. Just use a Nevada LLC. It's going to help you out. Yes, you can create LLCs in your states. Totally agree with that. Okay. But your main operating one, you should probably have it as a Nevada LLC. And don't keep more than $1 million in asset values in a single entity. Okay. If you're going to use, if an individual investor is going to bring 250K to the table or more, create a separate LLC for their deals. All right. Keep your deals and assets separate from your partner's deals, existing business. If you're doing something outside of real estate or outside of notes, have a separate LLC for your note stuff. If you're buying performing notes for yourself, keep those in a separate LLC from the ones that you're buying non-performing. If you end up taking some property back and you keep them as a rental, keep those separate from your note business. You're buying an individual commercial project, put that in its own LLC. If you're going to start creating educational and marketing stuff, keep that in a separate LLC. If you're going to do property management, keep that separate from your other stuff. All right. So yes, you will probably end up with multiple LLCs. It's called good asset management. Okay. Well, can I just use my self-directed IRA, my personal trust and create? Yeah, you can use that, but it's not going to necessarily give you asset protection. It's not smart to fund in your own name or your own IRA. Yes, people will fund playing those deals. But guess what? Do you want a disgruntled borrower coming back after you? Oh, here's your, I can track that person down and go knock on your door. It doesn't happen. But some people are scared about that. The reason we're using LLCs is the whole asset protection. The Consumer Finance Protection Bureau used to be around would target people. You would get complaints, and you don't want them targeting your IRA. Now it's the state licensing or the state Consumer Affairs Division, or what's the other big federal government thing that's tracking debt stuff? Anyway, the reason you keep it in LLC, you don't want them to come file a complaint against you personally and wants to go against your LLC. Okay. Now, some counties like Wayne County in Michigan and a few others, in poor counties, are actually suing the trustees for back taxes. I would not be surprised. You see this happen in like New York, Oregon, Washington State, where those communist states or communist governments, I hate to say this, they're losing investor money. So if they see that you've bought a property in your IRA, wouldn't be surprised if they start suing you for back taxes on that property. We've seen it happen before. Funding or joint venture partners, don't do some asset protection. Okay, we talked before about self-directed IRA, LLCs, and having checkbook access. Use NIC, use Safeguard, use Solero Bank to help you out. That trusts are not recommended because yes, you can create a trust really easy, stuff like that, pretty easy to. But if you're going to move it out, move it around, stuff like that, people are just going to want an LLC. All right, just keep it simple. You need to document things. Having an LLC is not just a trip to the Secretary of State and getting a tax ID number. You need to document your transactions, what you're buying from, if you're taking an apartment, who you're using, if you're reimbursed you for other things. So many different things that you have to document. Even if you're a single member LLC, you still need to document these things, okay? And it's important to use a company that can help you out with that. And we love using Laughlin Associates. They've been around for over 50 years of creating and keeping people's LLCs, their corporate veil stuff is so important for you. They help with asset protection and structuring the deals as well. They have an amazing corporate veil protection plan where somebody will reach out to you on a monthly basis and help you create the actual documents and disclosures and notices that you have to put in with your LLC and help you structure. So it's true an LLC, a true company, not just somebody out there doing things. Well worth it. So much cheaper than you would do it yourself or hire an attorney to do it. And they will also work with you to help structure trusts, wills, all this other stuff if you have a lot of other assets out there. They do a biannual event called Magnify Your Wealth Summit, magnifyyourwealth.com. They've done it on the West Coast. They've done it in Texas here. They've done it in Florida. If you want to attend it, it's well worth it. One of the most valuable 3-day events you can go to for asset protection. It's pretty inexpensive, like $3.99 to go to it. Lunch is included on that stuff too. Great networking, usually about 150 to 200 people. If you go to magnifyyourwealth.com and sign up for it, use the code NOTES, NOTES, and then they'll knock $100 off for you. They do that for all of our clients. And you can also go to lawfulnusa.com to find out more about what they're doing for asset protection. Well worth it. They work with 95% of our coaching students, and they just do an amazing job. All right. And we just recently had Aaron Young on our podcast episode 1086, where he talked about the asset protection for real estate investors and what you need to put in place in today's world, because a lot of people are suit happy. There's ne'er-do-wellers out there. So you got to be smart. Are you going to get sued at some point? Yeah. If you're a real estate investor in the real estate niche, you're going to get sued at some point. To just protect yourself, protect your assets, and go do that. All right. Let's talk about the different exit strategies available with notes, as we're kind of getting to the point where we're getting to the last few sessions here. You buy a note. How do you make money with that note? Well, there's basically 10 plus ways to skin a note, as we like to say. We did a longer form video on this, exit note strategies. You want to take a look at that at some point. But one, you can wholesale note, which is all about flipping contracts. So I get a lot of people like, I want to flip notes, and that's fine. But the work you're going to put into wholesaling, you might as well put into that raising capital to close more deals. But wholesaling notes can be done. We still do this from time to time. You can make a flat fee of like $500 or more. It's a low balance thing. You can make a 1 to 3 points based on the funding amount. If it's a performing note, usually 1% is pretty normal. If it's a non-performing note, 3% is kind of normal. You can do a double closing if you don't know the seller and don't want them to find out who or you do it for your buyer if you don't want them to find out who the seller is. Just do two contracts. Or you do a flat signed fee agreement before with somebody. We do that for all our WCN members. If they're going to buy a note, we're wholesaling it. We'll just turn them over and, okay, pay us our fee when you fund. You can also, if you're starting off or closing on multiple deals with multiple notes at one time, use a real estate attorney's escrow account to help the money to come in funding wise to come in, and then you wire out one wire. Okay. Especially it's good to do that, especially starting off with a new funding source. Good wholesalers know their deal and know how to market it. If it's a good deal, understand why it's a good deal. If you don't pay any attention to doing into a deal, you're just trying to flip shit, you're going to not be very successful and be disappointed. Okay. You can borrow. The next strategy is to try to get the borrower to start paying. You buy a non-performing note, the servicing companies that reach out to the borrower. Okay. And they start reperforming and paying on time. That's what you ultimately want with buying notes. You bought it at a discount, borrower starts paying, you're making a double-digit return. You're going to need a third-party licensed servicing who's licensed to collect debt in that state. That's going to cost you $35 to $95 a month, 35 for performing, 95 for non-performing. They're going to handle the collection of payments, the borrower outreach, or as we call it, right party contact, and you're going to instruct the servicer. They work on your behalf of what you want to offer the borrower. All right. So when we buy a portfolio of notes or buy a note, we're going to notify the servicer, hey, we're doing this. This is what we want to try to work out. You know, hey, we know we're going to get a deed in lieu, cash or keys to the borrower, so they don't have to do a whole lot of work. Okay. So that's the thing. They work on your behalf. And usually what we're going to do is do a trial payment plan to start off with, or do a loan forbearance agreement, add what they're behind onto the back end of the note. We're never going to do a loan modification right off the bat. We're just going to try to get the borrower to start paying on time and do a trial payment plan for them. The reason you do a trial payment plan for the first 12 months is it's treated as a long-term capital gains at that point versus a short-term capital gains if you modify it. Okay. Modifications, hey, great to do. Like I talked about, we'll do a trial payment plan to begin with versus going to a loan modification, but it's basically about the same thing. It's a payment plan with a lump sum or extra payments. We always want to get the borrower to bring extra to the table. We're not going to usually just let them reinstate. If they do reinstate and they're behind by 2 years, we're going to return those payments and start the foreclosure process. They've got to bring a lump sum. All right, that's skin the game. For every non-performing borrower where we never got a lump sum on the front side of something, they always end up non-performing again and ended up going into foreclosure 90% of the time. All right. The TPP, as we call it, trial payment plan, will be 6 to 12 months. And you can do a variety of things during that trial payment plan. Adjust balance, forgive, reduce back payments, adjust the payment schedule, make it a bi-monthly payment versus once a month. Like I said, never go straight to a loan mod. Once you've modified the loan and forgiven balance, reduce interest rate, it resets the foreclosure clock. All right. It's not a new loan, but it's a modified loan. Now, if they stop making payments and don't follow through and you modify it, guess what? You can only go after them for what they're behind on now, not what you forgave. And if we're going to do a trial payment plan, yes, we're going to have the borrower fill that out, sign off on it. Loan modification needs to be signed. If we agree to something on the front end, we can just send the servicing company the bullet points and they'll create the paperwork and charge you for the paperwork and send it out. Sometimes you get a loan payoff where the borrower pays off the loan. That's always nice. You can do a reduced payoff and a settlement. We've done that before for borrowers where we're upside down. We've done it over 90 days. A payment plan paid off. Okay, you're going to pay a third, a third, a third. You're not, you have to realize if a borrower hasn't paid more than 2 payments in 12 months, they're not going to go get a loan. Especially if it's an owner occupied asset, they're not going to go out and get a loan at all from a hard money loan to get refinanced out. Okay. If it's investment property or it's like a family member's property, then they could go get a hard money loan to buy it from the family member and, you know, pay you off. We've had people cash out their retirement accounts to pay us off. Hey, what do you have in your 401k? What do you have in your IRA account? All right, let's use that money to help pay off this off. It shouldn't be a penalty for paying off the house. Okay. You will handle the payoff and settlement with a servicer. You'll also need to do a release of lien from the county showing that they've paid it off. Okay. You can't allow a loan assumption. You've heard of subject to deals. Well, you being a lender, you can allow someone to assume the loan who's a family member, a friend, potential investor. I always want them to fill out a new 1003 application just to see it's not a new loan, but we want them to get all of their information, social security number, debt to income, that kind of stuff, to make sure they can afford it. When you're doing a loan assumption or a modification, it's not a new loan. So you do not need to go get an RMLO or an NMLO to go and make sure it's Dodd-Frank compliant. Okay. Most of the time, we're going to keep the existing payments, the unpaid balance, and the terms. We may have modified a little bit, but we're not going to allow them to drop it from a 12 to 6% interest rate unless they're bringing a huge amount to the table. Okay. The borrower, your existing borrower, can quit claim the property to the new note payer, to the new sub 2 buyer, and the sub 2 buyers or the assumption buyer starts paying you. Okay. You can do a short sale. If they're upside down, the borrower sells the property at an amount below the payoff, or which is what the short is. The bank has to approve what's getting shorted here. I will approve a short sale as long as I'm making more than what I paid for the note most times. If it's not listed already, we do require them to list the property at 85% of fair market value in the MLS and not use a best friend to list it and drag things out. We're going to make sure that for somebody to come look at the property, they can do it at any time. It's not around the borrower's schedule. If they're not going to allow somebody to come see it, no, we're not going to do a short sale. We'll start the foreclosure. Okay, we'll reduce realtor's commission to 4% because if I'm going to bleed and take a loss, everybody's going to bleed. Okay, if there's no foot traffic, no showings in 2 weeks to 30 days, we're going to cancel the short sale and say let's do a deed in lieu, cash for keys, or consent to judgment, and let you get the borrowers out of the property. We're not going to sit there and drag this out for 2 months, 3 months, 6 years, whatever. Okay, and you can 1099 the borrower for the short to write it off. Okay, so that's something people don't. Tell them a 1099. I think it is, or whatever it is, they can file it if they can't afford it, pay taxes on it. They can file an IRS form 928. I believe that's the form number to show that they're insolvent. If they can't do a short sale, then a deed in lieu or cash for keys or a friendly foreclosure. Basically, we let the borrower walk scot-free. The borrower will deed the property back to the bank, back to us. We'll either give them obviously they deed it back. We're going to give them forgiveness of debt. Some banks previously were trying to get the borrowers to sign off on a second lien or an unsecured lien. We don't do that. We're just going to forgive you. If you're going to deed it back to us, we're just going to forgive you the debt and let you walk. Cash for keys, $500 more to help expedite taking the property back. We've done up to 75 grand before for cash for keys. Normal is about 5 grand or less. Okay. If we're going to allow somebody to do a cash for keys, we're going to want the property in good condition. We want it clean, swept, vacant, obviously, and it helps them avoid a foreclosure on their credit. And we want to make sure there's no other liens on the property above yours. I don't care if there's municipal lien or small little liens, but we want to make sure there's not a second lien on the property, because if we accept the deed in lieu, it puts that second now into first lien position, and it's not a good thing. If there is a second, then we do what's called a consent to judgment or cash for consent. Okay. And you'll always want to pull title, see what's sitting out there, and get internal photos so you know what the condition of the property is. Okay. Because if you take a deed in lieu, cash for keys, you can't 1099 them for the difference above in most states. Most states are a one action thing where if you're foreclosing, that's one action. Some states are two action where if you foreclose and you don't get enough back what was owed, you can send a 1099 to the bar for the amount that wasn't paid off. Okay. You can sell the asset to another investor. If you've created value knowing which way the exit will go, if you bought a note, the idea that you're going to try to get the borrower back on track and the borrower's just been a pain in the ass and you don't want to deal with a foreclosure, like if it's in Cook County, sell it to another investor. Um, if it's in a, you bought it as part of a portfolio and you know the borrower is going to drag this out, just go ahead and sell it to somebody else, make a quick 5 or 10% profit. If you do that in 30 days, that's a pretty good annualized yield for you. Okay. Many funds, that's their whole goal, is to buy the notes in bulk, work to modify it in 90 days. If the borrower doesn't come to the table, start performing in 90 days, they sell it at 10% or greater of the purchase price. If you make 10% in 90 days, it's a 40% annualized return. Think about that. Okay. Sell to local investors, market via local meetup groups, real estate clubs, Facebook groups that you got to deal. Even if it's a handyman special, if the borrower, you find out the property's not in good condition, borrower sign it off, sell it off to somebody else. You don't have to do the rehab. Find you a investor-friendly realtor. If you need somebody, let me know. We've got a whole network of people that can do door knocking, property inspections, door locks, all those type of vendors for you. We can help out with that. Okay. Number 9, if a borrower's not going to play ball with you, can't pay, won't short sell, won't respond to you, you're just going to have to foreclose. Like I said, we talked about foreclosure costs. Non-judicial foreclosures are faster, cheaper, starting at about $1,000, $1,500 for the cost. Judicial foreclosures, you got to go through the process of foreclosing through the judges and the court system. That's going to be a minimum at least $2,500 or more. You're going to pay that as a retainer to the attorney. And sometimes you might get some retainers back if the borrower works, but other times you won't. You can either A, sell the property at the foreclosure auction and make money at the sale. You will give bidding instructions to the attorney foreclosing. And we'll often say, okay, give us up to 80 to 90% of the as-is value, the payoff. If you're owed more than the property's worth, if there's a ton of equity, you may want to make the opening bid your full legal balance if there's a lot of equity above and beyond what you're owed. Okay. We have one note right now. Borrower owes 200, the house is about 300. We bought it for 170. Our opening bid at the auction is going to be the full 200,000. If it sells, great. If it doesn't sell, we now own the asset and it's worth 300. We'll sell it. If it sells at the auction, okay, we make 30 grand in 6 months. Okay. If it's not sold, you now own that property as an REO. Go change the locks, go evict the tenants, and go that route. Okay. But the foreclosure is basically going to clean title for the most part. Taxes are not going to get paid. Some municipal liens like water liens, weed liens aren't going to get wiped out. Those will have to be paid, but that's okay. Sometimes you can negotiate those down with the county. If you take back the property, make sure to place a lien on the property in the amount of what your investor lent you as a first lien, or over encumber the property with a second lien above what they invited so that you don't get these unscrupulous shysters who'll go slap a fraudulent lien against a property. You'll see that happen from time to time. Okay. And that's an asset protection we talk about doing in our 2-day class. Okay. Now, we talked about the whole goal of buying a non-performing note is to get the borrower back on track. Well, guess what? When they get back on track, it's called a re-performing note. You can turn around and sell that off. And yes, you can sell it. You can sell it after you've gotten 6 to 12 months of on-time payments. I prefer 12, especially if the borrower brought a chunk to the table. I'll look at 6 months. Okay. You want to make sure that note is with a third-party servicing company, so you're adding value, not self-servicing. You can only sell off of the P&I payment. If the borrower's making extra per month, you can't really throw that in there, especially if it's just for a limited time. Your basis is going to be the P&I payment times 12 divided by what type of return they're looking for, or a percentage of the value to see what it is. Okay. You're not going to sell it above the legal or above, if the value is above what's owed, you can't sell it for full value. You have some idiots out there trying to sell a note at the full value of the property when they're only owed like 200 grand. I'm like, that doesn't make any sense. You understand what you're bidding. Okay. Borrower may still be behind, but they've paid at least 6 to 12 months of on-time payments. Great. I'll consider that a performing note. I don't care if they're a year or two behind, but they've made 12 months on time and they're working towards that back bounce. That's really considered a performing note to me. Of course, there's bankruptcy loans. If the borrower files bankruptcy, that's a good thing in the note business. For you in the real estate business, if you're trying to deal with a distressed borrower and they file bankruptcy, guess what? You go on to some other deal. Well, for us, we love it because we've now got an attorney to talk to, and your servicing company will help you out with that. They'll usually often have a bankruptcy attorney to help collect on your behalf. I'll talk on your behalf. BK Chapter 13, that's going to turn into really a debt restructuring. You can actually pull the bankruptcy filing at pacer.gov and pull up the individual bankruptcy report, whether it's a 13 or a 7. But basically, a BK Chapter 13 is going to be a 5-year payment plan to pay off what they're behind on. So they still have to make their existing payment, but they're going to pay a little bit extra. You have the right to not approve the payment plan if it's failed or bad. And it's often BK Chapter 13s that are paying are often sought after by firms at 80 to 90% of what's owed. You can discharge the mortgage from payments if the plan fails and restart foreclosure. A BK Chapter 7, though, is going to be debt liquidation. The family does not get to keep the house. It becomes an REO because you're going to finish the foreclosure, or you can do a deed in lieu of foreclosure if the bar does not comply. All right. You can do a deed in lieu or foreclosure if the bar does not comply. Now, there are some other revenue sources with note investing that turns into deals on distressed notes. You can use these distressed note leads as potential subject to deals, lease options, wrap leads, distressed home sales or short sale leads for realtors if you've got a good realtor network. You can also target some of these for owner financing leads. Hey, don't lose your home. We can help you sell with the owner financing. This could also potentially be property management leads if it's a rental property or landlord or out-of-state venture, or it's a DSCR loan that could be an investor loan. Might be a potential property management lead. With performing notes, what we see often is if it's an owner finance notes with some seasoning, or it's an older owner finance notes, these could potentially be mortgage broker refinance leads. Hey, let's get you out of your 10% mortgage into something at 6 or 7%. You got all this equity you've been paying on time. Okay. Also could be potential property management leads as well if they're willing to sell or it's an investment property. Okay. Session 11 is all about if it's a deal or a dud. Things to consider before buying. There's a whole lot of things that you want to go through when you're doing the, when you're thinking about notes. What's going on with that deal? City issues. What's the values? What's the days on market? Does it look like it needs some things? We talked about size and population in the city. Where is it located? Are there colleges nearby? Okay. Does the asset meet your strategy? Does it make sense to do with performing notes or reperforming notes for cash flow to keep that borrower back into it? Are we going to get a decent amount of profit if we do have to do a deed in lieu or foreclosure sale? Are we going to be able to keep it in our portfolio if we want to do it, or doing, rental thing? Those three things are the most important things. Is it going to meet your strategy? You want to avoid weird ass assets or unfinished projects or just stuff that looks like crap. All right. We always want to try to make sure that the note has three profitable strategies. The first one being, if it's occupied, can it become a reperforming note? Will it make sense to do deed in lieu of cash for keys? Is it going to make money if I have to take it to foreclosure and it takes the full foreclosure time frame? I don't really care about rental or new note sale or origination. If I owner finance it, those will make money, but it's usually going to be a single digit return. I've got to make a double digit return for A, B, or C, especially if I'm using other people's money. You also want to think about, has legal started? You want to ask to speak to the attorney or see the attorney notes. You'll be able to see the servicing notes and should request it as part of your due diligence process, plus the whole collateral file. We talked about checking bankruptcy on Pacer, and look at the state's statute of limitations for debt collections. Every state's a little bit different on that. Okay. And then also, is the state have safe harbor like Florida, Colorado, Nevada, where you don't have to pay the full amount due to the condo associations or the HOA associations? Sometimes you get away with paying just a fraction of what's owed because of that. Safe harbor in Florida, if I'm buying a note and foreclosing and there's an HOA lien, I'm only going to pay either 12 months of the HOA fees or 1% of the original sales price of the property, and the HOA can't do shit about it. Okay. Due diligence is a longer process, and you worry about the borrower, the property, and the collateral file, ladies and gentlemen. We do a long due diligence video, especially in our workshops, about the servicing notes, the borrower's due diligence, how responsive it is. Have they filed out hardship letters? Look at the previous loan documents. We look at the BK. We do a little social sleuthing to see if they're currently there. What are they saying on social media? We also, if it's a vacant property, we'll look at neighbors and family members trying to find them out. And we'll also look at past and present employers based on the loan documents they provide. Obviously, the property is important. We'll look at values of as is in 30 days. We'll look at the exterior condition. We'll look at the market conditions. Is it in a good area or a rough area? Always put eyes on the asset before funding, making sure that property is there and not trashed out or gone or wiped away. Look at nearby sales and comps. And by nearby sales, we mean nearby sales, not something that's 5-10 miles away. Always order a broker price opinion. You can do that through us at weclosenotes.com, or get a realtor to pull a CMA if you know somebody that's local. Look at the taxes and pending tax sales, code enforcement liens, activity in the neighborhood, previous MLS listings, the rent rates, the HOA, condo association. Some places you can't rent, or you got to be age appropriate. And then look for any of these special assessments that may have been filed by the association. And then, of course, crime maps are always a good thing if it's in a city with one of those. Of course, you will not get interior access on most of these notes because if it's not listed for sale, you're going to base most of your stuff off of exterior conditions. Okay. Use Zillow up front, and then to make your offering, use Zillow, Trulia, whatever. And then once your bid's accepted, then you'll order a BPO and do a much more deeper dive into values. RPR uses a free AVM tool if you're a realtor. I also like to call the utility departments or the city departments to find out if it's occupied or utilities are on. And I can always, if I find that the value is below what was stated to me on the spreadsheet, I can always reduce or fade my bid with proof that the value is less. And the seller can either accept it or they can cancel it and I can move on. But always, always have somebody go look at the asset before bidding. Collateral files, this is what you're really buying, not the property. So it's the original loan documents, the mortgage, the chain of different assignments of mortgages that note's been sold a couple times. Look at allonges, such as the transfer. Check out the deed of trust and make sure that that matches up with the details of the borrower that you're buying. Look at any previous appraisals on there. That's great. They're outdated, but at least it gives you an idea what interior is supposed to look like. And look at the previous borrower's 1003, which is the application that most people are filling out from the mortgage company to buy that note. That'll tell you what they have: retirement accounts, other assets, all sorts of great stuff. And the soft versus hard does not mean a Viagra thing. Your soft collateral is going to be a PDF document, scanned copies that you're going to look at. And then after closing, usually within 30 to 45 days, you'll get the physical or hard copies sent to you from the seller. Your team of vendors is important. This is not a business you do alone. You're going to have vendors out there to help you. You have your servicing company. They're going to, like Covey Financials, who we use, coveyfin.com. There's Madison Management. There's Allied Servicing. There's FCI Lender Services, which is pretty horrible, but they're there. You also have Land Home. There's a whole lot of other servicing companies out there. Essence Servicing is kind of the expensive one. You're going to use a title company for O&E reports, or a vendor. You can order O&E title reports from us at weclosenotes.com, or use a company like Pro Title USA. You're also, one of the most important things is knowing the value of your company or value of your property. And you're going to want to order a broker price opinion from us. We can do that for you. You're going to want to hire foreclosure attorneys. You can either do the servicing company will have their own list. You can use legalleague100.com if they don't have somebody, or you can use like a referral from other investors. As far as collateral review, you want somebody to look at, make sure all the documents there. You can use like a company called CSC, which is out of Dallas. You could use another company called Richmond Monroe out of the Ozarks. We also provide collateral review. That's going to cost you about $150 per file. To give you a bit of an idea, of course, realtors are important to help you sell the asset. You can go to realtor.com. You can use nard.com to find realtors to help you sell the stuff. But when we order BPOs, we have a third-party vendor with nationwide realtors, so they're able to get a realtor to go out and pull accurate comps and take some photos for you, right? Property insurance is going to be something that's important to protect your investment. You can use Ross Diversified Insurance out of Orange County, the National REI Group out of Kansas City, or US Risk, which is located here in Texas, but they do stuff nation. All these three of these companies do stuff across the country. Property preservation, especially in the winter, if you're buying something in the north, if it's vacant, you want somebody to go in and make sure the water's turned off and everything's winterized for you. And like I said, you can order your due diligence directly. We have an amazing group of vendors that we use for our students. Save you, instead of you trying to go out and do it yourself and pay a whole lot more, you can do it through weclosenotes.com, or reach to me at scott@weclosenotes.com, and we can help you out there. Anywhere from door knocking to door locks to exterior, interior BPOs, all that good stuff. Okay. Now, what comes next for most of you? Well, I want to first of all say thank you for hanging around for about 2 hours with me here. But the next thing that most people do is they sign up for our virtual note investing workshop. It's a 2-day workshop. You can get signed up for it at notebuyingfordummies.com. Normally, it's about $9.97. We've reduced the price down in 2026 for you. We've got so many successful students have closed on 10 notes, 15 notes, 20 notes, 50 notes, and making above average returns. We could talk all day about what type of deals they're doing, but we are so proud of our successful students who are doing big things out there. All right. I mean, if you're wanting to make a double-digit return in your self-directed IRA, you could do like Sterling James did, bought a small note in Florida. We helped them find the deal, help them negotiate it, help them do the due diligence, and help them close on it. All right. What's included with our class? You get a 2-day live class that we do via Zoom. That's usually $9.97, but we do that live, so you can ask questions. You will also get the replays to the previous class that you just don't have to wait around to the next live class. You can actually start learning today. You also get a 200-plus page manual with forms, contracts, case studies. We'll also include our wholesaling and calling banks master classes as well for you. And this is good for you plus a partner or spouse. All right. So it's over 20. We also bring in a tape of list or two of notes that you can cherry pick from and make offers on. That's priceless. So you get well over $2,000 in value by signing up for our workshop. And we're here to help you. We always believe there's no dumb questions. It's just that no questions are asked sometimes. And that's the question that needs to be asked. And like I said, normally it's $997. We're doing it for the low price of $297 for you guys now. It's going to notebuyingfordummies.com. That's our Saturday and Sunday classes when we host it, usually from 8 to 6, 8 to 7 at night. We used to do it 3 days online and realized that people just couldn't make it on Fridays. So we've shrunk it down to make it more accessible for you guys during a normal weekend on Saturday and Sunday. And then, of course, guys, if you want to do more, but you want to spread it out, stay involved, then sign up for our WCN membership. It's $97 a month. Go to noteumbrella.com and get signed up for that there. Includes access to the replays. We do coaching calls on Mondays. We also upload our list of notes there that you guys can cherry pick. So $97 a month, it's the biggest bang for the buck and the all you can learn note buffet, like we say. So go to noteumbrella.com for that. And then, of course, we do have one-on-one coaching that we help hold your hand through the process. What's involved with a note coaching program? It's at least 8 weeks of one-on-one coaching calls. We do via Zoom. You get my list of 5,000 plus asset managers. You get my 12 hedge fund contacts. You get a year of the WCN membership. We'll help you with raising private capital. You get VIP access to me. After you do your 8 to 10 weeks of coaching calls, you come spend 2 days with me here one-on-one in Austin, Texas. And then we do a follow-up call via Zoom 6 months later. And we will help you find your first deal and help you raise capital to fund that deal. We are here to help save you money and make you money. If you're going to invest some time in the coaching program with me and money, we are going to work our ass off to help you make that money back. Because the cost, it's not the cheapest thing out there. It's right at 25 grand. But we do offer a discount if you pay in full. And we also have the availability to do a 24 to 36 month financing program for you, where we've got a third party vendor that will help with that, or we'll help you with that as well. So if you're wanting to finance your one-on-one, we do offer it through Ease Coaching. It's 2 years of W-2s. You got to make 40K per year, have a 620 FICO. And like I say, they'll spread the payments up over 2 to 3 years for you. So your monthly payments could be about $500 a month. There's no prepayment penalty plan for that. And that payment starts in 45 days. So you can get rock and rolling. And most of our coaching students that go this route, we're going to find you a note that you can purchase that's going to pay you $500, $600 a month. So you can start paying, it starts paying your coaching program for you. So you may can even get into it with nothing out of your own pocket if you qualify. Okay. Like I said, we've got a whole, our normal total cost is already at 25. If you do a 30-day paid in full discount, we'll drop $5,000 off it. So it sets up, and then we can set up, or we can set up a monthly payment plan. Bring a chunk down. We'll have it paid over 12 months. Or if you want to do the third-party financing, you can do that. It's a full year coaching, and like I said, we have a 95% success rate. The 5% success rate, 5% of those that aren't successful either disappeared or were not coachable people to fall through. We find deals for you by giving you our access. All right. And we just went through this here. We're willing to help you get this rock and roll. If you're wanting to do something, let's talk about the coaching. But like I said, guys, we can find out in just a few minutes, in hours, not days, if you're proof of that, and get you rocking and rolling. If you'd like to dive in it, let me know. We're glad to send you the link to get this a short 10-minute application. But I think for most of you guys, it's going to be the next step is to sign up for our 2-day workshop at notebuyingfordummies.com. It's the biggest bang for the buck. We're going to show you, like I said, how to find, fund, flip, flow, due diligence, raising capital, how to find the deals. We're going to hold your hand through it for 2 solid days with yours truly. Now, are you going to learn everything about the note business in 2 days? No, you're not. But you're going to learn a whole lot more from me because I'm not going to blow smoke up your ass. No pitch, no pitch run to the back of the room or any credit card. It's 2 days of nuggets and knowledge with the note guy. All right. So, like I said, normally $997. Get signed up for this today at notebuyingfordummies.com. And like I said, guys and gals, we're here. Thank you for listening. And feel free. If you got questions, want to talk more about coaching or the class, book a call with me at talkwithscottcarson.com. That's a 30-minute call or Zoom with me. It's free. Talkwithscottcarson.com. And let's help you take your business to the next level, ladies and gentlemen. All right. Thank you so much. If you're going to hang around for the live version of this, we'll dive and tape if you watch the replay. Thank you for listening. Thank you for watching. Go out, take some action, and we hope forward to seeing you at the next virtual note buying workshop. Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the podcast. We are so excited about this episode. This is a Texas reverse mortgage foreclosure case study that we're going to. It's actually a note that we're bidding on today. Literally sent in an offering earlier this morning about this deal and waiting to see what the comps come back, or not the comps, but whether they accept it, decline it, counter it. It's definitely some opportunities here. And this is either going to be a great ROI in a short-term deal, or it's going to be another potential six-figure profit. Heck, 50K profit. If I got to split it with somebody, I'm rocking and rolling and feeling great about this. Okay. So, first and foremost, thank you again for always listening, commenting, watching this stuff. If you're one of those folks that are watching, listening, or even reading this, thank you so much. And we really, truly appreciate you. I really do appreciate for all you guys that are commenting. You're loving these breakdowns. Thank you so much. Keep them coming. Keep them coming with your questions. That's what we're here for. So thank you for, we've gotten a wave of people comment that you're really, really loving these breakdowns. And here's another deal that I think is going to meet your fancy, and maybe for some lucky investor, be a potential funding partner with us on this deal. But anyway, once again, 50K, 50 no deals in 50 days. I think this is deal number 17 or something like that. I got to go back and count it up. But this is a deal. It's not here in the big metropolis of like Austin, Texas. It's not in the top 5 city of Austin, Texas. This deal is actually in Wichita Falls, Texas. Now, that's a picture, that's the Google street shot view, which is hard to tell because it looks like it's brown, decent roof, mature trees. That's a picture from this year. Okay. A little harder to see. But the great thing about this, we have an interior and exterior photos from an interior BPO that the fund provided a year ago. Okay. If you don't know where Wichita Falls is, it's up North Texas. It's north of Fort Worth. It's just south of the Oklahoma border, just south of Chickasaw Nation. It's actually, did not know this. I thought it was a smaller town, but there's somewhere between 102 to 105,000 people that live in Wichita Falls, Texas. It's up by Vernon. Wayland Baptist University is up there. Midwestern State. There's Vernon Community College, something like that. It's the 43rd largest Texas city. Now, to give you a bit of an idea, it's the same size as New Braunfels, Texas. All right. It's bigger than Georgetown, Texas. I was surprised by that. That actually kind of shocked me today. So I was like, oh, it's a pretty good sized town. That population size meets our minimum requirements. I want to see at least 50,000 or more people in most cases. I'll go down to 20 or 10 if it's down the coast where I grew up in Ingleside and Aransas Pass, because I know that area. But I've never bought a note in Wichita Falls, Texas. Now I've had stuff. I take that back. I have had some stuff in part of portfolios we bought and sold off and things like that. But this is a deal that I'd be willing to make that trip up to Wichita Falls, Texas, because there's actually another one in Wichita Falls that we'll talk about probably tomorrow or the next day. But this one is a bigger asset, and I think the profitability and the numbers behind it really do make sense. So let's dive into the numbers. Now, the great thing about it is this was a picture from the actual BPO, which I like. Wow, that's a nicer looking photo. And that's just from a year ago. Okay. And I'm like, oh, that looks pretty good. I like that very much so. Now, give you a bit of the numbers. This is a HECM mortgage, which HECM stands for high equity convertible mortgage loan. It's basically what we call a reverse mortgage. Somebody lived in the property. They had a bunch of equity. They hit 62 years of age, decided to tap into that equity that they had and pull some money out of it, and they live in it, and then unfortunately they've passed away. Okay, so the borrower's been deceased since about June of last 2 years ago. So it's been vacant for about 2 years. June of 2024 is what triggers that it's in non-performing status. Once the borrower passes away, the lenders usually will give, HUD, and the lender will give the either surviving spouse or the family the opportunity to come and pay off the mortgage and go from there. Well, that didn't happen, so it's proceeding to foreclose. Now, it is a good-sized house, 3-bedroom, 2.5 bath, 2,630 square feet. It was built in 1959. It's obviously been updated when you see the photos inside. Okay, it's on 4/10 of an acre. All right. It was originally purchased by the previous borrower, in May 27th, 2003. So they lived in there for 20 years. Okay. And they bought it originally for about $80,000. Well, the unpaid balance, when they took some equity out of it and stuff like that, now sits at the unpaid balance. That's not the legal balance. Legal balance is a little bit higher. The unpaid balance is at 108, 185. Okay, I don't have the legal balance. I'll get that if our bid's accepted. We'll go from there. But the fair market value conservative says 292. Previous BPO said 314, 315. BPOs can vary. Obviously, it's a year old, stuff like that. But Zillow Value gives it around 292. And I would definitely give that a solid valuation from doing some online due diligence on stuff. Okay. Like I said, the interior BPO said 315 a year ago. Okay. I could see that. And, the 292 is going to be based off other sales in the area, but the somewhere between 290 and 315. Okay, if it's cleaned up and stuff like that. Because when you look at the exterior, it does not look that bad. And the big thing about HECM reverse mortgages, guess what? You're not going to get the borrower to come back to the table and start paying on time. I mean, you take a hell of an exorcism, the night of the living dead, mortgage payers to come back. Family doesn't want it. They've had the opportunity. I mean, there is a substantial amount of equity, $108,000 unpaid balance to a fair market value of 292. That's a $184,000 difference. Okay. That's a chunk of change sitting there that could be an opportunity for somebody. Okay. Now, here's kind of what I run through the deal. But let's talk about a little bit before we talk about that. Before we talk about ching, let's go through some of the photos. Now, here's another photo from the exterior BPO. And you can see it's got a 2-car garage. It's not so bad there. That's the back of the house. Nice looking. You can see that the BPO agent went through the fence and then the glass door there. The AC unit doesn't look that bad. Now we have interior photos. Now you have the living room kind of den. It's nice. Look at that stuff with the built-in shelves and the door up there. And looks like there's a lot of stuff that's been left in the property. Here's the other part of a living room. It looks like somebody did an estate sale and then they just walked away. Now, I don't know what is currently on this stuff. I would probably make the trip up there. I've got the lockbox codes of this one. Be a heck of a trek. But there's the kitchen kind of, you can see, pretty good sized kitchen, lots of cabinet space, kind of that old paneling look, but it's still, decent. The carpets don't look bad. When I look at these images, I'm looking for two things. One, I'm looking for holes in the ceilings, and I don't see that, or holes in the wall, or water damage, or damage. And I don't see any damage in this stuff. Okay, pretty clean. This takes us into the dining room area. You got a big armoire there left there. Okay. You have the larger bedroom over here to the right-hand side. You get the second size bedroom there. A lot of stuff left in the house, but that's okay. Carpet looks a little old, but you got the older light fixtures there, or the blinds. It takes us to the third bedroom up here, which looks like it was probably an office with that gold carpet around the outside, which is okay. And there's 2.5 bathrooms in this thing. So you got the biggest bathroom to the right upside there. Okay, it's got wallpaper, not a big deal. And it's got this kind of interesting trim. I thought that it could have been water damage, but it's actually trim on that shower stall. Here's another photo of it. Here's the second bathroom, sorry. That takes us to the next thing. You get the half bath. And then you get a picture of kind of the facing out into the backyard from here. And then it's also got a laundry room, pretty good sized laundry room. Look at that storage, the shelves, stuff like that. When I see something like that screams like, hey, my mom's got a knitting room, right? She's got a room she converted in her house into a sewing room. Okay. But that's like, oh, that's the laundry room based on the BPO. Okay. It's like, wow, this looks like it's in pretty good shape, right, everybody? A little outdated in some cases, but it's basically, you're talking paint, carpet, and some fixtures. All right, and haul a bunch of stuff off. Have another yard sale to pay for your rehab, right? Anyway, moving on. So let's talk about the deal on this. So with a non-performing HECM loan, you're going to foreclose. And in Texas, since we're in a fast foreclosure state, usually it doesn't take that long, about 90 days to go through the foreclosure process. Okay. So since there's equity, I would my initial bid's at 80 cents on the dollar of UPB. I don't have the full payoff amount. Okay. So they may come back and say, okay, we want you to little bit higher. Okay, that's fine. So let's just say 80% of UPB. So you take $108,000 times the 80 cents on the dollar comes to $86,500 is my offering. Okay, remember the UPB is 108. So let's just say you're gonna have to take it to auction, which is like 90 days. You bought it at 86, you finish the foreclosure, you say, okay, credit bid for the full 108 because that's the highest you can bid. It sells at auction. You make $21,600, 21.6K. I'm gonna put an asterisk next to that in roughly 90 days. And that's a 20% ROI in 90 days. You annualize that out, that's an 80% annualized ROI in a fast foreclosure state, start to finish in 90 days. That's definitely can happen. That happened recently with two of our deals, one in Texas here, another one is going to happen up in Tulsa with our coaching student, Andy Espinero. We'll probably go through that deal this week. So that's not so bad. If you've got your, $90,000 for some little bit of holding costs or stuff like that along the way, that's a pretty good ROI. Quick money in and out of a deal. You ain't got to deal with any maintenance. You're not dealing with anything at all on it. You're basically finished the foreclosure, getting paid a check within 30 days of the auction taking place. And this is up at Wichita Falls. Okay. Now, let's say it doesn't sell at auction. Okay. And it becomes, you take it back and it becomes as an REO. Well, then your goal with that really wouldn't be to keep as a rental. You could, but I'm not diving in the rental spot right now. Let's just, because there's this huge amount of cash, right? Fair market value, 292. All right. That's a lot of profit. You're in about 30, under 30 cents on the dollar when you think about it, right? And at 86, it's worth 292. 86 times 3 is enough, right? Okay. So let's just say you put a full 50K rehab in the property. That's internal paint, new carpet, and new appliances. It doesn't really need anything else for the most part. But let's just say you got to throw a new HVAC in there at 10 grand. 50K rehab. Well, if you figure in that, okay, you're going to sell it for 292, that's the value of the property. You're going to lose 10% in closing costs and commissions. I'm just going to throw that in there. That might be a little high, 29 grand, but we're just going to figure 10%. Okay. So you take your 86,000 purchase price plus your $50,000 in rehab costs, and then you throw in the $29,000 in closing costs. Okay. That's 165 total costs from your 292. That's still a chunk of $127,000 potential profit. Cha-ching, cha-ching. Yeah, baby. I like that, don't you?
Well, yes. Yes. Yes, 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 yes.
We all love that kind of stuff. That's a good six-figure deal. That's 100% roughly of ROI if you're using your own money, right? ROI on that's like 102, 103%. You're sitting pretty freaking good. 127. That's over 100%. All right. And that's if it took a year. If you could do this in 6 months, 90 days in, 90 days out, guess what? That's almost a 200% ROI. It's actually more than 100% ROI because you figure you got 127, you're into it at, oh, no, it's under that because your costs, 86 plus the 50 is 136. So you're at 90 something percent. Phenomenal, right? Good enough. Okay. Now, the question most people are out there like, well, Scott, this sounds great, but I don't have money to buy notes with. Oh, shucks. Oh, woe is me. I'm going to cry me a river. No, you're not. Okay. So get out and start talking to people. We're teaching a class actually right now, Marketing for Money. And it's the halfway point. And this is a great deal talking about raising private capital from IRA investors in the Lone Star State, fast foreclosure state, still relatively fast turnaround time of 90 days to buy and sell in most places. Okay. That's going to be the one tricky thing is looking at the days on market in Wichita Falls. Okay. And something like this, I'd be willing, you could fire sale the thing faster and still make a good chunk of money, still make 100 grand, give or take a little bit. All right. So let's talk about what if you don't have your own money, but you go out and raise capital. Let's just say you find an IRA investor who's got money sitting on the sidelines and he wants to make 10% on his money, his or her money. No offense, their money. Okay. His or hers. All right. So you're still buying 80% of UPB. So the 108 of the UPB times 80 cents a dollar, it's 86.5. Okay. All right. You sell it at the auction. You're still going to make 21,600 in the sale. But what did your money cost you? Well, if you were to take 10% of your money and you borrowed 86.5, let's just say it's that for simple purposes. So then that's 8,650. That's 1 year's of interest in 10%. If you did a 1 year prepayment penalty, that's what you got to pay. But honestly, I would just say, hey, I'll give you, if we in and out in this 90 days, I'm going to give you 90 days of funding. Say it's less, say I'm going to guarantee 90 days, 1 quarter payment. So you're making some money. So You take 8,650 divided by 4 because it's 90 days. That's a quarter. Okay. So that means if you made 21,600, you're only going to pay $2,162 to your funding partner. That's $2,162. That still gives you a nice whopping 19 grand in profit, net profit. Is there going to be some servicing costs? Is there going to be some foreclosure costs? Yeah, no, there's going to be a little bit along the way, but I guarantee that the legal balance is going to offset that. All right, so we're just working with numbers. We're going to say it's a wash. Okay. All right. 19 grand. Now, what's your return on that? Infinite. Your return is an infinite return because you're not using your own money. You borrowed the money. And you borrowed the money basically. Well, I take that back. You would have to, if it's sold at auction, you only borrowed 86, you would have to pay taxes on that 19 grand. Okay. So that's, that's okay. You paid your investor back their 86.5, and they also made $2,162 in 90 days. That's a pretty good return to them. Okay. In 90 days, that's really good, actually. Okay. If you do that for 90 days and it only takes you 45 days to sell, it sells at auction, they don't make a 10% annualized return. They make a 20% annualized return on that. Okay. Do you understand compound interest, how that works, all that great stuff? Yeah. So 19 grand, you use somebody else's money, buy it, sell it, be out of the property in 90 days if it sells at auction. Might very well happen because it's such a low investment to value. I didn't figure this out, but if you just look at the payoff, the 108 divided by the 292 value, it's 37 cents on the dollar. 37 cents. You're into it at 26 cents on the dollar because you take off about 20, 25 cents on the dollar off before you're sitting even prettier, right? All right. Now let's talk about what would happen if it didn't sell at auction and you took the property back. Okay. Well, if it doesn't sell at auction, now you want to turn around and list it as sell it as an REO. So remember, fair market value is about 292. We're just going to say a 50K rehab. You're going to say, okay, if you add 13.6 is your cost of money. So 50K plus your 85K is 136,000 is what we're figuring that. All right. So 13.6K is a year of interest if you borrow 136,000 at 10% interest. Okay. Now, I'm going to say this, let's just say it takes a year for the heck of it. 136,000, that's 85 plus 86,000 for your purchase of the note, 50,000 rehab, plus your $13,600 in money costs for a full year. And let's go ahead and throw that 29,000 in closing costs and commissions in there as well. That comes at your total cost basis is at 178.6. If you sold it at 292 minus your $178,000 costs, you're going to net a nice whopping six-figure $113,400 profit. That's pretty stinking good. Now, remember, those closing costs include commissions, title fees, stuff like that. That's a pretty good. Now, if you could do this in 6 months, your money costs don't go 13.6, they go to 7.8, So you could throw your profit be 120 if you got an investor to give you the money at a 10% interest and do it for a year. Now, I always say, prep your investors, even in Texas flips, say it's going to take a year to 2 years to get things done. Guarantee, 90 days of interest or 6 months of interest if you want to do that, depending on how savvy the investor is. But most investors that are looking for deals to fund, it's sitting there burning a hole in their pocket. Okay. Now, when somebody sees it's like, oh, that's a pretty good profit, I'd like to make some. Could you split the deal? You could potentially split the deal with another investor. You'd probably want to set up an LLC together or make sure they're an active investor in a lot of cases. But if somebody's like, oh, I got 25 grand, I got 25 grand, 25 grand, 25 grand, you don't want to pool money that's be illegal. Okay. Now, how would you secure your investors' money? Well, when you bought the note, you'd have them either be on the assignment of mortgage with you or have them be the loan funder of the assignment. You have the deal, have them on the assignment, and then you have a partnership agreement. They outline the deal. Okay. I would say just do 50% interest to their LLC or IRA, 50% interest to yours. And in the actual operating agreement or funding partner, you can set up the interest rate at whatever you're looking at for, flat loan agreement. On something like this, could you do them a 12% return on their money? Yeah, you sure could. Now, obviously, let's talk about the due diligence side of this. Obviously, you still want to review condition of the property. I've got an interior lockbox code to it, which gives me keys. So it'd go through, make sure it looks good. It's obviously a vacant asset, so there's no power on, no water. You'd want to get those turned on if you had to take it back. Minute I bought the note, I'd go change the locks. I'd go change out the locks and secure it for myself. Obviously, the valuation is going to be very important. Hiring a new BPO, new agent, pull comps, and the big key factor with this one, I mean, 100,000 person city, it should have relatively still stuff should still be moving. So finding out days on market, the big kicker on that 292 versus days on market is it's really at 6 months. If days on market take longer than 6 months, the 292 value is going to have to come down maybe 250 for a 30-day quick sale price. But that still gives you the flexibility if you're coming in and your investment's 86 on a $108,000 balance, or maybe it's 90 on a $115,000 balance. That's $25,000 difference. I'm looking for that $20,000 difference if it's a fast foreclosure. Now we're talking, you should be able to foreclose in 90 days or less. Some of the deals that we've been buying recently have been under that because we've been buying them at a price and then taking over, the creditor's position. Obviously, you're going to review the collateral file. All the documents go along with the servicing notes, the attorney notes, pulling title report, making sure that there's opportunity with this as well for you. So it's your full due diligence side of this. But like I said, I submitted an offer on this one this morning. I'm looking to see what comes back. I've submitted 20 offers yesterday and today onto this fund and another other fund that some of the deals that we looked at. So definitely excited about this deal. If you're interested in getting rocking and rolling and looking to put some money to work, let's talk, ladies and gentlemen. Love to talk with you. See if it's a fit for you. Now, we're not looking for wholesalers. Don't contact me until you're looking to buy for your private equity firm. And then I look at your profile on LinkedIn and you're selling patio equipment. Okay. And you have a recent update of selling patio equipment. And then I find out that you don't have a private company because you're using a .me email address and you're just a wholesaler. So I don't need wholesalers. Okay. No, I'm not looking to flip this asset to somebody. I'm looking for somebody who wants to come in and partner fund this deal provided the price right. If they come back and they want 105,000 on $108,000 balance, there's no room to make any money on that. Okay. I don't have to hold around and wait to try to buy this as an REO. I don't want to roll the dice and only make $2-3 grand at a foreclosure auction. So that's the big kicker on where they're at. Could I go to 90? I might be able to go to 90 on it. But I'd probably put a clause in it that all the interest, the difference, if it's only 10 grand or less, probably goes back to my private investor on that. I can still make a couple grand at 10%, and a couple grand on nothing is still an infinite rate of return. So there's some flexibility on this. I think the property taxes are all paid up based on what I've looked at before. If I know the funding, that's one of the things they do. And so it is with a third-party servicing company, and it's already been started down that foreclosure process. They referred it to attorney last January. I haven't foreclosed on it yet, so it's an opportunity for us while they work through the probate side of things. So as always, guys, if you want to make an offer, jump on. Feel free to shoot me an email at scott@weclosenotes.com if you're serious investors, or book a phone call with me at talkwithscottcarson.com. That's talkwithscottcarson.com, or my email address at scott@weclosenotes.com. So as always, we do have an upcoming workshop August 29th and 30th. It's a 2-day, Saturday and Sunday. We'll be going through this deal on there a little bit more instead. We'll probably going through the due diligence side of things because we're 45 days out from the class. Tickets are only $99 as we sit right now. So take advantage of that early bird special and get signed up today. You don't have to wait till August 29th to learn. We had a guy sign up this afternoon. He already had the email sent to him with replays, the previous workshop, and he is already learning how to become a note investor. So encourage you guys. Thank you so much for coming on, listening, watching. Keep the comments, keep the reviews coming. And once again, thank you for being such a great listener, great students when it comes to our 50 note deals in 50 days. So go out, take some action, everybody, and we will see you at the top. Bye. Good morning, good afternoon, and good evening, real estate and note investor. Scott Carson, excited to be here with you today to talk to this specific case study deal on arbitraging and making anywhere from an 11% return to an infinite rate of return. Now, nothing beats infinite. And so this is a great little deal. I had it sent to me from another one of our hedge fund sellers. It was actually one of 3 notes that they had available for sale. 2 were in Houston, 1 is in San Antonio. And then I actually drove by this property. The photos you see of the property are actually photos I took of myself when I was there last week looking at this asset. And it's a nice little property. It's a performing note. It was owner finance. So I was looking to sell this one plus the other 2. And I think this is the most attractive one out of the bunch because it's a lot of pride of ownership. It's owner occupied, and you can tell that the borrower really has done a great job and really wants to stay there. House is, but it's not the biggest property by any means, but this is a great deal and a great example of how you can either use your own money and make a double-digit return on cash flow, or you can also use somebody else's money, OPM, other people's money, to pay for purchasing the note and still cut yourself in for a couple $100s a month in cash flow. And it's a win-win-win across the board. So I really like this little deal. I think it's a great one, and let's dive into it. And like I said, it's a nice looking little property. You can see you've got some pride of ownership. This is, that's the front of my truck here in the bottom right hand corner. My Dodge Ram there. I pulled up in the neighborhood. It's a quaint little San Antonio neighborhood. It was one of the nicer houses on the block. They're all kind of smaller houses, but you really see that the borrower has done some really nice work. Sitting outside, they got plants. It's hot in the middle of summer here, so nothing's really growing plant-wise, but they've got pots, they've got the wind chimes, they got the exterior lights on it, newer roof. This property looks like it's been rehabbed definitely in the last couple of years. And so when I saw it, I was like, oh, I kind of really like this. The gates, we see a lot of that in San Antonio area where you've got some of these higher gates on stuff going on. But it's okay. You're not living in the property, but I bet it's just as nice inside as it is outside. Now, this is it's a performing note. It was built in 1960 originally, but you can tell it's been rehabbed. Newer roof, newer siding. They just got a lot of pride of ownership on it. 3-bedroom, 2-bath, 1,288 square foot. It's a performing note. Like I said, it's owner occupied. It was originated back in February of 2022. So they've been into it for over 4 years. Now, the purchase price of the property was at 145 and some change. The borrower brought in about $15,000, just shy of $15,000. I think it was 14,700 to be precise, but $15K down payment. It was owner financed 30 years at 9.9% interest rate. The current unpaid principal balance, that's what UPB stands for, is at $126,750. Now, the value hasn't gone up a lot in this part of San Antonio. It says online value is like 147. It's not showing a newer picture of the property. We can say San Antonio has taken a little bit of hit in values in the last 2 years, kind of stayed low, but San Antonio usually appreciates on average 5 to 10% per year on average. It's just that we have a little bit of a correction, but still, you're sitting in a pretty good spot. It's only if you figure the unpaid balance versus the fair market value, you're at an 86% LTV of the unpaid balance versus fair market value. Now, the current P&I payment, since it's at 9.9% interest, is at $1,135. That's a nice payment asset. Now, like I said, the borrowers on this, they went through an RMLO to finance this. It should be a pretty clean collateral file. It is with a third-party servicing company, and they are on time. They always pay by the 10th to the 12th of the month, is what the notes in the spreadsheet said, which I love seeing stuff like that. Okay, so it's through a third-party servicing company. You can literally step into cash flow by buying this. Now, when I asked the seller what they were looking for on this, they're looking for roughly about 90 cents on the dollar, in the 90s, okay? Now, I would say offer at 90%. There's a point to the seller. So maybe you offer at 89 and you get it at 90%, right? So your total cost, if you take the 126,750, which is the unpaid principal balance, multiply it times 90 cents on the dollar, that comes to a purchase price of 114,000. Okay. Now, if you take that 1135 a month that's coming in times 12 months, that comes to just over 13,620 in cash flow. Now, that 13.6 divided by your 114, that's a decent return of right at 11.9%. That's not too shabby, right, everybody? Now, if you take away $35 a month for servicing costs, since it's performing out, that drops it down to 11.5% cash and cash return. Okay. And you're sitting at a 77.5% of investment to value. Buying at 114, it's worth 145, 46, 47, give or take a little bit. That's at a pretty decent, safe investment of value. I like being below 80% of my performing notes on something like that. Now, the great thing about it is there's a $12,000 difference that you're basically at between where you buy the note at and the payoff amount. Okay, so if you're buying at 114, they owe 126,750. You're at a nice difference between the unpaid balance and what you're buying that note at. Now, if you just consider to collect payments. They're going to pay you off over the next, well, 26 and a half years. There's still 308 payments left available. All right. So that's a great deal, great solid base hit ROI for your self-directed IRA. But what if you're sitting out there and you're like the guy Alex that I talked to yesterday? He's like, I got some money, but I need to make my money go further. I don't, I want to get some cash flow, but I would prefer to get infinite rate of return. Well, that's where using other people's money comes into the situation. 11.9 or 11.5% is not bad. That's better than what you're going to see most of the time out there in performing notes. But let's talk about arbitraging. How about you bring in somebody's self-directed IRA money and you put that to work? They fund your deal and you're making a split of the cash flow. You're paying your investor a good return and then you're keeping the difference. Let's go through the numbers on what that would look like. Okay. Now, if somebody's going to bring in $114,000 to fund your deal and they're passive, the money's not been going to work anything, then what I would do is I would offer them an 8% interest rate. If you can get it cheaper than that, 6-7%, by all means, great. But offer 8% for other people's money. It's getting them into a deal. It may be a 3 to 5 year deal or longer, but you're going to give them a good return at 8% where they don't have to do anything. Okay, so if you take, and I was throwing $115,000 because there's going to be some costs along the way. Maybe put $1,000 in your pocket, whatever. Maybe you got to pay it a little bit more. In transaction fees or your due diligence costs, stuff like that. So let's just say you get them to fund $115K at 8%. All right. Well, if you take, that means $115K at 8% interest only. You're just paying interest only to your to your investor. That's $9,200 a year that you got to pay him. You divide that by 12 months. You're going to pay him a monthly interest only payment of $766.57 per month. Okay. I think actually 6.7. It's like, we just say 767. Okay. Well, if you take the 1135 that's coming in gross minus the 767, that comes to $368 difference in cash flow into your hip pocket. That's right. 368 is the difference on a month-to-month basis on this. Now, I say you only going to see $333. Let's go ahead and just have that servicing cost of $35 removed from that. So you're netting $333 times 12 months. That means you're going to net a nice chunk of change there. Is it going to get you, where you retire? No, but guess what? $333 times 12 is just at $4,000 per year in cash flow. And that's right now, as it sits, this is based on that they've paid 51 months on time, right? The 127 UPB is at month 51. Now, why do I have months 51 through 141? Well, it would take them paying another 90 payments or 7.5 years to go from the 127 down to 115. So let me show you this. Okay, so we ran this through an amortization table. Okay, just simple amortization. 130,470 was what they originally financed. 30 years, 9.9% interest, 1135.34. What I show you? All right. And if you look at it where they're at today, so they are at payment 51, right? 126,750. We just outlined that in red there for you. And if you're borrowing 115, how long is it going to take for that unpaid balance to get reduced down to where it's at with what you borrow from an investor? Well, that's going to take you to month, basically 140, 141. 141, you get exceed 115,000. Okay. So, like I said, that gives you about 90, 89, 90 months of potential cash flow if you want to. But guess what? We don't want to hold it that long until we get down to 115. I would suggest, guess what? You hold it for 5 years. Now, what's the balance going to be in 5 years? Well, the unpaid balance, if you look in 5 years, so you take 51 months plus 60 months comes to month 111. And the unpaid balance in month 111 is 119,820 and 50 cents. So just under 120,000. Okay. So you hold this note for 5 years. In 5 years, what's going to happen? Well, appreciation is going to go back up. The market's going to rebound in San Antonio. The value is going to go up. They're going to be sitting at a better percentage. They're at 119. That's payoff. It's unpaid balance at 120. Value's going to probably go up to 150, maybe 160, maybe even 170 based on what we've seen in the past. Okay. So their interest rate's at 9.9%. If they paid on time and they got decent credit, and they got private ownership, I would work with them to do a rate term refinance with a mortgage banker, a mortgage broker. All right. Get them to roll that. They can roll a closing cost there, pull some cash out. Hey, they're sitting at a pretty good percentage there, right? Even right now, if it was just a rate term at 80 cents on the dollar, they're sitting pretty good. Okay. So what happens, you get them to pay off a refinance in 5 years. You hold it for cash flow. You get them to refinance at the 119.8. So you're getting paid off in full. So you're able to, with a 119.8, what are you going to do? You're going to pay 115 to your investor, get them refinanced out in their self-directed IRA. Remember, they've been making 8% return all along out of that difference in payments, right? The 767 a month you've been paying them. And you put another 4,800 cha-ching in your HIP National Bank. That means by using somebody else's money, you've received an infinite rate of return and put $24,780 in your pocket. Now, are you going to retire on $24,780 over 5 years? No, you're not. But guess what? If you figure that on average over 5 years, that's 5 grand. That's roughly about 600. No, I'm sorry. That's about, yeah, it's about 500, just under $500 a month average, 400 or 333 coming on it, and you get a bigger kick on the back end of the 4,800. That's a pretty good little base hit. 330 a month. What's that going to cover? Well, is that going to cover your car insurance, your cell phone bill, maybe your power, maybe your utility bill? That's a great little asset to have in your wealth building portfolio. Okay. Is it going to, like I said, are you going to retire? No, but that's a great little base hit. You've got pride of ownership. You got somebody who pays on time, and you've got a little cash flow that comes in that builds a lot of benefit. Now, what's that investor with 115K going to do in that 5 year period? Well, they're going to be happy. They're going to probably come back to you. Hey, can I put some more money to work with you? Can I, can I introduce you to my friends? Yes, yes, and yes. All right. Now, if somebody comes, now, what if somebody wants to be tied up for 5 years? That's completely fine. Put it in for 3 years. They pay off in 3 years is going to be higher than 119. That's 36 plus. I don't even think I've got the numbers on that. 80 something. Yeah. So it's probably going to be closer to about 123. So you make more money if it's only 3 years. Put them in 3 years and do a 2 year renewal. Now, what if they can't refinance? Well, guess what? Then I would just turn the deal over to your investor. Hey, you want to make a 9.9% return on your money? I'm going to cash out of the deal. I'm just going to hand the deal over to you and you walk away. And they're happier than a pig in slot, making better than 8% now, right? So moving on here. So let's do a quick little recap. You're buying this note at 90% of UPB, which is the 114K. You're borrowing 115K from a self-directed IRA investor or a passive investor. You're going to give them an 8% interest-only return. I would set it up where it's just quarterly payments. All right. In case there's ever a little hiccup, it gives you time to get back on track. But this bar is paid on time. They've got a chunk of skin in the game. They put 15 grand down. They don't want to lose this. Okay. So the arbitrage cash flow to you is going to be 333 a month after servicing. 333 a month times 16 months. It's 5 years. It's 19,980. You're going to get the bar to refi by working with a mortgage broker to get that 9.9% interest rate reduced down, so they get a better deal, maybe cash out, pay you off for sure. You're going to make $4,800 in the payoff, which is the difference between what you borrowed at 115 and the payoff in 5 years. You've paid your investor back. They're happy. They've made 8% passive returns for 5 years, and you've made roughly right under 25,000 in 5 years in the past. 4,800 plus the 19,980, it's 24,760, right? Or 780. That's a pretty good little deal. Can we agree to that, ladies and gentlemen? There's insurance being paid by the borrower. They're covering the property taxes. It's with a third-party servicing company. You can step into $333 by just talking to potential investors. Now, people always ask me, well, Scott, what happens? What happens if the sky is falling? Well, let's go through that. The sky starts falling and the bar defaults. Well, I would always set them up on a payment plan first. If they're going to get more than 90 days behind, guess what? You have the right to foreclose at that point. All right. Pay, stay. Would love to help you out, and I'm glad to help you out. But if you're not going to follow through on payment plan, look, people will get hiccups. I don't mind taking a 1 month payment you're behind on and spreading it over 3 months or spreading it over a year. You fall behind by $1,200, just pay me $100 extra per month. Going forward, we'll get you caught back up, or $200, whatever it might be. There's a way, okay? But the thing is, along this way, this property is going to appreciate. It's one of the nicer houses in the neighborhood. It's going to go up. Okay, there's rehabs taking place all around it, right? So you're either A, If they don't play ball and you've got to foreclose, guess what? You're probably going to get paid full at a fast foreclosure. Once they're more than 90 days behind, you foreclose in Texas in 30 days. This is in Bexar County, San Antonio, Texas. Okay. Drove by it myself. Okay. Now, if it doesn't sell at the auction where you get paid off in full, whatever the full you pay off is on, that's what your bid is for the attorney. Hey, pay off, full payoff. If they don't pay, if nobody bids you at the auction, guess what? You've now taken this property back as an REO. You offer up before it ever goes to foreclosure, you offer up some cash for keys to the bar to walk away for what it's going to cost you to foreclose. Okay. Now, that's the great thing about it. You don't have to give them a ton. You could, it's up to you. But let's just say you're going to give them the 2 grand. Say, listen, you're behind. I'm going to foreclose. I'm going to give you 2 grand to either walk away or we're going to foreclose or pay me off. All right. But if they don't, it doesn't sell at auction. You now own an REO that's at no higher than probably 78% of fair market value. Okay. Like you said, pride of ownership, probably nice inside, like it's nice outside. The value's at 147 as it sits there. It's only going to go up 150, 160, and you're sitting at 115K investment. Okay. If they stop paying, guess what? You tell your investment partner, hey, sorry, the bar stopped paying. We're going to foreclose. I will pay you back your 115 plus whatever interest is owed to you, the 767 month at the time of foreclosure sale. All right. Pay them back. If it doesn't, you take it back. You turn around, list the property for sale. You do a refinance yourself with a DSCRM loan or our money lender, or you just turn around and sell it. You're going to make more money in the foreclosure REO sale, and the yield's going to be higher because of that for the most part. Just depends on time and things like that. But that's what I'm trying to get at, ladies and gentlemen. You're in a 147, 150, 135 asset for 115. Okay, you're at below 80% of value for the most part, and you're sitting in a pretty good spot. And I don't think that's going to happen. That's the thing when I say pride of ownership, that's the worst thing that could happen. Okay, pay, stay. All right. Now, one thing you got to keep in mind here, due diligence wise, ladies and gentlemen, is you're going to go through the due diligence side. You're going to review the condition of the property. You're going to find if it's vacant or occupied. It is occupied. We know this, but I'm simply saying this with any type of note deal, you're always going to check the condition. You're not going to get inside of it, but you can pull a comp. You're going to pull a BPO, have a realtor drive by it. You're going to review the collateral file. In this case, it was with an RMLO. Look at those documents. Look at the servicing notes. Looking at all the documents, making sure they're signed and notarized and all that good stuff. And of course, if they don't play ball, then you have the right to have an attorney start the foreclosure process. But have everything run by that and look at the due diligence. Now, here's one thing that most people will come back to me on this one. Well, Scott, I don't have the 100 and some odd grand to buy this. Well, guess what? Get out and talk to self-directed IRA investors, ladies and gentlemen. Because in San Antonio, in Texas, all across the country, the average dollar amount sitting in a self-directed IRA, you may not know this, you may not know this at all, but guess what? It is the average amount is $180,000 in one self-directed IRA. That's the average amount in a self-directed IRA. Some less, some more. So get out and talk to self-directed IRA investors. Pretty easy to find that in the county. Pretty easy to reach out to them. They know you know that they're real estate investors looking for deals, and they can make an 8% return passive. They're rocking and rolling. So if you'd like to submit an offer on something like that, or partner up or talk with us, hey, you've got money and you want to make an 8% money on your lazy assets, reach out to me. You can reach out to me at scott@weclosenotes.com. That's my direct email address. Yes, I answer my own email. Or you can book a phone call with me at talkwithscottcarson.com and pick out a time in my schedule that works best for you. If you'd like to learn how to buy notes, how to get into this game, how to raise capital, how to do the things that we've talked about, then you definitely want to check out our next 2-day note buying workshop. It's our virtual note buying workshop because it's on Zoom. It's all day August 29th and 30th. That's a Saturday and Sunday. And you don't have to wait till August to learn. Get signed up today for as little as $99, and we'll send you the replays to the previous 2-day workshop so you can start learning now and retake the class. Take the class again on the 29th and 30th. You'll be more educated. You'll understand what's going on, and you're off rocking and rolling. And then, of course, we'll give the replays, send the replays out the week after the 30th, so the first week of September. So if you can't make all sessions, all day sessions on Saturday and Sunday, can't make the sessions, you'll get the replays of the class and go back and watch those. That's included. There's none of this BS. Oh, we're going to charge you for the replays. No, we want you to be there. And obviously, if you can be on person in Zoom, that's great. But if you can't, the replays are available before and after the event. So encourage you. Let's get you rock and rolling, ladies and gentlemen. It's a great time to be a note investor. These types of deals are available all the time. You just got to be willing to put the work in to underwrite it and get rock and rolling and pull the trigger. So let's get you making some money. Go out, take some action. And once again, thank you for watching this episode as we're going through 50 note deals in 50 days. This is a great little case study, great little base hit. And I encourage you to check out the rest of the deals that we've highlighted throughout the last 2 weeks. We've got a lot more to go into, so stay tuned. I think we're at, this is like deal 15 or 16, something like that. So we've got another 30, 35 deals to go through for you over the next couple of weeks. So go out, take some action, everybody, and we'll see you at the top. Bye. Hey, real estate note investor, Scott Carson here. So good morning, good afternoon, good evening. We've got an interesting case study to dive into, a little bit different than what we've done with some of these non-performing ones where they're owner occupied and they haven't paid or they are paying. This is a hard money to REO case study. Now, what I mean by that, well, this last week on Monday, we got a listing of a bunch of hard money loans that the seller is looking to sell off at a discount below their unpaid balance. What? That's right. Now, if you don't know what a hard money lender is, a hard money lender is somebody's a lender who's going to lend on the value of the property, the value of the rehab, those kind of things. They use after repair values in a lot of cases. And they're not necessarily going to look at the borrower because it's usually going to be a short-term loan and they're only going to lend 65, 70% of value for 6 to 12 months. Okay. Well, we had one of our fund brokers send us a list of these 29 hard money loans across the country and included a couple here in Texas, 2 in Houston, 1 in San Antonio. And since I was driving by the property in San Antonio on Tuesday to look at a couple, I added it to my list. And then as I started diving into the list, I was like, oh, this is a different opportunity, but a great way to educate you guys because oftentimes hard money lenders are not going to sell their debt at a discount. They're already at 65, 70%. They're not going to usually sell it below what's owed because they just have the right to foreclose and they'll take the property back or sell it at auction. Well, when I literally have the broker tell me, yes, they'll sell stuff at 70 to 75% of the unpaid balance on the non-performing side, I have to sit up and take a look at it because we've bought hard money loans in the past. Would never recommend buying a hard money loan in Chicago, Illinois, or Crook County, but in Texas, it's a different story. So here's this property. That's me, my selfie there, driving by this property in San Antonio, Texas, and it's actually a nice little blue house, but when I looked at it a little bit further, it's actually 2 units. It's a 3-1, 1,400 square foot house on the front end, and it looks like it's a converted 1-1 in the back end. Used to be a shack in the back end or an ugly garage. Well, they've really done a work to clean it up. Now, this sits on a half an acre. What you can't really see from this photo is the other half of the acre. You do see the RV parked on it. The tenants, this is tenant occupied. There was 2 people sitting outside barbecuing on a Tuesday afternoon about 3 o'clock. And so it's tenant occupied. It's got tenants in it. And the hard money lender even sent over exterior photos. They didn't send any interior photos, but they did send stuff over. So let's dive into this deal so you can kind of see what I'm talking about. And what I mean by 29 non-performing notes, you can see where they're located. So you had 3 in Texas, 2 in Houston, 1 in San Antonio, some up in Ohio, okay, some in Indiana around Anderson, Indianapolis, like I like, 1 in North Carolina, a couple in Georgia, and then several down in God's waiting room in Florida, right? Now, when you have a longer foreclosure time frame, is it something you like? It can be yes and no, but this one, the ones in Texas I looked at, and I think they've got some promise, and I'll tell you a little bit more about it as we go through this thing. But this one in San Antonio, since I was down there, I was like, well, let's look at it, and we'll dive into it as we get rock and roll. Literally came in Monday night. I went Tuesday morning to look at these 6. So 3-bedroom, 1-bath front end. And then this is a photo from the back. You can see this is a 1-1. It used to be an ugly garage, but they converted into this 1-1 unit. And it sits kind of, so it's not bad. You got that chair out there, rocking chair, the barbecue pit, RV parked over the right side. I don't know if they're using an RV storage, but that half acre, it's sitting there for you to use and stuff like that. They've got junk on it. They got some cars on it. Okay, whoopee freaking dude. I'm not living there. But could be a nice little investment property. So let's go through some of the numbers here. So I'm going to say this is a non-performing note, fix and flip. Okay. Now, it was originated in March of 2024, and it was just a 6-month loan. It's a true hard money loan, 6-month loan, 13% interest only, interest rate on the mortgage. They do have a default rate of 18%. The borrower rehabbed it and has had to ask for 3 extensions. Okay. And finally, they stopped making mortgage payments. They're interest only in mortgage payment in March of this year. So they're effectively, 90 plus days behind. All right. They have a monthly payment of 1770.64, $1,770.64. That's the monthly payment. The unpaid balance on this thing is 150K, like 150.5K. All right. Like I said, tenant occupied. Now, the nice thing on these hard money loans is that they did list kind of the percentage complete. And this one's at 97% completed. If they've got tenants in both places, that's great, right? What's the other 3%? Cleaning up the yard, maybe do a little bit extra work. I don't know. Okay. Now, this did, from previous listings, I could see on Zillow, it has an in-ground pool. Looks like it was filled in as well. I didn't see the pool in any of the photos. So it must have been filled in by dirt from years ago. Now, the borrower purchased this property for 100, and then they've also put 70K into as far as rehab costs and stuff like that. All right. So they paid some of it down over time during the 3 extensions. But right now, based on the tape, there was 9K in unpaid charges. And they put the after repair value or the after repair value at 210, but the as is valued about 190, which falls in line with what we were seeing comps wise and looking online. Okay. All right. So you're at a pretty good LTV at 150K, right? You're at 75 cents on the dollar, give or take a little bit. And they wanted 70 to 75% of that number. So I was like, ooh, that's an opportunity. Bear County appraisal district shows it's a 3.2, 1,420 square foot. I mean, sorry, shows it a 3.1 and a 1.1 in the back. I got that wrong. So 3.1 in the front, 1.1 in the back is what I expect. Don't know the square footage of that garage. But like I said, just under a half an acre, and it's split kind of 2 buildings there. And so they've done a decent looking job. I can see it's gas and electric. And like I said, tenant occupied, according to what we know, the tenants are paying on time. So they're paying the borrower on his hard money loan. He's not paying the underlying loan. Now, it looks like from what I can tell, I didn't know what the rent rates are, but roughly it looks like it's about somewhere between 2,100 to 2,400 in combined rents based on comps, based on what I could find in San Antonio in this zip code with a 3.1 and a 1.1. And I went in the low end side of that. Okay. So we're just gonna say 2,100 a month in rent. So now I didn't look at this tape very closely Monday night. It wouldn't have really helped anyway, because guess what? This property on Tuesday is Super Tuesday in the state of Texas, was set to go to foreclosure. I looked at it on July 6th. It's going to foreclosure on July 7th, Tuesday, when I was out walking it. All right. And like I mentioned, the seller told me, hey, the underlying lender is looking for 75% of UPB. So if you take the 70% of the 150K UPB, that comes to a purchase price of the note for 105,000. That's not bad, right? If you could buy the note and then it goes to foreclosure the next day, that would be a really good ROI, right? So if I could have closed on this by Monday night, which obviously not going to happen, but I just want to tell you it's why you need to be raising private capital ahead of time. So you've got that quick powder, that dry powder. Now, I don't know if it sold or if it got delayed yet. I'm still waiting to find out if this property sold. I've already inquired back. It could have been delayed. They could have gone ahead and done the foreclosure of their auction. I don't know. But let's just assume I was able to pull the trigger. And I know assume is making out an ass, you mean both, but this is something to consider about in fast foreclosure options. Fast foreclosure states like Texas, Georgia. If you can pull the trigger quickly, pull the trigger quickly if it makes sense. So like on this, if I'd have bought this at 105, all right, and then immediately went through with a foreclosure auction the next day, that'd have been a 45,000 foreclosure profit if sold. That's a 1 month ROI of 42%. That's pretty good, right? And like I said, 42% in 1 month. If I could have pulled the trigger and then it sold at auction the next day, that would have been a 514% annualized return in 30 days. Yes, let that sit there. You annualize 42%, and it actually would be higher than that, because if you did this in a week, 42% ROI in a week. If I had a week for it, that's 160% in a year, a month, and then you annualize it. I'm just gonna say 1 month, okay? Because it could be honestly it'd be closer to a 2,000% ROI if you annualize it all out. If you were to buy it, close it, sold it at auction in a week, and you're sitting pretty. Now, I've had some deals like that happen where I bought the note and the foreclosure auction was in 2 weeks or 3 weeks, and we sold it at auction, bought it for 44, sold it for 88 2 weeks later. That's a phenomenal return. I love those types of deals. Who doesn't like that type of deal, right? So sometimes you can be in, be out. But if this would have sold at auction, it'd have been a very good payday. 105 grand. If you're going to make a $45,000 profit, even if you got to pay a 12% 1 year prepayment penalty on 105 grand, paying somebody 12 grand for you to walk away with 33 and some change, you're still getting an infinite rate return. It's still a 12% return for them in 1 month is 144% annualized in 1 month. Who wouldn't want to do that, right? That would have been for your private investor. Okay. Probably wouldn't want to go through a self-directed IRA for that because it would just drag things down unless it's a truly like a self-directed IRA LLC where they could wire the funds directly or uh, take it upon themselves to get it done. Not going through an equity trust or Penske. That's going to take a week to 2 weeks to get money funded. And something like this, you just need to move quickly. Okay. Now, like I said, rent rates divide come down. We figured about $2,100 a month in rent to be about $1,500 or more for the front property, probably $595 to $1,400 for a 1-1. I went in the low end because it's a converted garage there. So that's $2,100 a year in incoming rent on the low end, gross rents. And then I also looked at the property taxes, and they were like at 5,600. So we just rounded up to 5,700 a year. I'll tell you why I pulled that information because, hey, let's say it didn't sell at auction. You did make 45K at the very first auction, but if it didn't sell, now you own an REO. Now you've got an REO that's occupied with tenants in place. Could you turn around and sell the property? By all means, you could do that. But I think it makes a little bit of sense here to go through the rental side of things. I mean, if you bought it and then sold it for 190, and you lost 10% in closing costs and commissions, you're sitting at 171, you're in at 105, to say 12 grand in money costs, that's 116. That's still a nice $55,000 profit by just turning around and selling as an REO at the 190, and then willing to get some concessions and stuff like that. Tenant in place, it's cash flow. But let's go through some of things. So, like I said, waiting to find out if it's sold. Could it be a good rental property? Well, let's figure this out on some rough numbers. 2,100 a month in gross rents times 12 months. That comes to 25,200 in gross rents. Okay. Now I ran it through. I just dropped that number as the address, gross rents, the breakdown into it. And I dropped that in the chat GPT or Gemini. I can't remember which one. Said, hey, give me breakdown on rough expenses. And they said the expenses would be about 11,000 in expenses between your property taxes, your insurance, your maintenance, vacancy. So I just rounded up to 12. Okay. Because I thought their insurance was a little low. Property management is probably going to run you about 10%. So anyway, so that gives you a 13,200 net cash flow. Now, if you take that 13,200 net cash flow and divide it by 105, so you're using your own money, that's a 12.57% cash and cash return in year one if you just keep it as a rental. Okay. You're not making a lot of money if you've got to pay your investor that money, a 12%. As a rental, you're kind of breaking even if you keep it as a rental here. But what do you own now if it didn't sell at auction? Well, I own a rental. Yes, but you also own the property. It's a real estate owned. You are a bank when you buy the note. You didn't buy the property. You bought the note. And by foreclosing, it's just like Bank of America foreclosing and keeping a renter in place. I'm going to talk about why that's important and relevant in this next process. So you've got a rental that's breaking even if you just keep it there. You're into it for a 105. You got the tenants. But we know the property is worth a lot more than 105, right, ladies and gentlemen? It's worth 190 to 200, 210. Okay. So let's just go on the low end side. Could you do, since you've got renters in there paying monthly rent, could you turn around and do a cash out refi? Yes, you could. Now, here's the thing. I actually called up my buddy Hard Money Gary, and I was picking his brain and his assistant's brain about this. A hard money lender, not a hard money lender, a DSCR lender is going to want to see you have seasoning on the property for 90 days. before they're going to give you that percentage of the purchase price. Now, if you told them you bought the property for 105, they're only going to give you 70, 75. It doesn't make any sense. But since it's an REO, when I was talking to them, since it's worth 190, they would give up to 75 to 80% of the value. And that's 142,500 at 75% of the 190. And they said 80. We ran some numbers and dropped it down to 75. Okay, that's fine. The interest rate, if you've got good credit, 700 credit score, you'd get a 7.5%. If you got a little bit low, that's 620 and above, it would go to 8, but we'll just say 7.5% interest rate. That gives you a rough P&I payment of $996 a month. Okay, so just about $1,000 a month. That means if you were to do a cash out refi at 142.5, you subtract the 105 that you paid for the note, that's $37,000 in gross cash out profit. Now, the great thing about that 37, that's tax free. You're borrowing that money. You didn't sell it, you borrowed the money. So that, of course, it's got to be paid back. Now, the 37,000 is gross. So you're going to take away closing costs, commissions, title fees. There's going to be some broker fees from a DSCR lender. And that's going to vary across the board. If you're going to roll in taxes, if taxes have been paid, if you're going to prepay interest, there's a whole variety of different things that can go along with that. So don't get pissed off if you call a DSCR lender and come back, oh, it's not 37, it's 25, or it's 30. Okay, I'm just going with rough numbers. But the great thing about this is if your monthly P&I, monthly payment on the mortgage is $996 now, and rents are $2,100, you would net cash flow wise still about $500 to $600 a month between paying PITI. So ballpark spitting numbers here, you could, if you bought the note, did a cash out refi immediately, and there's a couple different things you're going to want here we'll talk about in a second. You could technically put $43,000 in your pocket in year one. Now that's a pretty good deal there. That's a 40% year one ROI. And here's the other kicker. You're only into it for 142.5. It's worth 190, 200. You still got 50K plus in equity on the bright side. Now, this is not talking about doing a cost segregation analysis or of all that great stuff that you can do since you own the property side. But that's basically, like I said, you pay taxes on the cash flow, the profit of the rental. But that's a pretty good ROI. You could still afford to pay your investor a 12% annualized return on the 105 that you borrowed. Now, here's the kicker. When I talked to Gary, Hard Money Gary, as he's known on TikTok, he was saying, I explained the fact that, well, I'm not buying the property. I bought the note, and basically I'm a lender buying the hard money loan and then foreclosing. He goes, okay, what you would want to do to get that 70, 75% of the value is you'd want to slap a lien on the property, have your private money lender slap a lien on the property for 142.5. So then it's a rate term refi, not a cash out. On a rate term refi, they wouldn't need to wait the 90 days for seasoning. Now, if you didn't have the loan, you didn't put an investor on it, you're using your own funds, or didn't have somebody could put a loan on it for you, or a lien, then you got to wait 90 days to season of owning the property before they'll reappraise it for what the value of the property is versus what you bought the note for, what it foreclosed at. Okay. So we can get more of that a little bit later on. But if you're wanting to do something like this is something to think about. And I've run into this whenever I bought notes and foreclosed. I had to wait 90 days selling the asset because the mortgage broker on the borrower side didn't understand that it was an actual REO and not a fix and flip, or it wasn't flipping the property. I was foreclosing as the lender. They just couldn't get through that. So just keep that in mind. Okay. Anyway, but can we agree that's a pretty good year one ROI? You've got a ton of equity. You're paying off your funding partner, the 105. They're getting money plus points, and you're putting 37 grand tax-free into your pocket, plus another 6 grand in cash flow over the year above. That's a pretty good. That's like printing money. You've got technically an infinite rate of return if you're using other people's money on this, give or take a little bit. Okay, so 43. That's if you're using your own funds. If you're paying off an investor at 12% and a 1-year prepayment penalty, that's still 31. You're sitting pretty, and still got some equity. And I mean, is this in the greatest part of San Antonio? No, it doesn't have fencing or gates around everything like we see in different parts of San Antonio. It is on the it's on the west side, almost directly west of downtown. And like I said, I wasn't worried about the neighborhood a little rough, but nothing too bad. And like I said, this property looks a whole lot more in that dark blue if you're looking at the video than it does the lighter blue option that was on Zillow if you were to pull it up. So if you like these types of deals, obviously there's going to be some due diligence involved. Now, what would you do in a fast time? Well, you would review the condition of the property. Like I said, that's why I drove by it immediately. I'm down there. If it's vacant, I'd be peeking in the window. Since it's occupied, I only looked from across the street. It was nice that the seller provided some photos, a 360-degree view of the photos of the exterior. All right. Property valuation, I can agree it's worth 190 to 200 without having to pay for a full appraisal. I can look at some comps. I can see, okay, valuation. I'm pretty comfortable with that 190. I mean, let's face it, folks. If it's worth 170 and they owed 150 and I'm picking up for 105, I'm still sitting pretty buying the note and foreclose. Collateral file, you'd review the docs, the loan docs, all that good stuff, and then look at the title reports. That's what's going to be the longest time on it. Would probably be to pull title if you had to do it. But you want to make sure you have the right to foreclose, making sure there's no other liens on the property and going from there and reviewing the servicing and the attorney notes. So the greatest thing is this hard money lender is not screwing around here in Texas. This guy was, like I said, due for March. So March, April, May, June, 4 months behind. July was the fifth month. And, it's a potential deal here too. I don't know if it sold at auction or not. If it didn't sell at auction, I'm definitely making an offer on it to find out. And I'm waiting to hear back on it. So there could be a potential deal if it didn't sell. As always, if you like these types of deals or like to learn more on how to partner with us on things, feel free to reach out to me at scott@weclosenotes.com. We've got different deals we've gone through the past couple of weeks, 25,000 and above, usually a good starting point. Also, if you've got some low balances, that's fine. We maybe find you a note or well too. But reach out to me at scott@weclosenotes.com or book a phone call with me at talkwithscottcarson.com. And as always, if you want to learn about note investing, go to and check out our upcoming 2-day workshop, August 29th and 30th. It's the next virtual note buying workshop. We call it Note Buying for Dummies. It's $99 to get signed up for the class. And it's 2 full days of just showing you how to find, fund, flip, and flow. And I'll probably bring up a couple more of these hard money deals like this because when you start seeing hard money lenders liquidating portfolios at below what they're paid, it screams opportunity. Yes, it also like, oh shit, something's happening out there, but it screams opportunity. And this is a way for you to take the asset back, turn it into something, have an infinite rate of return because you're not ultimately using your own money, you're using other people's money to fund it, tap into it, and then ride that wave to make things happen for you. And buying the debt, it's great because we're buying it below what people are paying for assets and waiting for. So great opportunity, guys. So if you're a fix and flipper, you're looking for opportunities or a landlord, this just might be a way for you to dive into either the fix and flip side or taking over something with tenants at a much more reduced price. As always, I want to say thank you for listening, thank you for watching, and or thank you if you're reading this as well. So go out, take some extra, buddy, shoot me an email, book a phone call, and let's go see you at the top. Bye, everybody. Good morning, good afternoon, and good evening, note and real estate investor. Scott Carson here. Excited for this episode. This is a little bit different deal than what we've been going through. Obviously, we've focused primarily on a lot of Texas assets the last 2 weeks. And as we go into the third week, I actually had a couple students reach out to me with a couple of deals they'd like for me to market. Now, we obviously did that last week with one of the Dallas sub-2 case studies. And this deal is not in the Lone Star State. It's in Florida. It's actually a deal that one of my one-on-one coaching students purchased about 2 years ago, 18 months ago, to be precise. They bought it. They got the borrower back on track. They actually filed bankruptcy, so it turned in a really great yield. What, unfortunately, as life is bound to happen at some time, they've fallen back on non-performing status. So the investor who lives all the way over in Portland, Oregon, doesn't want to deal with a foreclosure in the Sunshine State, God's waiting room. And so he asked me to reach out to me, and I thought this would be a great case study to go through some of the different mindsets when I approach a non-performing note, especially an occupied note. Now, Florida, I've bought a lot in Florida over the years, and I think this is an opportunity for the right individual. If you're not opposed to a potential 1-year foreclosure time frame or potentially rehabbing a property if it needs to be rehabbed, and going from there. There's a lot of nuances with this, and so I think this is an opportunity to dive into and how you can achieve at least a double-digit return on your money. And by double-digit return, I'm talking 15, 16% or greater, not at 11, not 10. There's some opportunities here. So let's dive into now. This property, like I said, it's for sale. It is available for purchase. As of all the notes that we've talked about in the last 2 weeks, they're available for purchase. So if you're interested, please make notes. Please reach out to me. This would be great for an IRA. This will be great if you got, say, 50K floating around as well that you want to put to work. And so some opportunities there for you. And yes, we're glad to help you out with the deal as well. So this is, as we'll say, it's a Florida foreclosure case study. Borrower is non-performing, and my investor has just started the foreclosure process. I just saw the bill, the attorney bill, to start the foreclosure process on this thing. So give you a bit of background. This is owner occupied by a couple. They've lived in there since 2008, so almost 20 years, had a mortgage, originally financed $81,000 at 8.99%. They've been paying for a while, fell in hard times, filed bankruptcy, and started paying through the bankruptcy to get caught back up. And they had done that. And lo and behold, guess what? They're getting divorced now. After the bankruptcy has been finished, they're getting divorced. And so it's an opportunity. They've stopped paying for a while. It is with a third-party servicer. My investor student has reached out through the servicing company, even sent through the attorneys, and the borrower is not responding as of this moment, which is not unheard of. Now, the details of the property. It is a 3-bedroom, 1-bath, 1,233 square foot in Mayo, Florida. Mayo, Florida is a little smaller town. It's kind of the armpit inland of Florida. Okay. The online value, $144,000. It's on 1 acre. House was originally built in 1974, but it has been updated. That's a metal roof on the property now. Like I said, still owner occupied. Like I said, it went owner occupied, became a BK, it was a non-performing, to a BK, to a performing now, and back to non-performing now. All right. Like I said, the borrowers are divorcing, and so they don't have the money to pay. Now, here it is. Like I said, it was originated in 2008, 8.99%. They currently owe, with the new attorney fees added on there, it's $56,000 legal balance. All right. That's well below. I mean, you have, what is it, $88,000 in equity. Okay. It's with Allied Servicing. They're preferred. They're supposed to be making a $792 a month P&I payment. Okay. $792 a month is what they're supposed to be paying. Well, they're obviously not paying it. I don't know how many months behind they are, but I know they're at least 90 days or later, because it's our investor has started the foreclosure process. Not our investor, our student. Okay. Now, since there is equity, let's just talk through scenarios. First of all, looking for somewhere around 80% of the legal balance, which is a pretty normal. That's at 56K times 80. That's going to come to 44.8 thousand purchase price for the note. That's at 31% of the fair market value. There's going to be some fees thrown on there, $1,200 in fees to us for helping negotiate this. But if you take the $792 a month times 12, that comes to $95.04. So if you could get the borrower back paying again, it's a 21% ROI if they start paying. Maybe they have a hiccup. I don't know how old they are, but if they can't pay now or aren't responding, and maybe they just need somebody to help them out for 6 months. I don't know the situation. That would be more for the due diligence side. But 21% if they start paying on time again, that could be a pretty good deal. It's still occupied. Okay. Now, if you have to go through the foreclosure process, okay, let's talk about that. Currently, the legal balance is 56K. Is that number going to increase over the next 12 months? Yes. But let's just say, for shits and giggles, you take the 56K minus the 46K, which is what your purchase price is and fees. That's going to be a $10,000 difference. So if you take it to foreclosure and the attorney fees are already paid in full, guess what? That's a $10,000 profit, because I bet you only bet it would probably sell at auction. Okay. So $10,000 profit on your $46,000 investment. It's a 21% ROI if it sells at foreclosure auction. Okay. Now, if it doesn't sell at auction, because Mayo is a little smaller area, there's 98,000 equity if you take it back as an REO. Now, you don't be a rocket scientist. What would I do? I would not let it go to foreclosure. I would try to negotiate a cash for key deed in lieu settlement. And I'm not going to, would I offer them 100 grand? No, I would not offer them 100 grand. Would I offer them 50K? Potentially. 25K more likely, 10K the minimum. I'd offer them 10K, but they've got to be out of the property. I'd offer them $1,000 to sign on the deed in lieu, $9,000 upon exit, leaving the property in good condition. That's exactly how I would set it up. Give them 30 days to get out. I could even up it a little bit more and say 5 and 5, because 5K would give them some moving expenses. But I'm not going to give them a huge. I don't know the condition of the property. I'd want to see interior condition. I'd want to have a realtor go out and take a look at it before I negotiate cash for keys. Okay, if the property's in trashed out, no, I'm not giving. It's not worth 144 at that point. It's worth probably close to 100. Okay, but that cash for keys deed in lieu avoids you taking the foreclosure auction and only getting 10K at the auction. Now that I would highly encourage, like, hey, let me give you some cash for keys. The investors already offered it, but they've not gotten a response back. This literally just happened about a week and two ago. So he offered 3K, no response back yet from the attorney on that. So that's a potential option. I would maybe go a little bit higher. Okay, now I think he is also a little bit limited by what's in his self-directed IRA too. He funded this with his self-directed Roth, so I'm not sure how much is in his IRA that he could offer that. He couldn't offer cash outside of that because that would be a violation of his IRA, right? Self-dealing. So for somebody to come in with cash or more money, this is an opportunity for you to, hey, he's going to make a little bit of money in the 46 above what he paid for it. He's got some cash flow. That's the opportunity then to talk to somebody. Okay. Potential cash for keys deedling. Now, could you also try to work out a payment plan with the spouse, husband, or wife, whoever's going to stay there? Yeah, you could. You could buy this note at the 46 and then work out some sort of trial payment plan. Reach out to me. Listen, hey, I know you're upside down. We're not really upside down, but you're going through a rough time, a financial hiccup. How about we work out some sort of trial payment plan for a period of time? If you'll start paying on time, we'll delay the fortune. If you pay on time for 12 months, then we can recast your loan. If you only make a payment and then stop paying, we're going to return your payment and finish the foreclosure. Okay? So if you wanted to get a 16% ROI, if you're using other people's money at 8%, it still gives you some opportunity there. If you take the $46,000 purchase price fees to purchase it times 16%, that comes to $7,360. That's the number you would need to get in cash flow in a year to see a 16% return on your investment. That's not including servicing costs. I'm not figuring that in there right now. Okay. So take 7,360, divide that by 12 months. You would need to see a payment about $613.33 per month so that you're getting a 16% cash and cash return in that first year. Okay. That reduces the payment by 22%. That's a pretty nice trial payment plan. Okay. Hey, we're going to just do an interest only payment. We're going to drop this down to $613 a month, $1,633 a month. I don't know what taxes and insurance on this thing. That would be figured out in due diligence. But what I will offer you, if you make payments on time for 12 months like that, then what I will do at the end of 12 months, since it's now a performing loan, is then I'll recast the loan. I'll make it a 15-year loan. I'll take the 58K that you're behind on, or whatever that number is, and I'll reclassify it as a 15-year loan at 9%. I'm not going to adjust the interest rate because you're not going to give somebody an interest rate they can't get. All right? Because if they've been late and it's been reported credit, they're not going to go get a traditional loan. They're not going to get a traditional loan being at really under 100,000 either. Okay? But the great thing, if you get them to recast the loan and they make that year of payments, it's now a performing note. Let's recast it, 15-year mortgage term, 58K, 9%. That drops the P&I payment down to $588.27. So you drop it another $25. $588.27 times 12 divided by your $46,000 purchase price is a 15% cash on cash return in year 2 and beyond. Now, if you can get them to bring some money to the table in that first year, great. If you can't, they can just start making payments again, great. But it's just a forbearance agreement. It's just a trial payment plan. If you stop making payments, you're going to have to return the funds to them because you don't want it to recast the statute of limitations. If they're already behind by 90 days or 120 days, you don't want to reset that. So you would instruct your servicing company, you're going to hold these payments for 12 months. If they stop paying, then we're going to foreclose and refund back these payments so that we can foreclose. All right. Now, could you get away with doing a deed in lieu without giving them any cash? Maybe, but I think with somebody's got about 100 grand in equity in their property, because what are they doing? They've gone to Zillow, they looked at the values. Values can be all over the place, but you know, it's not a bad looking property, based on what we can tell from the previous BPO from a year ago. Now, the nice thing about this too, let's talk about some of the risks. Okay, it's a 1 year foreclosure time frame. The cash for keys option, the borrower's divorcing. You got a lot of emotions in there. You need somebody to talk to. Now, Mayo is not the biggest city in Florida. I think it's 2,000 people. Okay, but it's on a 1 acre lot, and people are liking that. Okay, not the biggest property, but 12.3. Hey, that's not a bad area, wooded area lot. Okay, this is the reason I bring this up is because when you looked at the previous BPO, I know it's 18 months old, but I'm just simply saying when I looked at the previous BPO, days on market for similar properties that sold was at 30 days and less. Okay. Plus, the value has increased in 18 months from the original BPO value of 75,000. A 30-day quick sale price 18 months ago dropped the value to 69. But it said it was worth 75. That was an external BPO. Somebody's living in it. So that's what you look at. If value's 144, great, it's gone up. Almost double. It's gone up by a huge chunk, 88% in the last 18 months. So that tells you something. Of course, what would I do as far as due diligence? I'm going to obviously review the condition of the property, send out another BPO agent. I'm going to try to make contact with the borrowers. I'm going to review the legal documents, stuff like that. I'll make sure somebody's living in the property. Okay, making sure the props, the comps show up where it's over 100. All right. Review the collateral file, the documents, all that stuff. That's all pretty easy to do. Pull a quick title report, just seeing if there's any other liens on the property, making sure you have the right to foreclose, make sure there's not a second on the property, anything like that. And of course, review the servicing notes and the attorney notes from the foreclosure, the collections, and any back and forth on this as well. And actually, pretty much already have that. Sterling, our investors and coaching student, he's got a clean file. Like I said, it's all been with Allied. He can easily get the updated payoff, the attorney fees. You can see how far they're gone. All that stuff can be handled in due diligence. So if you like this opportunity, hey, here's an opportunity for you to potentially double your money in at 46, maybe get out at 92 and sell it on a quick cash sale if you needed to. If you need to put some rehab and sell it at the peak, there's an opportunity for you to do that peak there. But I think the play makes sense on this to either buy it and try to approach the borrowers on a trial payment plan or the borrower to get them back on track for a period of time and then keep them in it. Let me drop the payment down, but still you're going to be in a good yield, 15% or greater, or work with them for cash or keys, 10, 20 grand, depending on the condition of the property, and get them out of the property and move on from there. Because here's the thing. If days on market are 90, 120 days, that's not a bad thing for you. It's a bad thing for them because that foreclosure time frame is already ticking. If it's going to take 4 to 5 months to sell it at the peak, you're going to be pretty close to that foreclosure time frame. So I would not pause the foreclosure auction at all. I would keep rock and rolling. The only thing I would suspend it during that trial payment period. I would suspend it for 6 months. They made 6 months on time. Great. Keep going with another 6 months. You can always restart it. That's the big thing. Always restart it and rock and roll from there. Okay. So if you're interested in making an offer on this one in mail for, just reach out to me directly at scott@weclosenotes.com. That's scott@weclosenotes.com. That's my direct email address. You can always book a phone call with me by going to my schedule. I'm glad to tell you what I know. Talkwithscottcarson.com. There's a $1,200 fee on this deal. Could you offer below the 80%? By all means, you totally could if you want to do that as well. So something to think about. As always, guys, I highly encourage you to check out our upcoming 2-day workshop. And the next class is August 29th and 30th. That's a Saturday, Sunday, all day Saturday, all day Sunday via Zoom. If you go to notebuyingfordummies.com or go to weclosenotes.com, click on the education, you'll see that available. As always, go take some action. And we appreciate taking time out of your day to listen, read, or watch this new case study in the 50 note deals in 50 days. Have a great day, and we'll see you all at the top, everybody. Bye. Good morning, good afternoon, and good evening, everybody. I hope you're having a great day. Scott Carson here. We have got another deal to talk about on our 50 deals in 50 days. This is a property in the San Antonio area, northeast San Antonio area, basically Converse, Texas is actually the street address and everything like that is. But this is a cash flowing performing note that is available for sale. And I thought I'd break down the case study and talk about some of the good things. Now, I actually walked this property just recently on Tuesday. So whenever you're listening, I think this comes out on a Tuesday. So it would have been a week ago when I walked it and been running the numbers and stuff for you. But here is kind of the scenario. It's a nice looking house. That's actually my photo that I took itself. Got it's on a corner lot, big backyard, nice neighborhood, and really manicured and taken well care of. So you've got a lot of pride of ownership with this borrower. It is to give you a bit of an idea. It's a red dot here, so it's on the northeast side of San Antonio, just north of the 410 loop, over not too far from the Randolph Brooks Air Force Base up that neck of the woods. So and great little area, growing area of San Antonio. San Antonio's grown pretty big. I think it's actually probably a little bit bigger market than Austin, Texas is for the most part. It's spread out a little bit more. But anyway, it is east of I-35. But anyway, it is a 4-bedroom, 2-bath, 2,334 square foot house. It was built originally in 1997. It's on an 8,300 plus square foot lot, so normal lot size in that area. The current fair market value is 223. Now that has dropped down a little bit over the last couple of years, just because that area has kind of dropped, had a price correction at one point. BPO from about 2 years ago is at about 240, but it's holding steady of that. I know that area because I bought a note, a performing note, not too far from this property, just a month or two ago. The unpaid balance on this is 168,000. It was originated originally back in 2004 at 87,000. So people ask, well, how did the UPB increase by 80? Well, they did go non-performing for a while. All right. And the borrower actually filed BK Chapter 13, which is a get back on track, in September of 2021. The loan was modified in March of 2022. So they took the back payments, everything they were behind on COVID, and basically did a forbearance agreement, readjusted some things, and modified the loan in March at 4% interest rate. And they did it for 458 months as the new term. There are still 408 months remaining. So you've got a obviously 30 plus year term on this on a performing note. Now, are you going to hold on to this for 30 years? Probably not. All right. Now the P&I payment on this principal and interest payment is 757.72 per month. And the taxes and insurance are escrowed with a third party. So that the property taxes, the insurance, that's all being escrowed. Is shown in the balance actually that I saw at the tape, is that they are paying monthly into their escrow account, which is great. Not a negative escrow, a positive escrow. Okay. So that's a good thing. Property taxes, insurance are being paid and taken care of and rolled into that. Now, like I said, it is a performing note. It was once non-performing, but they've been performing now for over 4 years. And the great thing about this, the current LTV of the balance to value, you're at 75% LTV. That's pretty good. That's a pretty good spot there for the borrower to be with some equity. Now, if you buy it, since it's a performing note, I wouldn't, normal is about 80% since there is equity. So 80% of the UPB. That's a purchase price of 134,400. You add my fee on there, you're going to be paying basically 136 as your investment, 136,000. So if you take the 757.72 multiplied times 12 months, comes to 9,092 in cash flow on an annual basis. You take that 9,000, divide that by 136. As far as your investment, comes to 6.7% ROI. Now, I get it. That's a little lower than most people are thinking out there, right? But you're sitting at such a low investment to value. If you're in at 136, that's at 61% of the investment to the value, meaning the 136 to the current valuation of the 223, 224. All right. It's a pretty good price. Plus, there's also a $32,000 difference between the purchase price and the unpaid balance. So if they do sell the property in a couple years and cash out of the deal, you're sitting pretty good. If they go refinance, you're sitting pretty good. Now, they've got a 4% interest rate. Are we likely to see them refinance into something lower? Probably not. Could they do a cash out refi, pull some equity out of the deal? Yeah, they've got a little bit of room for that. But this is the thing is I'm looking at this thing. This is going to be much more of a quality, on time. You're at a low investment value. If something goes wrong and they stop paying, then you're definitely going to cash in about another 20% difference between what you bought the note for and the payoff. Now, that's provided that you can get it at 80% of UPB. I think if you're looking for an 8% ROI on the 9,000 a month coming in, then your purchase price would be around 113, 114 to get that close to 8%. Now, I haven't deducted servicing costs on this yet. So your ROI would be a little bit above 8%, so you'd be right about that 8% mark on your cash. Now, like I said, we've talked about this before. If you're waiting around for a 12% return and you haven't done anything in 6 months, guess what? If you put your money into something like this and you're getting a 6% for the next 20 years, you're doing pretty good. Not that it's going to take 20 years for it. I doubt that would happen. But anyway, you've got a pride of ownership. You're at a low investment to value. You're a pretty safe, secure deal in case something wrong. You foreclose. It's in a fast foreclosure state of Texas. You can be, stop making payments for 90 days, you foreclose, and you're making another 32 grand at the auction if it's sold at auction. If not, then you're into a property for the full value and you've got an REO and do whatever you want with it. So possible opportunities here for you guys. You've got 140 grand sitting around the sidelines and wanting to put to work and get a decent return for your money. This is a pretty solid return for you with a great investment to value, lower than normally, and you'd be rocking and rolling and go from there. If you'd like to make an offer or find out more information, always feel free to reach out to me. Obviously, there's a due diligence period if you're making an offer. Obviously, you'd want to probably pull your own exterior BPO. But when I drove by the property, it was in really great shape. It is occupied, it's not vacant, so that makes it even better for you. But you want to pull your updated values. Whenever you see this or whenever you're pulling stuff, you still want to pull your own values besides just Zillow. And that's what I'm just pulling values off of very, very quickly. I do got an older BPO, but it's over a year old, so we don't go off of that. Obviously, we review the collateral file, the payment history, the servicing notes, the attorney notes, and making sure all the documents there so you do have the right to foreclose in case they do stop paying. But like I said, ladies and gentlemen, not a bad, pretty little base hit there for you on a regular basis. If you're looking for something to offset maybe your higher investments, that's a pretty good hedge to get things rock and roll if you're in the higher side of things on your Bitcoin or other types of investments for you. So, as always, if you'd like to make an offer, talk more about it, reach out to me at scott@weclosenotes.com. That's scott@weclosenotes.com. That's my direct email address. Or you can always book a phone call with me at talkwithscottcarson.com. That's talkwithscottcarson.com. Now, we do have an upcoming workshop, August 29th and 30th. Our virtual note buying workshop. You can get signed up for a ticket for just $99 by going to notebuyingfordummies.com. That's notebuyingfordummies.com. And we're always here to help answer your questions and help you take your real estate investing to the next level. So, when you look at $757 a month in the cash flow coming off it, that's a pretty good chunk of cash flow for you. When you look at if you've got rental properties and you're making $200 a month and all the extra work, you're probably negative. So here's a way to step into $757 without having to do any work. You can keep the existing servicing company, just step into the payment stream. It's something to think about for you as well. So let's talk. Let's go out and take some action, everybody. Have a great day, and we'll see you at the top. Bye, everybody. Good morning, good afternoon, and good evening, real estate and note investor. Scott Carson here with another great little deal for your IRA or lazy assets. This is a performing note down in Leva La Valley of the Rio Grande Valley of Texas. This is down in McAllen, Texas. Now, if you don't know where McAllen is, it is down south of the border. It's actually a 5-hour drive south for me. If I were to drive from Austin, Texas, it would be 5 hours to get straight down there, going down 35, 37, and a few other ways there through Corpus Christi and Kingsville, or I could fly down there to Harlingen, which is the Valley International Airport. And the Harlingen is about 45-minute drive east of McAllen. Now, got a lot of people down there. I get a lot of snowbirds from Minnesota and colder states during the winter. Actually, my aunt actually spends her summers, well, actually not her summers, her winters down in Harlingen and McAllen. Loves that area. The cost of living is a whole lot less. Plus, it's a whole lot warmer than, negative temperatures up in Minnesota. It's just a handful of snowbirds that go across there. So definitely a lot of great opportunities down that neck of the woods. Yes, of course, it's right across the border, but not a bad area for if you know where to buy. Of course, you always want to buy in an area that you're fine owning that property. If you have to take it back. Now, this property, it's not the biggest property. This is actually I had the square footage wrong. It is occupied. This is a photo, actually from about a year, 2 years ago on it. The most current photo showed a van. It's still occupied, but it didn't have as much green foliage. It looked like it was the middle of the dead of summer. But anyway, this is an occupied property. Bar is still living according to the notes on the spreadsheet and what I can find. Taxes are paid up. It is a small little 3-bedroom, 2-bath, we think 1,396 square foot, built in 1972. It's on a fifth of an acre lot. Now, the values on it were a little across the board. One website showed 143, another one showed it closer to 200. I'm going to probably put it closer to 143 to be very conservative on this. Okay. If it's worth 200, great. You're sitting pretty good. But even at 143, you're sitting pretty good because the loan was originated back in 2005. Borrower modified it, I think, in March of 2021 or June of 2021. So they've been paying on it for about 5 years straight, which is great. It's a performing note or a very substantial reperforming one, right? Legal balance on this is only $47,000. P&I payment is also a nice, attractive $480.80 a month. The interest rate is at 4%. Now, it's a 15-year mortgage, 119 months left available. So you've got 10 plus years, almost 10 and a half years left on it. I love that there's at least $96,000 in equity in this deal. And I also like the fact that it's with third-party servicing company. Now, the online shows it only being 396 square foot. There's no way this is just 396 square feet because the building does go back. That's not saying it was once 396 square foot and they've added on and just not updated it. But somebody's living it. Somebody's making the mortgage payment. Somebody's paying the taxes and the insurance and the escrow and stuff like that. So definitely an occupied asset and a nice little chunk of change at $480 a month in cash flow. Now, what would I do with this? Well, if you figure since there's a ton of equity, paying at 80 cents on the dollar is 47,000 is what 80 cents take your, your 80 cents on, so $47,000 legal balance, sorry, times 80 cents on the dollar, it's going to come to 37,600. Add a $1,400 fee to me on the deal, you're going to come to an even $39,000 acquisition price. So great for a little IRA for you. You take that $480 a month times 12 months, that comes to $5,770 in annual cash flow. Divide that by 39,000 acquisition price. That's a 14.8% ROI on this performing note. Not a bad day. Now you reduce the $400 off for servicing costs, $30 a month, $35 a month from a servicing company. That's going to drop your ROI down to 13.8. That's still very attractive, especially since you're sitting at roughly 33% of fair market value on the high side. If it is worth more than 147, it's closer to 200, you're going to be sitting down closer to that 25%. Now, I always say, look, if it's sitting pretty good and there's got a ton of equity, it's great for the cash flow. It's great for a 14.8% ROI or 13%. But as I always like to do, if they've got a low interest, they got a ton of equity, you may want to see about getting them to refinance. So if you could get them to refinance out in 12 months and pay you off the 1 year of cash flow, plus the $8,000 you'd make in the difference between your purchase price and the payoff, that's a sizable little chunk of money. It's about $14,000. That's a 35% ROI if you can get them to refinance in the first year. Now, what are the risks on this deal? Obviously, the borrower defaults, unlikely to foreclose on the property because A, they have all this equity. But the idea is to buy it as a mortgage, buy it as a note, hold it for cash flow, and then, like I said before on our previous deal in El Paso, work with a mortgage broker to get you to refinance you up. Tap into that equity. Now, on this one, both borrowers are in their mid-60s. So this borrower could potentially qualify for a HECM loan, a reverse mortgage, pull some of that equity out, not have to make any monthly payments on it, put a chunk of equity. It pays you off, and that definitely is going to boost your ROI up as well, too. So that's something I would work on and align yourself with a good mortgage broker that understands cash out refis, HECMs, high equity convertible mortgage, or as we call it, reverse mortgages, as a way to help offset that debt to the borrower. So something to think about there for you, ladies and gentlemen. As always, you're going to perform your due diligence on this deal like you would anything else, pulling an extra BPO, pulling title reports. You're always going to have somebody drive by the property. Make sure it's still in its good condition. It's been a couple years since photos. If you send somebody by the property and it looks like ass, don't buy the property. If it turns out to be vacant, you may not want to buy it. If it's occupied, still great. Then somebody's taking care of the property, not really worried about repairs needed because there is so much equity in this. But I would want to get a little bit higher evaluation done on the value, knowing if it is worth the 147 or closer to the 200,000. Of course, you're going to review the collateral files, any documents, loan docs, origination docs. You're going to review the title report, making sure there's no outstanding liens, that you would still have the right to foreclose, and review the servicing and the attorney notes. There's not going to be many attorney notes because the borrower's been paying on time, but the servicing notes would come in handy to see just how on time they are. And like I meant to say earlier, they have paid 12 months of payments in the last 12 months. So if you're looking for these types of deals, this is a great little double-digit ROI. Could you borrow money at 6% and use 6% OPM to fund the deal and put some money in your pocket? By all means, you could do that as well. It's just about talking with your investors and going from there. But anyway, if you'd like to make an offer, take it to the next level, then let's jump on the phone. Submit your offer or to talk about partnering, because we do have opportunities. Reach out to me at scott@weclosenotes.com. That's my direct email address. If you'd like to book a time to talk on my schedule, you can do it by going to talkwithscottcarson.com. That'll take you directly to my line to credit. We can book a phone call or a Zoom call to talk more about it. And we are always here to help answer the questions and help you understand how to do this business if you're brand new to it. Now, if you're seasoned, hey, let's talk about how to get this thing rocking and rolling for you and put a double-digit yield into your IRA or get your lazy assets making a great return. As always, if you want to learn about buying and investing in notes, you can go to our virtual note buying workshop at notebuyingfordummies.com. Our next 2-day class is August 29th and 30th. That's a Saturday, Sunday, all day Sunday via Zoom. When you sign up for 99 bucks, not only do you get the replays, you get the 200 plus page manual and the 2-day full access to the class, and the replays as long as you need them. We'll send you the direct files. So if that helps you, let's get rocking along. Let's help you make some money in 2026 and make it the most profitable year yet. There's a lot of opportunities out there, ladies and gentlemen. If you're sitting on the sidelines with money at 0% accounts, let's put it to work. Let's get you making 8, 10, 12% or greater and make it a profitable day for you. So go out, take some action, everybody, and we will see you at the top. Good morning, good afternoon, and good evening, everybody. Hey, welcome to this next episode of the podcast. Hope you are rocking and rolling around. We are really diving into a lot of stuff that I think is some pretty good base hits, cash flow for you guys and gals out there looking to put some passive money to work. Whether A, you're buying the note, or B, looking to partner with some folks out there like us to help you achieve an above average return on your, I said, lazy assets or your IRA. And so this is I think, a great little deal out in El Paso, Texas. Now, El Paso, we often joke it's the part of Texas that we would rather give to Albuquerque because it's the only part of Texas on the mountain time zone. But as wide as Texas is, it makes sense. Now, El Paso, yes, it's got a little bit more of a deserty thing. I keep thinking of that older country western sound, down in the valley of the city of old El Paso. But it's actually a pretty good sized town. We are seeing more distress out there. You could call it a border town, not only bordering with New Mexico, but also bordering with Mexico as well. But a lot of people live there, a lot of opportunities, I believe. Also, it's a not too far plane ride from Austin, Texas, or Dallas, Texas. Southwest does fly through El Paso. So it's I hadn't really mentioned that before, but it is a major city in the Lone Star State with pretty easy access to it. But let's dive into the numbers behind this one, because this is another owner-occupied base hit, maybe even a double, for those out there looking to put some money to work here on a property that's got some pride of ownership and is owner-occupied. And it is not the biggest property. You can see this. This is actually a photo from 2 years ago. It's the most recent photo I could find. And it's occupied. The borrowers are paying on time. It's, this picture was taken during the middle of summer, so everything looks dead with the heat. But it is it's not the biggest property. 3-bedroom, 1-bath, 888 square foot. It was built in 1971. It's the original owners. Just so you guys know, out in El Paso, they do put the air conditioners up on the roof, not on the ground. So don't be surprised to see that. I like seeing that the AC's there, right? It's a 6,000 square foot lot. Fair market value of this is about 170 plus. I put 170 on the lower end just to be conservative because I don't have a relatively newer photo of the property. But it originated in 2007 and it was modified in December of 2020. So they've been paying on time for 5.5 years now straight. Legal balance on this is at 58K. What I like about it is the P&I payment is a nice chunky $490 a month. That's right, $490 a month. It's got an interest rate of 3.25. Now, it was modified because they fell behind during COVID, stopped paying. Well, they modified. It's a 30-year mortgage, and there is 134 months left. So there's 11 years left to receive payments on it. And they've got a nice whopping 112K in equity on this deal. It is being handled by third-party servicing. It is a little elderly folks on there. One of the borrowers is in their 60s, one is mid-50s. And they've lived there for a long time since they bought the house, over 20 years now, basically. We're right at 20 years. So let's talk about it. So it's performing, and there's a ton of equity. It's over 6K, 6 figures in equity. So if you were to buy this note at 80% is where I would say that the fund's probably going to start off. You take 58,000 times your 80 cents on the dollar. That comes to a purchase price for the note of 46,400. You add my fee in it of 1,600, it rounds up to a nice even 48,000. Now the 490 a month, that's the P&I payment, times 12 months. They've paid 12 months for 12. That's going to bring in a gross of 5,880 in cash flow. The 5,880, divide that by your acquisition cost, which is the 46.4 plus my fee, so the 48,000. That's going to come to a very respectful 12.25% ROI. All right. Now that's without servicing costs deducted. Take away your $400 a year if you have it with like $35 a month servicer. That's going to drop it a full point down to 11.25% if you're keeping it with the existing servicer or have it your own servicing company. So that's really more of your true ROI there. Unless, I mean, this Texas you could self-service. I would not recommend that. Okay, especially if you're using a third-party servicing, or if you're using your self-directed IRA, you definitely want to have a third-party servicing handling that, so you're not violating anything. Now, they're only at 34% fair market value. So they've got a ton of equity, as we talked about in the previous slide. When I see something like this, I start to look at, okay, if we get a year of cash flow, what would I do? With a ton of equity in the deal, my goal would be to try to get these borrowers to refinance and do a cash out refi. 150s, 160s. You couldn't necessarily do a reverse mortgage because you need both parties to be over 62. But it does give them an opportunity, hey, let's refinance out your mortgage. Let's put a little cash in your pocket, 50 to 100 grand in cash, and you're sitting pretty good. If you do another 30-year mortgage, your P&I payment's going to be well below the 490 a month, or right around the same price point for you. So that's what I would shoot for if you do that, where you get 12 months of cash flow and then get them refinanced out in 12 months. That's a nice whopping 32% ROI based on the difference in what you paid for the note, the 10K difference, and the 58 or the 5,400 coming in. That could be a very nice ROI, which is not necessarily an 11-year study. Now, if you did it, it took 2 years to do it. Okay, you still make a pretty good chunk of change. It'd be something in mid-20s. Actually, you'd split it. It'd be closer to 21% if it took you 24 months for them to refinance. But that's the opportunity. Now, what would I do? The risks involved with this? Well, the risks are for this deal is the borrower defaults. Well, they're unlikely to do that because they haven't done that yet. But if they did, they stop paying 90 days. You have the right to go ahead and foreclose on the property, and you're going to make 10 grand or more at the foreclosure auction. If it sells at auction, if it doesn't sell, then you're taking it back and you have an REO worth 140 that you're into it for less than 50. Okay. But my biggest strategy on this would be to buy as a note and then work with a mortgage broker to refinance you out. There's nothing wrong with the 490 a month coming in. That's great. Right. But I would start working with a local licensed mortgage broker to start reaching out to them. The loan needs to be more than 100 grand or more to make it worthwhile to somebody. So doing a cash out. Now, could they go get a line of credit from a bank and tap that? Yeah, they could, but the line of credit's going to be probably more expensive than a mortgage rate is for you. So anyway, I would work with, like I said, a private mortgage broker here in Texas to help with the drip marketing campaign, sending them different offers, maybe offering a no fee refi where you cover maybe some of the cost, a little bit of the closing costs, so that you get paid off sooner and your ROI goes through the roof. And you put an above average return into your IRA. Now, like I said, this could be an 11%, it could be a 30% return on investment. All depends on which way the wind blows with you and the borrower out here. But this is an opportunity. Um, like I said, they've lived there for 20 years. I don't know what kind of interior condition is. There's going to be due diligence you do. And obviously, you're going to review the condition of the property. You're not going to get interior access, but I would send somebody out to drive by the property, making sure that it is what it looks like. An occupied property, no internal access, but guess what? If it's looks better than it did on that one photo, then you're sitting pretty good, and the value is going to be more than the 149. All right. And that's the thing. Always know what your values, know what your comps are, and going from there. You're not buying this to take the property back. Taking the property back is plan C down the road. I would go, like I say, cash flow, refi, and then foreclose if they don't pay. Obviously, you're going to review the collateral file, the documents, the assignments, the allonges. You're going to look at the servicing notes. You're going to look at title. If you were to buy this, make sure you have the right to foreclose or the right to collect payments on this stuff. And you're going to be utilizing a servicing and attorneys to do this. But your due diligence up front's not going to be that much. We're talking a BPO O&E, less than $500, and you'll be off rock and roll. And it could put a 490, $460 a month into your IRA as far as monthly cash flow. You're not going to get rich, but $5,000 coming in is pretty good for something that's a passive investment for you on less than 50 grand. As always, if you'd like to submit an offer, talk more about partnering on a deal like this or finding a deal for you, always reach out to me at scott@weclosenotes.com. That's my direct email address. Or you can go and book a phone call with me at talkwithscottcarson.com. Now, look, if you're sitting on the sidelines and you've got 25, 50, 100 grand, and you want to make a good return, please reach out to me. If you're sitting around and waiting 3 months for the perfect deal to come through, guess what? If you'd have pulled the trigger 3 months earlier, even at a lower interest rate, you'll be making more yield than you would waiting for the perfect deal or your higher yield looking for. Sitting around doesn't solve anything. So reach out to me and let's book a phone call to talk about it. As always, if you want to learn more about note investing, you can always go to our Note Buying for Dummies workshop. That's notebuyingfordummies.com or to our website, weclosenotes.com. Our next 2-day class is August 29th and 30th. That's a Saturday, Sunday, live on Zoom from basically 9 to 7 a.m. 9 a.m. on Saturday, Sunday, wrapping up each day about 7 o'clock. So I think tickets are as little as $99. So let's take you to a whole different level in 2026 and beyond. Let's show you how to become a lien lord, not a landlord. If you've got money sitting on the sidelines, let's put it to work so that you don't have to work so hard out there. You're losing money and fees, and you're sitting around. Opportunity costs are pass you by. If you want to make a double-digit return, here's a potential opportunity for you. So go out, take some action, everybody, and we'll see you at the top. Thanks for listening and watching. Good morning, good afternoon, and good evening, note and real estate investors. Welcome to another episode of our 50 Deals in 50 Day Breakdown. This one comes from the land of West Texas, the landman part of the country, if you're familiar with the not Tommy Lee Jones, but the amazing show on Paramount where the main character is Tommy, which is Billy Bob Thornton. Actually met Billy Bob once before, back down in Greenhall years ago. But this is a West Texas performing, maybe non-performing wise. I'll get into it in a second, but this is a deal I think has got some definitely merit, some opportunities. And even though it's out in West Texas, it's not all tumbleweeds and dust storms. All right. But I thought I've been waiting to use an image like this for a while. I thought, it's an appropriate one for West Texas notes. Now, this asset, this note is a first lien, and it is out in the Texas city town of Odessa, down in Odessa, Permian, Mojo Magic. All right. And this is the house. This is the Street View house from 2 years ago. You can see a lot of pride of ownership. You've got the planters with the plants. You've got the chairs outside. It definitely looks like an older couple with those older awnings. Obviously, the house looks like it needs some work, but there's a basketball hoop. I don't think I see the ballers dunking on anybody anytime soon, but I think it's for the grandkids. From my due diligence, if you do a little bit closer intake to it, I believe it's an elderly couple, and unfortunately, I think the husband may have passed away just like 2, 3 months ago. But when I see a photo like this, yes, it looks like it needs some work shingles, it needs some siding work, but this is all cosmetic work. It's in pretty good shape. And besides being outdated, you're going to run into that sometimes. But the whole point being, if you're buying notes, is not necessarily to end up with a property. In this case, is it going to make more sense? Are you going to make more money if you end up with a property? Yes, you will. But let's dive into the numbers and go through the scenario. Now, if you don't know where Odessa is, a lot of people think it's like smack dab out in the middle of Texas. Odessa is not smack dab out in the middle of Texas, okay? It is a 5-hour jaunt to TCU or Fort Worth from Odessa, where this property is located. And by sharing the map, you can see it. Like I'm way down here in Austin and Round Rock area. If I were to drive out to Odessa, it's still a 5-hour trip. So the big fictional part of Landman, that show in Paramount, is that, oh, it's a 2-hour drive to Fort Worth or Dallas from where he's at out in Midland. No, Midland is still 4+ hours to Fort Worth. But you can see it's closer to Hobbs, New Mexico, and Carlsbad, New Mexico. It's right down there in that 90-degree angle between Texas and New Mexico. But you know what? I've been out there before. It's not a bad city. It's a bigger city for West Texas kind of thing. It's not as big as El Paso, but a lot of boom going on there. People live out there. I've been out there before. Really salt of the earth. I went to school actually for a year in San Angelo, Texas, which is about an hour and a half east of Odessa. But anyway, so let's get into the details. This is either a 3-2 or a 3-1 home at 1,261 square foot. It was built in 1950. It's on just under a fifth of an acre lot. Now, the fair market value of this property had it up closer to 200. I think more as it sits more, it's probably closer to 150. Obviously, online values often will go with the best ones. This one obviously needs some TLC if you were to take the property back. But the original note originated back in 2009. Borrows it for 12 years, and then they modified in March or April of 2021 when the COVID modifications. It was then modified to a 20-year mortgage at that point at 6% interest rate. The legal balance is at 38.5. Okay. Now that I'll tell you that there might be a little bit more than that with some missed payments and stuff like that. But the P&I payment, part of it is $328.34 a month at a 6% interest rate. Like I said, 20-year mortgage with 117 months left on this. So they're just over halfway through their 20-year mortgage on. Now, like I said, it is owner occupied from what I can tell. They may be 30 to 60 days behind on this. As I did a deeper dive into due diligence and looking at the borrower's information, I can understand why they might be behind with a death in the family. Now, both borrowers are obviously retirement age, so they may have been caught up by now. They may be behind. Either way, I would kind of treat this as a performing note, and the pricing point still makes sense for what we'd have to do because there is a ton of equity above, over $111,000 in equity above that legal balance, roughly a payoff balance of around 38.5. So it's still priced the same. You're not going to get a bigger discount because they're 60 days behind. You would if they were upside down, but not so much if you got a ton of equity there. So bidding at 80 cents on the dollar at 38.5 times 0.8, it comes to a purchase price of 30.8 thousand. Add on $1,000 fee to me. That's you're right at 32,000. So if you take the 328.34 times 12, it's going to be equal to 39.40. That's what you would get in cash flow if they started paying 12 for 12 months on time. Do I see that happening? Maybe yes, maybe no. I don't know yet till we would do the due diligence. So we're going to assume, and I know assume stands for an ass out of uni both, but let's just talk through this, okay? So if you take the 39.40 and divide that by 32,000 of what your investment is, that would be a 12% return on investment. Take away $400 in servicing costs just for servicing it with a Madison Management, an Ally, somebody like that. That's gonna drop the ROI down to an 11% ROI. Okay. Now it's only at 25% of fair market value. Now, if they were to start paying on time, they started paying 12 months plus technically the 2 months behind that that's a 14% cash and cash return if reinstated the first year. After a year, if they're keeping on time, it would drop down to a 12%. So while it's not ideal for a funding partner, this still is a pretty good deal if you're going to be a solo note buyer on this. If you're going to take this deal down and go that route, you're going to sit there and do okay. Now let's talk about the foreclosure process. 12% is nothing to laugh at. especially if your IRA has been making zero. Okay. Pretty secure and nothing to go but upside in this. All right. So if they stop paying and you have to foreclose, all right. So you take your $38,500, the legal balance, it may be a little bit higher by now, minus your investment of the 31 plus the fees, 32. That's roughly going to be 6,500 in gross foreclosure profit. You take away $1,000 in foreclosure costs, give or take a little bit. That's going to be 5,500. 5,500 divide your investment of 32 comes to a rough 17% ROI. Now, that's assuming if A, they haven't paid another month's payment, now they're 90 days behind, now you can foreclose. Okay. So that's 17% ROI in 6 months. That's a 34% annual return on investment if it sells at the foreclosure auction. Okay. That's not a bad return. And I say 6 months to foreclose. You got potentially 2 months behind now. Another month gets to 90 days. And then you're looking at 60 to 90. I mean, you can foreclose quickly in Texas, but 60 to 90 days to foreclose is as potential REO. Now, that's if the borrower is non-responsive on this. Depending on their age and what they have, there's a couple solutions you can do with this. You could get a little creative with some of the stuff. And let's go through the risks of the deal first. Okay, the borrower's deceased and the remaining spouse is also gone. Well, you're not going to be able to get the dead borrowers back to the table to sign the property over. So you're going to have to go through the foreclosure, or you're going to buy this deal as a note deal, not as an REO. It does need some work. Okay. But could you approach the probate? Could you approach the remaining spouse to give them some cash for keys? Hey, we'll give you 50 grand to walk away from the property to put you in a better spot. You could do that. And then rehab the home and sell it. Could you also approach the borrower and say, hey, if you want to stay in a house and they don't want to get out of it, then instead of us foreclosing on the property, let's work with you and get you in a reverse mortgage. You know, value of the house is over 100 grand. They got a ton of equity. Age-wise, at 62, over 62, they both would have qualified, even with their remaining spouse would have qualified as well. Don't care about the credit scores. Don't care if they're on time or not. So that would be something to think about doing and getting refinanced on full as a reverse mortgage. Instead of being 6 months to do that, you could maybe do that in 60 to 90 days. So your ROI goes up to maybe 18, 19%, and then your 6 month return is closer to 40. So if that didn't work, and they wouldn't play ball, if it didn't sell at the foreclosure auction, you now own an asset that's worth 150, maybe 200 fixed up that you're into for 60, 70 grand. I mean, a new roof, exterior paint and siding is not that bad. The big difference is if it's a 3-1, 3-2, what the condition is on the inside. Now, with them living there for 20 years, it's probably a little outdated, but that's still paint, carpet, and appliances. You know, paint goes a long way. Sheetrock goes a long way. And potentially be a pretty nice little property. Because if they're maintaining the exterior, and although the grass doesn't grow very tall out in West Texas, the fact that they've got the plants and they've got some stuff they're currently or semi-currently does bode well for that the inside may just need a quick paint and carpet and some touch-up. It's a first-time home buyer's house. If it's a 3-1, that's not as desirable as a 3-2, obviously. But for it being a 1,200, 1,300 square foot house on a quarter acre, there's some room. There's a backyard to it, and it's in a decent neighborhood. I mean, it's not a bad neighborhood at all, based on the current street views that we could see as well. So if you're interested in something like this, I would actually like this deal here for you. It's a potential deal there that I think somebody could actually make some pretty decent money. A good return, a simple return in 6 months or less. Or if you know in 90 days that you're going to be taking the REO back or working something out. There's definitely multiple ways to make money on this deal besides just buying the note, getting them reperforming, getting them refinanced out, cash for keys, reverse mortgage versus foreclosing, and go on that run. Of course, if the family doesn't have the money to rehab it, maybe it's a cash for keys. They will give you 10 grand or 20 grand, and they're done with the deal if both the borrowers are out of the property. So there's multiple ways to make money on this one. If you're interested, obviously there's always a due diligence period. You'll be able to have somebody go drive by the property, take a current photo. If it is vacant, it might be able to get into it. If it's occupied, obviously not going to get into it. I prefer it being occupied, actually, at this point. Somebody's living in the property. They're taking care of the property. I don't care if there's a lot of stuff in it, as long as it's not trashed or a hoarder house situation, and I don't think it is. Obviously, you're going to pull a new property valuation with an exterior BPO. We're going to look at the collateral file, the documents, making sure that everything gives us the right to foreclose. We're going to look at title, making sure there's no other liens on the property. And we'll be utilizing a servicing company to collect payments or start with the foreclosure process, and then also reviewing attorney notes from the hedge fund on this deal. And so if you're interested in doing deals like this, please feel free to reach out to me. This is an opportunity for somebody, guys, out there. If you've got, 40 grand sitting on the sideline and you want to get started, we can help partner with you and get rock and rolling. So if you want to submit some offers or talk about partnering, reach out to me at scott@weclosenotes.com. That's my direct email address. Or you can always book a phone call with me on my schedule at talkwithscottcarson.com. That's talkwithscottcarson.com. If you are new to note investing, I would not mess it. I would just say, oh, I'm going to wing it and figure it out as I go. No, I would highly take the time, invest the $99 to sign up for our next 2-day workshop in August on 29th and 30th. Wow, it's hard to believe we're under 60 days from there. We're right at 59 days for football too as we do this. But check out our virtual note buying workshop or go to notebuyingfordummies.com. 2-day workshop, all day Saturday, all day Sunday, plus the replays. It is the biggest bang for the buck. And really, one of the best things that we've helped the who's of note investors learn how to dive into the non-performing notes by taking that workshop. So go out, take some action, everybody, and let's go out and make some money in 2026. And as always, thank you for jumping on the 50 note deals in 50 days. I'd love to get your feedback. Are you enjoying these? Are you disliking them? Do you have a deal you'd like for us to feature on that you're trying to move or buy and stuff like that? If you are, so please feel free to reach out to me. We are glad to include a couple deals. We've got 3 or 4 deals right now lined up with other students who want us to feature them. So let's make a deal, everybody, and go out and make some money. So we'll see you guys at the top out there. Once again, everybody, thank you so much, and we'll see you later. Bye. Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the No Close Show podcast. And we have another deal in our 50 deals in 50 days. This one is down in the valley, not all the way down to south like Brownsville, like one of the earlier ones. This one was a little further up south of Del Rio. This is in Eagle Pass, Texas, which is right on the Texas-Mexico border. It's a performing note at this time. It has been non-performing. Borrower's gotten back to being re-performing on this. It's paid 13 months in the last 12 months. And so let's dive into this deal because it's got a ton of equity and it's got some positive sides to it, I think, that could be a pretty good yield for somebody looking to put 40 to 50K to work and make a double-digit return. So that's what the property looks like from Zillow. All right. You see a truck driver there. I honestly believe that the borrower is self-employed, drives the truck, has route stuff like that. And but they've done a lot of work. The whole front of the house is different. There used to be a different facade and part of the house where those 2 trucks pickup trucks are parked. And those columns, they're actually awnings that come out for the shade. So when they have family and friends over, it pops out the shades for it. So it's a little bit interesting look, but hey, they're living in there. Newer roof on it, done a lot of pride of ownership. I say, yeah, it might be a little bit dirty with trucks in the semi-truck, but it's actually, if you look back at the Zillow street views, they've actually upgraded the property. Now, it is if you don't know where Del Rio Eagle Pass is, it is on the border there, straight basically shot to southwest of San Antonio there. I've been to Eagle Pass before. It's not the biggest crossing like in Del Rio or Laredo or Brownsville, but it's still, I like it better than El Paso for sure. So the property is actually about a mile from the Rio Grande and the border crossing. So I wouldn't be surprised if this borrower was going back and forth. That's their work across the border, getting vegetables or driving things back and forth, with the whole NAFTA thing that we used to have. But anyway, like I said, that's where it's located. It is, to give you a bit of an idea, it's a 4.2. It's a pretty good sized house, 2,931 square foot house. Built in 2008. It stands on just over an acre lot. The fair market value, what I can say online, there's some that put it like 311, some at 315. I'm just going to say it's a fair market value of about 300,000 right now. It was originated back in 2008. Borrower lived in it for 13 years, fell behind because of COVID and everything. It was modified in 2021. Basically, the legal payoff balance is right around $48,500. Their current, as of this moment, the borrowers paid 13 payments in the last 12 months, even though 5 of those payments came at one lump sum roughly 5 months ago. The P&I payment is an attractive $523.55 a month. It's got a flat interest rate of 4%. It's a 15-year mortgage, and there are 111 months left on it. It wasn't your traditional 180 month. It was like 167 months when it was modified in 2021. Okay. So that's why we kind of off. And if you try to calculate everything on HPB 10B2 financial calculators, would be a little off for you. But that's why there's 111 months left. It is with a third party servicing company collecting payments as we sit the borrower's current, based on the most recent information on the tape. Now, it's a performing note. The seller is going to treat it as a performing note because the borrower's bought it back, brought it back to performance. So if you were to buy this at 80%, you're $48.5 thousand times 80 cents on the dollar. That comes to a purchase price of roughly 38.8. We're going to charge a 2K fee onto it. So you're basically going to be into this roughly right about $41,000. Now, if you take the 523.55 per month payment times 12 months, it's going to bring in 62.82 gross. Okay. 62.82 gross divided by your $41,000 cost is going to be a 15% return on investment. That's not a bad deal for a performing note there, especially something at 4%. Now, if you deduct the servicing costs of their staying on time and only paying about $400 a year in just the servicing side, that drops it from a 15.3 really down to a 14.3. And it's still at a 15%, you know, a 15% of fair market value. So you got a ton of equity, 85% equity above it, you know, $250,000 in equity above what you're owed on it. Now, like I said, they paid in chunks. This was kind of normal for somebody that's self-employed that has, you know, to pay for 5 months, not pay for a couple, get caught back up, pay for a couple months on time, miss a couple payments here. That's what I can tell from the last 24 months of payment history on there. So basically, is it truly a reperform? It's more of kind of a scratch and dent note in a lot of cases. So I'm just disclosing that on the front end. Borrower's current as it is, who knows what they're going to do? And it all depends on what's going on. Here's the thing. Most of your Latino families, Mexican families, they're not going to lose their house. They're not going to lose their truck, and they're not going to lose their house. They're going to come together to pay it, especially if it's something like this. But here's the thing. The equity side of this, the value of the property, even if it's not worth 300, even if it's worth 200, you're sitting at a very secure position of being at under 50 grand as far as the legal balance goes. Okay. And if you pick it up at 41, you're sitting even better. All right. Potentially no greater than 20%, even if it needs some work and you had to foreclose. So if the borrower stops paying, though, this is where you got to kind of reason. I'm bringing this up just because you have to be aware of this. So 48,500 minus your $41,000 cost of acquisition, that's 7,500 in gross profit if you sold it at the foreclosure auction. Okay, I figured 6,500 because it's going to take you about $1,000 to foreclose in 90 days. They stop paying. Okay, well, 6,500 divided by your cost of 41 is a 15.9% ROI in 90 days. That's pretty good if you sell it at the auction. You make 16, just under 16% in 90 days. You know, if it's sold and gets paid off at auction, which I would imagine probably would with this much equity, that's still a 31.8% annualized ROI. Now let me rephrase this. So 15.9 in 6 months. Figure 3 months of non-payment. It's going to take you a little while to get through the foreclosure process, 1 to 2 months. So let's just say 6 months. If they stop paying in 3 months, you foreclose. You sell it at auction in 6 months. That's where we get the 15.9. It's also where we get the 31.8 ROI if you annualize the ROI by doing this in 6 months. Now, it's potential REO if it doesn't sell. So you're going to sit into it for some higher value. It's just up to you. Do you want to own something on the borderline? There's plenty of, I think Eagle Pass is a pretty good sized town. It's not as big like Austin or Dallas, but there's still plenty of people there and plenty of opportunities with everything going on there. So this is something to think about. Do you want to be secured? If you've got 40, 50 grand in an IRA, this might be a potential deal for you to make a double-digit yield on a passive basis. Or if they don't pay, stay. You foreclose or they get caught back up. And then we've seen it hit and miss. Sometimes borrowers will do that. And a lot of times this can be alleviated with changing the payment from once a month to twice a month, splitting the payment up to bi-monthly versus once a month. Okay. Especially during COVID, a lot of people, we had people that stopped paying. We had to do forbearance agreements and things like that. Didn't pay for 6 months or 9 months, and they got caught back up all at once. And so that's fine. And just keep it up. People are struggling in some places out there, are having a hard time paying bills. Now, as we record this, if you make an offer on this, and you're obviously going to dive and do your due diligence on this stuff. So you got to understand the risk for your deal. The borrower skips or stops paying. and or reinstates, you're going to buy this deal as a note with the upside. If it does go to foreclosure, if needed to, you're going to end up with a pretty decent REO. So you're in a pretty good position just whether or not the borrower is going to keep paying on time for you. So obviously, one of the things I would do during due diligence is that I haven't mentioned before is reviewing the work history, making sure we have updated contact information on the borrower, whether it's English and or Spanish speaking. And that's one thing your servicing company can do for you. And that's the thing about the due diligence side of things, ladies and gentlemen. You're going to review the condition of the property. You're still going to send somebody by, take a picture. There's a fence there at the front end, so they're not going to get in and see the interior condition of the property. It is occupied, so you're not getting in. If it was vacant, then yeah, you could jump the fence, go take a look at it, as long as nobody's living there. Obviously, double checking the value. I think we're pretty clear on this with it being worth 300 plus, okay, or at least 250 plus, okay. Obviously, you can look at the collateral file, the documents, making sure everything is clean, all the necessary documents to foreclose on. You could also notify your servicing company that once a borrower gets behind 90 days, you won't accept anything except the full payment. So they're not just kind of kicking can down the road. You're going to review the title. You're going to look at all the things, the servicing and attorney notes, and seeing what's going on with the bar. Why did they fall behind? How did they get caught up? What are they doing? And kind of work your magic in there. And this, like I said, this is an opportunity. If it was an opportunity, I want to be talking about it for a little bit more. So this is something to take a look at if you like that South Texas, especially Texas asset where you can foreclose quickly on there with a ton of upside. Of course, to submit your offers or looking to partner, if you own somebody but you want somebody to hold your hand through it, we're glad to help out with that. You can email me at scott@weclosenotes.com. That's scott@weclosenotes.com. Or book a phone call with me on my schedule at talkwithscottcarson.com. Pick out a time that works. If you don't see that works, just drop me an email. We can schedule something as always. Now, if you want to learn about note investing, performing, non-performing, reperforming, contract for deeds, wraps, foreclosures, all that good stuff, then you definitely want to get signed up for our next workshop on August 29th to the 30th. It's called our Note Buying for Dummies workshop or a virtual note buying workshop. You can get signed up by going to notebuyingfordummies.com or go to our website at weclosenotes.com and sign up from the education tab. As always, you can always reach out to me directly at the email. Always glad to hear from you. If you've got a deal that you'd like us to feature during this 50K in 50 days, please feel free to reach out to email me the details. We'll talk about it. We've got a couple outside of Texas after this deal, one in Florida, another one in Albuquerque, New Mexico. One's a non-performing, the other one is a wraparound mortgage that investors looking for funding on. So let's talk, go out, take some action, get signed up for a class, and we'll see you at the top, everybody. Bye. Good morning, good afternoon, and good evening, everybody. Hey, welcome to this next episode of the podcast and our 50 Deals in 50 Days series. Excited to talk about this little deal in Port Arthur, Texas. It is a reperforming note that's been paying over a year straight now. And it's a nice looking property. But don't fall in love with the property, because when you buy the note, you don't own the real estate. You're just the lender on the deal. And what's great is no matter what happens to the property, you should not be getting phone calls about the AC, any flooding, anything going on here. Let's dive into this deal and talk about how it could be a great little deal for somebody's low balance IRA to get the ball rocking and rolling to above average returns for you. So anyway, this is what the property looks like. Yes, it looks like it's brand newly built. It was. It's not too far from the water, not on the Gulf of Mexico, or as Trump would say, the Gulf of America. But it is on kind of a inlet near Beaumont. And Port Arthur is, if you don't know where it's at, is south of Beaumont, Texas. There's a little map for you there. You can see where it's kind of located. This is not right on the water. It's 2 blocks off the water. There is a park in front of it, though, so you basically have water views if you were to buy the property. But you don't. There's a borrower in the property that's lived there for years. So let's dive into the details of this asset. Like I said, it's a reperforming note. 3-bedroom, 2-bath, 1,092 square foot. It was rebuilt in 2021 after the hurricane. Okay, it's on a 0.35 acre lot. Fair market value, as it sits, about 152 as far as the online valuation. Now, the underlying mortgage was originated in 2007, and it was modified in 2020. Okay, borrower was falling behind. They're back on track. They only owe, here's the payoff amount, is $23,200. House is 5 years old basically, and they only owe that amount on a higher valuation. That's the great thing about insurance. Okay, it covers you in case you get wiped out. That's why it's up higher on stilts there, like most of the homes in Port Arthur. The P&I payment It's not very big. It's only $211.76 a month. The underlying interest rate, modified interest rate, is at 3.75. So they modified it during COVID at a rate that was low, perfunctory of what rates were at COVID. So don't think the borrower is going to refinance out anytime soon. Okay. There is a chunk of equity there. Maybe they do a cash out refi. Maybe they do pull some equity out. Maybe they've got a line of credit. I don't know. But it is a 30-year mortgage with 135 months left on this deal, so just over 11 years, and it is handled with professional third-party servicing. All right. Now, let's look at the numbers. Now, since this is a performing note with equity, if you were to make an offer at 80% of that legal balance, that's 23,200 times 0.80. That's going to come to 18,560. Add my fee to the deal, about $1,000. That might be a little negotiable depending on what the underlying lender comes back at it. But if you take 211.76 times 12, that comes to just over $2,500, $2,541 in cash flow in 12 months. You divide that by your cost of acquisition, which is the purchase price of the note, my fee, it's 19.5. That comes to a respectful 13% ROI, right? Now, if you deduct the servicing cost, which we deduct about $400 a year for just the servicing cost because it's performing, so it should only be somewhere between $25 and $35 a month. That drops the ROI down to still a respectable 11%. The great thing is this is an only 15% fair of the fair market value. So you're in a very, very secure lien position in the first lien position. No other liens in place. The only thing that would wipe you out with taxes and God, well, that's why you've got insurance on this. In case of an act of God. Taxes are paid up to date. I believe actually taxes are escrowed on this one. So something to keep in mind there. You could step into this thing and have, just about $200 a month coming in cash flow. Not going to be the retirement to the Gulf Coast kind of note, but it is going to be something that can give you respectful $200 a month. This is, like I said, ideally for a solo investor. I don't think I would go in there trying to raise capital unless you can find somebody who's wanting to make 6% on their money, and then you arbitrage the difference. But still kind of a small amount for a performing note on a secured loan. Like I said, the lender is looking to sell this one off, not looking to partner with anybody on this like they don't do on some of the other fix and flips, but this is a performing first lien that was modified 6 years ago, and it could be something that could be a good little cash on cash return for you. If you're interested, you will obviously have time for due diligence. You want to send somebody by the property, review the condition of the property. That photo is about 2 years old. It is occupied. It is not vacant, but you still want to double check. Pull your own property valuations. Like with this one, the online valuation 150, I wouldn't necessarily go and worry about pulling values, paying for a BPO. I would send somebody by for an AVM. I have a realtor pull comps just for the heck of it, or a drive-by, making sure that the property is still there, not washed away. Obviously, you have a chance to review the collateral file, all the documents, pull title reports, make sure all the documents in place, the mod's taken care of properly so that you have the right to foreclose. And obviously, you get the servicing and attorney notes. But if the borrower's been paying on time for quite a while, I think you're going to be in a pretty secure position. So the little base hit here, maybe more of a bunt single, but it's still getting into the game and getting rock and roll. A pretty secure little note. Don't think they're going to refinance you out, so you probably have to be prepared to hold on to this deal for quite a bit of time on a passive basis. So feel free if you have any questions or you want to submit your offer on this deal, or like to partner with us on any other deals that we're talking about, you can reach out to me at scott@weclosenotes.com. That's scott@weclosenotes.com. Or you can book a phone call on my schedule at talkwithscottcarson.com. As always, if you want to learn about performing and non-performing notes, check out our virtual note buying workshop by going to notebuyingfordummies.com. And our next class is August 29th and 30th. That's a Saturday and Sunday for the low price of $99. So go out, take some action, everybody, and we will see you at top. And thank you for listening to our 50 Note Deals in 50 Days series. Good morning, good afternoon, and good evening, real estate investors and note investors. We've got another deal in our 50 Deals for 50 Days. This is actually from a private seller who messaged me about a couple weeks ago about wanting to sell a note. It's actually a wraparound note. It's actually a sub two wraparound note deal. The note was taken on subject to, then it was owner financed to an owner occupant in Dallas, Texas. Right, we got a big D. We don't mean divorce. A potential deal in Dallas for you guys to take a look at. So it's not a bad little note. It's actually got some nice qualifications to it. I kind of like some of the things about it. So let's dive into this asset and go from there. Now, it is not the biggest property It's not a bad looking little property. Recently rehabbed and renovated before it was owner financed a year ago. This is what it looked like prior to the new um, owner financed buyer or borrower, I guess you could say. That's the front of the property. It sits on about just under a third of an acre. There's the back of the property. Uh, and give you some photos of the interior that showed up online. You know, the rehabbed, clean appliances. You got backsplash. You got laminate flooring. The bathrooms look nice. The hallways look nice. They have new fresh carpet in the bedrooms, and it's not a bad looking little property there in Dallas. Now, to give you some details, it says it's a 3.2 986 square foot house. Might be 3.1. I had a hard time finding if it was a 3.1 or 3.2, so we'll just put it that. It was built originally back in 1956, but recently updated in the last 12, just over 12 months ago. It's on a 0.32 acre lot. Right now, fair market value is all over the place. Zillow gave it a lower value than what I expected it to be, but I figured the fair market value being roughly around 208 plus based on things. Now, like I said, it's a sub two rep deal or a non-qualified assumption, and then it was owner finance. So the underlying loan, which is the first lien in place, technically the wrap is a second. We'll talk about the underlying first lien, the sub two information. The unpaid balances on the original mortgage, which was originally with Midland Mortgage, it's just over $106,000. It was originally $118,000, and the P&I on it was $1,061 a month. The interest rate is 2.875. Okay, so as of a year ago, there were 307 months left on the deal. So that gives you a bit of an idea that they were in there about a good 5 years. And unfortunately, we're trying to get out of it. So it was a third party servicer. Okay. And so there you can see 1,061 underlying note. Somebody came in, took it over to the existing payment, and then owner financed it to an end buyer. Now let's talk about the wraparound mortgage. Okay. So this was originated in July of 2025. That's right at a year. Okay. They originated it with a wraparound mortgage that goes around the $106,000 first at $180,000 at 7.99% interest rate. 30-year, the P&I payment is $1,319 a month. So it's basically cash flowing about $258 a month. All right. Plus, there's a big chunk between the 180 mortgage and then the $107,000 mortgage. So there's a big chunk there in the equity side of things. So the owner of this note is looking to sell it. Obviously, if you're going to be raising capital or using your own funds, if you're going to be paying money into this, you're going to want to pay off the underlying first lien of this deal so that you are actually in a first lien position, not buying technically a second lien. Okay. So you would do part of the idea is paying off the underlying note, paying off the sub two payoff, plus giving some cash to the end buyer or the actually person that originated that owner finance note. It is currently with Providence Servicing. I've been told it did go through an RMLO here in Texas. I don't have the RMLO package. I do have the closing docs as far as like the wraparound note, the sub two disclosures, actually the title company, even the title insurance on the property as well. But I just don't have the RMLO package yet, and I'm been told I can get it. But like I said, it's a 1 year season note with some definitely some potential equity on this because we see, if it's valued at 208 plus, some people say 245, you're sitting in a pretty good equity position. So let's talk about the numbers. Okay. So the seller, if you're to bring money to the table, you would pay money to pay off the underlying mortgage plus cash to the seller. Now the payoff is at 106.5 thousand. The seller is looking for $40,000 or best offering. Basically, you'd be coming in at 146.5 plus my fee, so roughly right about 150. Okay. Now the wrap terms, like I said before, it's $180,000 first lien at 7.99% interest. That's technically what you're buying the note at. All right. It's a 30-year PMI payments $1,319 a month. So if you figure what your cash flow is going to be, $1,319 a month times 12, that comes to $15,828. Now it's performing. It's not non-performing. Okay, so you're just going to see the 12 months of payments. So that's 15,828. Okay, $15,828 divided by your $150,000 purchase price. That comes to a 10.5% cash and cash return. Okay, it comes to like I said, a 10.5% cash and cash return. Now, if you deduct, say, $400 a year in servicing costs, because you figured somewhere between $30 and $35 a month for servicing costs, You could have it with Covey Finn. Getting that, your ROI drops to about a 10.2% after servicing costs. Now, remember, the estimated unpaid balance when I went and ran I ran an amortization table. Your UPB right now sits at 178.5 at the 1 year mark. First, July 1st is their next payment due. That's at 84% of UPB, and it's roughly about 75% of if you the high value or 80, what is that, about 90, 80 cents on the dollar of market value. Actually, it's a little bit below that. But anyway, it's not a bad first lien performance. It's with Provident Servicing. I'd probably move servicing companies. I'm not a big fan of Provident. Neither is the seller. But to close on this, you would actually wire money into Midland Mortgage, pay that off, get you would put your cash payment into a deposit with attorney, making sure that the underlying mortgage gets paid off. I would close with a title company or an attorney's office. You could do Alan Shesker here in Central Texas. He's a really great attorney for doing these sub-2 deals. And it was not originated with Alan Shesker. It was originated with a different attorney up in Dallas. That's why I know that the Armola package is available. I know who they are. But anyway, so about a 10.2. That's not bad. Now, if you wanted to make a 12% return, as I know a lot of you guys are, so if you take the cash flow, I did 15.4 as a cash flow. I went ahead and deducted servicing costs. Divide that by your 12% required ROI. That means you would pay about 128,333. Okay. Now that's $106,000 first. That's 3K fee and $22,000 going to the seller. Don't know if she's accepting that. I'm just the messenger here. Now, like I said, the estimated unpaid balance is at 178.5. If you were to buy it at 128, that's at a whopping 71.9% of UPB. So you've got a chunk of equity if the borrower stops paying. And like I said, the full collateral file, payoffs, and history will all be available for winning bidder. So if you are interested in something like this, you're basically, paying $130,000, $140,000. It pays off the underlying first. That second, which is a wraparound mortgage, becomes the first lien, and that's what you're into it for. And that's not a bad day, ladies and gentlemen. You're sitting at a pretty good LTV. I'm not disclosing the address. Like I said, I've got some current photos there for you from just a year old. It's in a pretty good spot. It's owner occupied and rock and roll. It's a husband and wife that purchased it. I haven't seen their 1003 or Armolo package, but it's definitely, I know there was one created based on what the seller told me. So it's just a matter of getting it over to me. But anyway, she's been very compliant with any type of information I've requested. And this is an opportunity for you to step into a 10 to 12% performing wraparound mortgage with some equity for you guys. So if you are interested, just reach out to me. Obviously, if your bid's accepted, there's a due diligence period there for you. Review the condition of the property. You still want to drive by the property. You're not going to be able to see inside of it. Drive by, make sure it's still there. It is occupied, so it doesn't have to worry about it. If it was vacant, you'd see it, but obviously if it's vacant, it'd be a non-performing note pretty much. You double check your own property valuation, comps, things like that. It's a little bit across the board. Obviously, you'll have access to collateral file documents, title reviews, the right to foreclose if they stop paying because you're buying a first lien position, which is secured. And of course, you'll be reviewing the servicing and attorney notes and the payment history and all that good stuff and updated payoffs. So if you're interested, just reach out to me directly, Scott@WeCloseNotes.com. Now, if you like any of these offers we've gone through, you can always talk to me about partnering. We've got some different opportunities on some of these deals for you to fund the deal and just to dive into the deal and manage it for you and partner in some sort of way. So reach out to me at Scott@WeCloseNotes.com or book a phone call if you've got any questions at talkwithscottcarson.com. That's my direct calendar link. I'm always here to help assist you guys in taking some things down. Very excited about this 50 and 50K series. We'll, in the next couple days or two, we're going to actually go through another sub-2 deal potential deal that's actually out in Albuquerque, New Mexico. It's outside of Texas, but I thought we would mix in a little bit of stuff for those outside looking for other deals. We'll probably maybe even mix in some reverse mortgages. We've got some stuff that's been sent to us in South Carolina, North Carolina, and other places as well. So primarily Texas deals, but we're going to mix in a little bit along. We've also got a deal down in Florida as a non-performing note that one of our students sent to us that was performing. It's now performing. They're looking to sell it to cash in, cash out of it, and they're going to leave plenty of meat in the bone for somebody out there. So if you have a deal you'd like us to profile on 50 deals in 50 days, please reach out to me at either one of those, scott@weclosenotes.com or talkwithscottcarson.com, and we get rocking forth. Of course, if you're looking to learn a note business, I highly recommend you go to our next, or sign up for our next 2-day class. Our next virtual note buying workshop is August 29th and 30th. You can get signed up for it by going to notebuyingfordummies.com. That's notebuyingfordummies.com, or go to weclosenotes.com and click on the education tab. So hope you have a great evening. It is hard to believe that the year is about halfway over. Let's make the second half of 2026 your most profitable year. And besides just celebrating Independence Day and the 250th birthday of the United States, let's help celebrate your Independence Day by buying some notes that are going to cash flow for you. So go out, take some action, everybody. Thank you so much. These videos are available on YouTube, our podcast, and we also create individual newsletters as well on each episode. So hope you enjoy it. Go take some action, and we'll see you guys at the top. Bye, everybody. Good morning, good afternoon, and good evening, real estate investors. We've got another case study for you. Probably going to be sick and tired of me saying this stuff as we go through these different deals. But this is a great little starter deal. It is a reperforming, and it's now been performing for over a year straight. Like I said, small balance, a great little deal for your IRA, your ESA, your solo 401k, whatever self-directed IRA account you have, even bonding together a couple different accounts to take this down. And this is it's a performing note, what I call now, but based on the tape that was given to me, it says RPL, reperforming loan from the hedge fund. But since they've paid more than 12 months straight and they're current, I consider it a performing note, and shows the motivation by the borrowers to stay in this property. Now, it's not the biggest property. It is not the most expensive property, but I believe it's a solid little good cash flow deal. It's not going to get rich on this, but it's going to be a good yield for a few years, roughly about 5.5 years to get rock and rolling for you. So let's dive into this note. Down in Brownsville, if you don't know where Brownsville is, it is down on the border of Mexico, down by South Padre, San Benito, via down south, obviously way south of Laredo, but down on really the Rio Grande, true South Padre Island down here. Now, not a bad area down there. Lots of great stuff. This is owner-occupied. Borrowers lived in it for quite a few years, and they've got a ton of equity in the deal. So I don't mind this neck of the woods. It's going to stay pretty warm most of the time. And if something doesn't go well with the borrower, if they stop paying, it's a fast foreclosure market, and you're going to end up with a ton of equity. So, but when I look at this deal, it's not bad at all. So this is kind of the side view. I couldn't really find a really good picture of the property. This is about 2.5 years old, but you see the truck in the driveway there. You see pots, landscaping, somebody taking care of the property down there. And here's another front view from Zillow, Google Streets, and you can see, plants, the chairs. It's kind of harder to find, but somebody's lived there, pride of ownership. The house doesn't look too bad from this. This is about a 2-year-old photo. As always, you're going to send somebody by to take a photo of the property if you're going to buy anything. And so this is like I said, it's a first lien. It's a 3-bedroom, 2-bath, 1,197 square foot. It was built back in 1940. It's on 0.8 of an acre. All right, so that gives you a bit of an idea. Almost an acre lot. Now, the online AVM values, Zillow shows it a value of 153. Okay. The payoff on this is only 14,000. Okay. 9% fair market value. So they've got 91% technically equity. Even if it's only worth 100, you're still sitting at such a huge equity position. Very low investment to value. Side note, it's owner occupied. It was originated back in 2007. So they've lived there just under 20 years. The P&I payment, $290.37. Interest rates at 3.25. It was originally a 180-month loan. That's 15 years. They went non-performing for a while, but have gotten back on track. That balance has been deferred. And there are 55 months left as of when the tape came out to me at the end of May. All right. And like I said, based on the payment history, they've paid 12 months of on-time payments, which is great. Taxes are also paid up to date. All right. The borrower is paying PITI, principal, interest, taxes, and insurance directly into the third-party servicing company. So they're collecting taxes, they're collecting insurance. And that's the great thing about something like this. This is pretty much you're stepping into a cash flow of just under $290 a month. Okay, just under $300 a month. You take out your servicing costs, $20, $25, $35 to middle of servicing. company, it's going to be a pretty good yield to you. So let's go through some more of the numbers here. So since there is so much equity on it, you'd probably have to come in at 80 cents on the dollar. I wouldn't go above 80 at all. Seller wants 90. There's no room to make any money on this really at 90, but an 80% of the 14,000, give or take a little balance, is about 11.2. We're just going to round it up to an even $12,000, $800 fee to me to help you with that. All right. So if you take $290.37 times 12 months, that comes to $34.84 in a 12-month period. Take that and divide that by 12. That's a 29% ROI. That's a pretty good year one ROI into your small balance account, right? Now, if you remove the servicing cost, which I'll do on this one, I just figured, I think it was $35 a month. I can't remember. It drops your ROI down still to a 25% ROI, which is pretty stinking good. Okay. That's good. That's a pretty good, obviously, paying back P&I. I think your yield over the 55 payments or the 55 months comes to about 110%, 115%. It's a pretty secure deal. Like I say, if you've got a low balance IRA, this could be a really great little cash flow for you for the next 5+ years, 4.5+ years, 55 months. And like I said, if they don't pay, you foreclose. I doubt they're going to foreclose on this, allow you to foreclose on that. You do have opportunities there. If they couldn't pay, cash for keys. Somebody's lived in the property for quite some time. So this is an asset that I wouldn't mind owning. I'm not going to move into it. 1,100 square foot house is a little small for me, but still, this is a great starting fee. It's in Texas. It's in an area where people are looking for homes down in the valley, that neck of the woods. All right. Laredo, further to the north up the coastline, does have a higher default rate in that neck of the woods. Actually, the highest default rate in the country a few quarters ago because of all the the issues with immigration and things like that. But this one, pretty secure little location, pretty great little neighborhood, and not too far from the border there for it. But the borrowers have been paying on time, like I said, for 12+ months. If you need to get an IRA or talk about getting a self-directed IRA because you could not use your 401k to do this or your traditional Schwab account or AG Edwards, you would need to have it with a true self-directed IRA custodian. Somebody to set up not only set up the account if you haven't done that, but also could give you checkbook access to it so you could write a check for this, make it really easy with any other future investments. Our preferred vendor is Safeguard Advisors. If you need to book a phone call, you can go directly to our website, weclosenotes.com, and there, if you go to the vendor tab, you'll see if they open your IRA, if you click on that tab, it'll take you directly to our buddy Nick over at Safeguard Advisors to get that stuff set up for you. Or just message me directly and I'll make an email introduction to Nick directly. But they do a really great job with our students and our clients and helping set up self-directed IRA plans for alternative investments of like either buying real estate, lending private money into real estate, or buying notes in this case. So here's a great way to put a little small balance and get an above average return for your low balance investment. All right. As always, you're going to perform your own due diligence on the property. We can walk you through that. You're going to still review the condition of the property, sending somebody by, making sure it's occupied, making sure it's still there, that those photos are about 2 years old. Obviously, if it's vacant, it's a different story. If it is occupied, hey, you're just going to drive by and, hey, that's a good thing. It's occupied, somebody's paying. Obviously, making sure the value's there. The value in this case doesn't have as much bearing to me with only a $14,000 balance. Yes, I want to make sure it's probably a $75,000 value or greater, but obviously there's plenty of equity there. We're going to review the collateral file, the loan documents. We're going to pull title, making sure there's nothing that's going to cloud title your ability to collect or foreclose, and go from there. And of course, reviewing the servicing notes, attorney notes, if there is any, what happened to also to non-perform, how far back. If it's beyond 24 months, I'm not really worried about it. You get a lot of folks that obviously defaulted during COVID and they're back on track. And I think this bar is back on track for a while. So pretty solid little base hit. It is not a home run. It's a base hit, $250 to $290 a month. It's not a bad little cash flow that covers what your cell phone bill, your power, your insurance. Here's one way to add a little cash flow to your bottom line. A great little starter deal with your low balance out there. So as always, guys, if you have any questions and want to make an offer on this, reach out to me directly at scott@weclosenotes.com. You can always book a phone call, pick my brain, ask questions by going to talkwithscottcarson.com and book a time that works on my schedule for you. But we've got some opportunities here for you, ladies and gentlemen, to get rocking and rolling. As always, you want to learn about note investing, take your business to the next level. Whether you're a new or seasoned real estate investor, note investing is one of the best ways to get rock and rolling here in 2026. And so our next 2-day workshop is August 29th and 30th. So if you go to notebuyingfordummies.com, you'll get signed up for a virtual note buying workshop. You don't have to wait till the end of August to start learning. Get signed up today. We'll actually send you the replays. That's right, replays plus the current class coming and the replays of that current class, all for $99. So let's get you rocking and rolling. Notebuyingfordummies.com. Otherwise, reach out to me directly if you have any questions. We're here to help you. And as always, thank you for being a part of our 50 in 50 series. All right. Take some action, buddy. Hopefully, we'll see you soon. Bye. Good morning, good afternoon, and good evening, real estate investors. Scott Carson here, excited to be talking about this next deal in the 50 deals in 50 days. Once again, welcome to the podcast, video, however you're watching, listening to, or reading this episode. This is the sixth deal in the 50 for 50 that we're featuring. This one is actually kind of in our backyards in Killeen, Texas. Now, it is a non-performing note. Uh, Based on the tape, it's vacant. Based on what we can tell online, it looks vacant as well. We'll go a little bit of the back story of the due diligence that we did previously to this. But this is one of 54 Texas deals that came to us. It's been non-performing for a while. Potential foreclosure. Foreclosure's been started on this. So let's dive into the numbers. Now, it is, as I record this on a Sunday, I actually went and looked at this yesterday, Saturday afternoon. It's a pretty day. Actually, if you don't know where Killeen is about an hour north of Austin, Texas. Now, I live on the north side of Austin, just on South Cedar Park kind of area. And so it takes us about an hour to get up there, 56 miles. I was going to head up there anyway to go to a birthday party in Belton. So I was like purposely to kind of kill two birds with one stone. So we took off. Hour get there, nice ride. It's great. Kind of, I say it's a back way north. You avoid I-35 and the chaos that can be with traffic. Even on an off weekend, there's always sometimes a wreck. So I like going the back roads a little bit as you can. So this worked out basically straight north almost for me an hour. So it gives you a bit of an idea. Now, Killeen is where Fort Cavazos, formerly Fort Hood, is located. That's the largest Army base in the country. And Killeen has its kind of feast or famine area when it comes to housing. When there's a lot of Army guys and military going on, rentals are up, properties moving. If it's good because people are down. If it's slowed down a little bit and the Army guys are out of town or there's not a lot of traffic coming in, guess what? The market's a little slow. And Killeen is an older community. All right. A lot of the homes built, during the building up of Fort Hood, stuff like that. But it's a great area. There's a lot of people here in Austin who like Killeen because it's outside of kind of the Austin Round Rock metro. It's a good 25, 30 minutes west of Temple, Texas. And they got 100 plus thousand people in Killeen. Surprise, surprise. I was kind of surprised to see that driving to town and seeing the city limit sign. But anyway, drove by. I've been familiar with Killeen for years. I've had some stuff that we flipped there before. It's been a long time since dealing with that. It's because it's just a bit of a drive. Outside our town, you're about an hour south of Waco, Texas as well. And but let's dive into the numbers on this. So we drove up there. This is the photo that's on Zillow. And you see it's a 3-bedroom, 2-bath. The 2-car bay garage has been converted into bedrooms. It's not the biggest of houses. It's 1,446 square feet, 3-bedroom, 2-bath. It's on about an eighth of an acre. I take that back, a quarter of an acre. We'll get into the numbers in a second there. But this is what I kind of expect. Now, this photo is taken from April or February of this year. So it's only a few months old. Obviously, the trees from the winter, stuff like that. When I did a Google Maps split around the neighborhood, very similar, all same size of homes, older community. Not bad at all, but you never know what you're going to get when you drive up there. So this is what I came to. So when I pulled up, the trees are really nice. The roof looks a little worse for wear. There are the notices on the windows, which I kind of figured out. That's kind of common for a vacant property, especially if a lender has changed the locks on a vacant property to protect their investment. You often see notices on the windows. There's a couple new notices on the garage there from weedlings from the city going out and mowing the lawn for last 2 years. And when I spun around, it was not a bad looking little property. I'll actually link the property walk around. It's about a 2-minute video of the neighborhood. I like the neighborhood. There are a couple vacant properties in the area. One looks like across the street looks like it's vacant. The one next door, it doesn't look vacant because they just mowed the lawn. But there's some opportunity, I think, in Killeen And especially in that first time home buyer market, that sub 200, sub 250 range compared to 400 really kind of being the average, 425 being the average price in Austin, Texas. So let's dive into the numbers. Like I said, it's a 3 bedroom, 2 bath, 1,446 square foot house. Okay. Built in 1970 on a quarter acre lot, big lot. Okay. Now, the online AVM, I'm not going to say Zillow, but that's the kind of the Zestimate. AVM fits better than Zillow on my screen here. Shows it a value of about 148,000. Okay, I can kind of agree with that if it's in pretty decent shape. Now, the payoff, the legal balance on the underlying note, because this is still a note, it's not an REO, bank has not finished the foreclosure yet, is at 71,000. Now, over 21,000 of that is in back taxes that have been paid. And it looks like this has been vacant for a good amount of time. Now, if you look at the payoff of 71,000, that's 50% of what the fair market value of as is would be if it's in good shape. Okay. Not bad. Not bad. Now, it was owner occupied in 1970. The only one owner on this property, but unfortunately, they originated the loan back in 1998. It was a 15-year mortgage. Um, should have been done in 2013. Unfortunately, both of the borrowers have passed. So they didn't finish paying off the loan. It's been sitting there non-performing for a while. So this note has passed through hands of several funds and is finally with this final fund. Now, to give you a bit of an idea in the numbers, all right, P&I payment was 375.90. It's at an interest rate of 9.99%. Next due is July 2013. So that tells me when they stop paying. Yes, that's 13 years of non-payment. Okay. And that adds up quite a bit. Okay, that's why the difference in not only lender advance fees, but also that $71,000 balance when the original balance was only about 20 grand. So you got 30 plus grand in back payments that didn't get paid. All right. Well, you're not going to collect from somebody who's dead and passed away. Unfortunately, it doesn't look like they have any heirs. Both the husband and wife passed away within just months of each other, unfortunately. From what I was able to search by going to the county records, pulling the borrower's or the homeowner's name and searching online, that's what I was able to find. Now, the foreclosure started just a few months ago. It is with a third-party servicing company. It looks like it's going to be going to foreclosure in the next couple months, all right, if not sooner. Because they're waiting. When you have something like this, when foreclosure started, you got to send it out to the heirs, and that takes a little while. If there's no heirs, you got to wait, a good 90 days for anybody to respond. So let's go through this. So if you were to normally buy this note at 80% of the legal balance, because there is a lot of balance, there's a lot of equity above it, 50% of 70 grand. So normal purchase price of a note with a ton of equity, I'm gonna put that in kind of in the air here, is paying 57,000 for it. If you pay, you're gonna pay that, you're gonna pay a grand to me. That's 58,000. All right. Now, if it was occupied, there were heirs that want to come back at 375.90 times 12 months comes to 45.10. On this deal, it would really not make sense to work to just have them start paying if there was a bar in the property, okay? Because it'd only be, you take 45.10, divide that by your $58,000 purchase price or cost to acquire, that's only a 7.7% return on investment before you deduct servicing costs, okay? It's gonna drop it down about 7 if you deduct the $300 in servicing costs or more. Now, if you had a family and then and you got them to start paying, I would require them to make double payments or bring 4 months to the table, and then you're making a half a payment every other month anyway. Okay. So if you were able to collect 24 months of payments in a 1 year period, then you'd see about 9,020, not 90 grand. Sorry, I got an extra zero in there. 9,000 in payments. That would still be about a 15.5% ROI if they were making double payments. That's not a bad day, but still kind of skinny if you're going to be using other people's money. All right. So on this deal, if you were to buy it and then take it to foreclosure, once again, 58,000. If the legal balance is 71,000, if you take, it sells at the auction, you'd make $13,000 profit between what you paid for the note and the legal balance, right? That's not too bad. If you did that in 90 days, it's a 22% ROI. If you did 90 days, you could multiply that times 4. That'd be an 88% annualized ROI. Not a bad if it's sold at auction that way. If you didn't sell, guess what? You now own a property that's supposed to be worth 148,000. Well, this is why we do diligence. We always put eyes on an asset. We always send somebody out to look at a property, see if it's occupied or vacant. This one was vacant. There's a lockbox on the door. Unfortunately, I did not have the combo to it. I haven't gotten it from the fund yet. but I still peeked in the windows, and there was a good layer of dust on the windows, but I was still able to see that it did need some work. Now, um, it hadn't transferred anybody, nobody did it over, so the property needs a tremendous amount of work. Okay, it's a complete rehab job. New roof, sheetrock. The ceiling sheetrock is falling off because of leaks in the roof. It's going to need new appliances, probably new electrical, new plumbing. I couldn't see inside the converted garage there, but I'm willing to bet that you would basically strip this down to the studs interior wise and then go from there. New lighting, new appliances. The back slab had some big cracks in it, and I don't know if that's the part of the main slab or it's just kind of like a driveway addition to it. There is no garage in the back, although there looks like there's slab for maybe a building back there, but not. But also around the front of the house, especially on the right-hand side, those front windows there, there's some wood rot there you have to replace too. So I would if you did this streamlined, you're looking at least 70K plus in rehab, figuring somewhere around 10 to 15, just alone for the roof, if not more. And then a paint job of something like this is going to run you, interior and exterior is going to run you probably 13 to 15. And that's not counting appliances, flooring, and stuff like that. So, and then depending on what you end up doing with the slab in the back. All right. It's a nice sized lot. But for me, on something like this, especially where the world is right now, since it's an hour away from me, it's a heavier rehab. For me, and that's my own personal opinion, this is a big pass. I don't like doing heavier rehabs outside an hour. I'm talking anything beyond paint, carpet, and light fixtures. That's a light rehab to me. Not new roofs, new sheetrock, all that stuff. I don't want to do that. Just not my forte. Now, if you are a fix and flipper, you are a rehabber, and you like the Killeen, Fort Hood, Fort Cavazos, Belton area, this might be an opportunity for you because the fund is looking for some individuals who it can partner with. Now, before we dive into kind of what they're looking about, somebody mentioned on a previous video, well, what about the loan file? Don't you have to look at the loan file beforehand to make sure that you have the right to foreclose? So I wanted to answer that because with all of these deals that we're going, you have a period of due diligence time. Okay. You're not going to have 90 days to do due diligence on a single asset. But here's the things to keep in mind. You're going to make an offer based on what you can find online. All right. Now, with this one, if I didn't drive by the property, my bid would be high. Okay. I honestly think it sits as is probably 50K. So my bid isn't going to be 58,000. It was going to be probably to acquire maybe 35 to 40 if I wasn't to do the rehab and the fix and flip on this stuff. I would need to be in that price range to make it worth my while. But in the rest of the things, like I said, you're always going to review condition of property by ordering an exterior BPO, which stands for broker price opinion, or you're going to drive by the property. If it's occupied, don't be going up there knocking on the door and peeking in the windows, okay? If it is vacant, then you can get away with it. Sometimes there'll be a lockbox on it. Sometimes you can get interior access. Sometimes the funds will provide during their due diligence period an interior inspection report. You'll see that, especially in reverse mortgage. But if the property is occupied, the best you can do is drive by it, call the utilities departments in the city to see if power is on and going from there. If it is vacant, then walking around the property is fine. Peeking the windows is fine, but be careful about what you do. Okay. If the condition of the property and the value of the property comes in below what the fund is saying it's worth, then obviously you've got proof of that. You can fade or reduce your bid during the due diligence period. If they don't accept it, then you walk away. Okay. But obviously, property valuations matching up, condition of the property. You're going to look at the collateral file after making your offer. You're not going to be reviewing collateral files on the front end 95% of the time. The collateral files you're going to assume are in good enough condition with the proper documents like the assignment of mortgages, the allonges, the original mortgage, deed, stuff like that will be included in the collateral file. Of course, if those are not in there, then you don't close. You get delayed. If there's missing assignments, it's not hard to fix, but you will not close until all the assignments are in order or the assignment chain. The note's been sold 4 times. You need to have 4 assignments, okay? So you're going to still review those documents. You're going to review the title report, making sure it's a first lien, making sure that you have the right to foreclose, all of those good things, while also reviewing servicing and attorney notes and the payment history and the payoffs. So you're going to make an indicative offering on the front end side, and then either it's going to be accepted and you work through the due diligence, and if everything matches up with due diligence, great, you close. If something pops up, you're going to fade or reduce your bid, and or cancel if they don't accept your fade or reduction. Or if you still like it and want to run with it, by all means, accept their counter or non-counter and close. You're not required to close based off your initial bid. You still have your time to do diligence, and that may be 7 to 14 days for a one-off note, which is pretty normal. It takes a couple days for a BPO, it takes a couple days for a title report or an ownership and encumbrance report, same thing, to come back and review it. So you have time for due diligence. You're not going to have to review everything on the front end side before making an offer. That just is not insightful to getting bids in. Okay. Now, as I mentioned before, this fund is looking for a rehab partnership, not only on this deal in Colleen, but some of the other ones you'll see us talk about over the next couple of weeks. Okay. And they're looking to partner with investors and rehabbers. They're willing to provide either the financing of the note or REO, or the carrying cost of buying that property or buying the note, or taking it back and allowing you to negotiate kind of, okay, what's the true value of this asset as is? We'll provide financing. You bring in the rehab funds and the scope of the rehab work. Once the scope of rehab is agreed upon, there will also be a split of profits, commensurate to the cost of things and rehab costs and cost of property, stuff like that. And the numbers can be negotiated on a deal by deal basis. So if you like rehabs, you like fix and flips, then stay tuned for what we have going on in some of these. We've focused primarily on the occupied assets to start off with. We have a few more occupied ones, obviously, we'll be going through, but we've also got some vacant ones that are more REO side of things. So if you're interested in this stuff, as always, you can submit your offers to either buy the note, buy the property, or to partner. If you're looking for a passive investment, hey, reach out to me. We've got plenty of opportunities. Thanks to those that have already done that. Or if you're looking potentially to buy this asset and partner with a fund on the rehab, that's fine. Just shoot me an email at scott@weclosenotes.com or book a time on my schedule at talkwithscottcarson.com. We are here to help you get some deals closed. We want to make 2026, especially the second half of 2026, your most profitable ever. If you're learning about note investing and want to learn more about it, then very easy. I would encourage you to sign up for our 2-day class. It's upcoming August 29th and 30th. That's a Saturday, Sunday. It's online via Zoom. Cost is like $99. So if you go to notebuyingfordummies.com, get signed up for that 2-day class, you'll get the replays of the previous class, and you'll be more educated as we go through these deals on a one-off basis. All right. And that's one of our biggest goals. That we've gone through this tape before as a full 54 assets, doing these one-off deals at a time, performing, non-performing, occupied, vacant. We'll also mix in a few outside of Texas as well, but primarily these are in Texas, so it gives you the fastest path to profitability. As always, ladies and gentlemen, thank you so much for coming on here. We are really excited about this asset. We're excited about all these deals that we're going through as a way for you guys to learn and for me to kind of show you the path to becoming a note investor. And as always, thanks for checking out our 50 note deals in 50 days. Go out, take some action, everybody, and we will see you at the top.